We don't have any major news coming out today, April the 1st. And for the rest of the week, nothing, no major news to report. Now let's go ahead over to the call that I called out yesterday. It worked beautifully. Just worked beautifully. After some patience, and the call was absolutely there. Get zoned in on this. Call was absolutely beautiful. This was the call that was called out yesterday. The 642 area, taking it from the 642 to the 645, and then from the 645 to the 648.50. Worked out beautifully. Shout out to those of you who made money with that. Shout out to those of you who understood why that was possible. You gotta love it. You saw the opportunity was there. Called it out. It is what it is. It's only safe places to take puts. This would definitely be one of them. Simply because that's underneath this monthly area of support. If you can turn it back into resistance. Plus you clearly see this bullish control buying. Okay. Not only that, you see the algo itself. So this will clearly be an area where they will have broken out of that control buying algo. And not until then. All right, team, I'm back. Again, now you can clearly see you can clearly see now this controlled selling algo that I have here in magenta. And as I told you guys yesterday, for us now to have been at the bottom of it, to bounce back to the top would to be expected. I said we'd have to bounce back to that 652 area. I said I'm not really concerned until she breaks out from this algo, which will be in that 658 area. That will let me know that we are now particularly possibly changing trends. Also keeping in mind that yesterday was the end of the month for March. And then so it gave the bulls the opportunity to end the month green. Okay. So let's take a look at exactly what that looks like on the chart. No, it didn't. It just allowed them to go green for the week. It was still a red month. As I stated, it did allow them to go green on the week. So that move yesterday closing, that bullish move for the end of the month, they still were red on the month, but that move did and has now given them their first potential green week. That has been, it's been a very long time since the bulls have had a green week. Pressure is at that 658. As you can clearly see here, where we'll be breaking out of this controlled selling algo, as well as putting pressure on the candle of these bears right here below the 659. They will then be in a position where they will have to start taking profit and start covering. So a lot of good action potentially could happen in this area. However, keep in mind, we are also now at the top of this controlled selling algo, so possibly it would not be surprising if you do see bears step back in this area to attempt to bring the market price back down. Just want to show you guys what is going on and hope you understand. Not only that, but the 658 is also a sweep area of last week's highs. And so in a sweep area, you may also potentially see bears step back in if the market does get up to the 658. Okay? So we just want to identify everything that's going on, and everything is correct. It's the 1 hour chart right now. It's a 1 hour coming from yesterday. Move didn't happen until 12:30 yesterday. "30-minute chart. Nice 3-candle reversal. Beautiful money in the first 30 minutes. Beautiful money from the 10:30 candle. And then if you waited and caught that break of the 246.9, really the 243 that I told you guys about, once she broke that 243, she was gone. And those were the plans that I had yesterday that worked great. What are we going to do today? Seeing that also is a closing of the cup at the 658. Seeing the top of the control selling algo is going to be in the 655 area. So we can expect some resistance at the 655 area. Closing the cup at 658. History has shown us some chop in this area between the 652 and the 658. There has been chop in this area. It has never really been smooth in this area. So there is potential again to make money if the market breaks out and above this controlled selling algo, just simply holding on to the bullish momentum. Take it all the way to the 658. So that's possible. Let's pull up some more plans here. Alrighty. Yes, sir. Work backwards. Clearly know there could be resistance here at the 658.3. So let's work backwards. If you break out of this algo, you could touch and close the cup even further at the 662. Let's move that there then. 658.3, 662.3 be the second profit target. Okay. So that now brings an entry above the 655.9. So let's just call it 656. Let's call it 656 area. Nothing is exact. Everything is areas and probabilities. A probability of this having a higher outcome of the market continuing to go upwards than the probability of it coming back down. So on a it says 656. On a 656, that'll put me at a strike. 654. And that would look like this. Let's draw it up. Bam, bam, bam. Yeah. That's what I'll be looking for. Something just like that. That's what I'll be looking for. And if she were to come back down, I wouldn't trust it until she got below the 644.5. As you see here in the recent past, below the 644.5. Okay, she was able to have a nice little gap down and continue down. And once again, she broke above the 644.5. She took off all the way to where she currently is right now at the 653. So in order for me to even feel comfortable taking a put, the very candle that made it happen would be the candle that I would look for to get my money from in the event that the market did decide to come down, and that would be this candle right here. That would be this candle right here. Until this candle right here gets called into question, then there is no reason to take a put. Any pullback could be a trap by the bulls to gain momentum as far as using those early bears as liquidity to take the market higher and break out of this larger controlled selling algo. And because of that, which is why I feel that that 656 area will be the next best place on the chart to take your call. If you want to go safe, that's where you go with the call. And for the put, let me just go ahead and make sure we got that clear. I said the 644.5. Okay, so that will make this 44, 46. That will make this 644.3, possibly down to 637.2, and possibly 634. Okay. Yep, that's how that lines up. It's exactly what I'm looking at right there. I'm gonna go ahead and put it on the larger chart, see how it lines up. But that is what I would definitely want to see. Okay, I want to see, understanding that we're in this much larger controlled selling algo, and as I spoke about it, for us to bounce from the bottom of the algo this week would not be surprising. We have the opportunity to close the cup here at the 658. If that does happen, we will also be outside of the algo. It's not going to go easy, but if it does, it could be a change of sentiment. Also, the bears could also step back in, use eager bulls as liquidity to bring the market back down. Either way, the 658.2 is going to be a very exciting area. So much so that to catch a ride from the 656 up to the 658.2 would only be an appropriate easy ride. Knowing that if it does happen, all the action is at 658.2, so that still gives you a nice $2 per contract move on the contracts, especially if you go in the money like what I plan to do in that area. That will be a very nice, profitable, predictable ride to the 658. What happens at the 658.2? I have no idea. But I do know, based upon what the market is showing us, that there is definitely going to be a conversation had in this area. Best believe it. There's going to be a closing of the cup, also a breaking of the algo. Will the bulls have enough momentum to continue this, Or will it simply be the market acting as it always does inside of a controlled, high-speed computer algorithmic trading? Time will tell. But for now, the bulls do have control of the week, and it's been a mighty long time since the bulls have had control of the week. The market is feeling very optimistic right now as everything is green and up quite a bit. Meta's up over $35. Nvidia's up, Netflix is up, Apple's up, Tesla's up over $16. Could be a very exciting day of trading. Finally, something worth trading. Now, let's go ahead and look at these plans on the Thinkorswim chart. Again, sometimes it's just as easy as following the crayons, Abdul. Following the crayons. Alrighty. Big shout out to those of you who are joining us on Kick. Big shout out to the team that is in the building as well. Appreciate you guys so very much. Alright, let's see what's going on here. What's going? Let's see what's going. Let's go ahead and blow this up. And as you can see here on my weekly chart, that we were in that controlled selling algo. And even though we were in that controlled selling algo, once we got down to the bottom of the algo, the bulls stepped back in. And just like I showed you on my trading view chart here on the Thinkorswim chart, you can still see that beautiful controlled selling algo and us now being at the top of it. Knowing that the bears could step back in, but I also have it highlighted here, that 658 area, 658.3 area. So very important. This area could represent a sweep area where the bears step back in and take the market back down, crushing eager bulls who finally think that the gig is up. This also could be an area where these bears in this beautiful bearish candle have to start taking profit, have to start covering their position before they start giving money back. Breaking outside of this controlled selling algo officially puts us in a controlled buying algo. And what better way to do that than to catch these bears who have to cover? Bear covering is buying. Buying causes the market price to go up. So if you join that side with a call, you're stepping on the necks of the bears as they're the ones who's in trouble. That is how we trade here. Who's in trouble? We look for a position that if you took a call, where would you be in trouble if you took a call? If you were a bull, where would you need to take profits? Where would you stop out? Where would you feel uncomfortable at? We only look for two emotions, fear and greed. That is what moves the market. That is what creates liquidity. This was such a beautiful candle to come in at the 640 mark. I wish I would have bought it in early at the 640 because on the week we flipped from red to green. Not only that, putting in a beautiful tail underneath the candle body, indicating bullish rejection of lower prices. Bulls are saying we've had enough. Now this is the only difference that you see in any previous week before. You do not see such a very strong tail underneath the candle body. Not to mention, we are green for the week, and today is just Wednesday. This could very well turn into something nice. We don't know what it's going to be, but we can definitely see at the 658.3 something that's definitely going down. So that is from the weekly candle. We do a complete top-down analysis from the monthly to the weekly. This is a new month. Last month was still a red month. So the first quarter of the stock market has been red. Today is the first day of the second quarter. Okay? And this week is green. And the market hasn't been green and hasn't had a green week in a mighty long time. But this week is green. Let's talk about money. Let's talk about how we flipped from red to green. Beautifully. Let's look at this daily chart. As we can still see though, we're still within the controlled selling algo. Very interesting is going to happen in that 658.3 area. Can't wait. Top right is the daily chart. Bottom right is the weekly chart. Bottom middle, where I'm on right now, is the 30-minute chart. And I'm trying to show you Monday on the 30-minute chart, as well as yesterday coming into today. We don't even need to see Monday. We'll just look at yesterday and today. Bottom left 15-minute chart. Top left 2-minute chart. In the middle, the 5-minute chart. That's what we primarily go off of. After we look for the larger time frame move, we look for the entry on the 2-minute. See what we have right now as we get ready to start. Let's use our superpower. We have a superpower of only having to trade when we clearly see edge. If we don't see edge, we do not trade. If it's not from your playbook, we do not trade. If you're not in control of your emotions, we do not trade. We treat this with the respect and professionalism that is required as we begin today. Put an alarm at the 6:55.9 for that call that I like. And I said 6:44. That's too far away. It's coming back. Testing this. Let's try to wait till you got here. That's too much. Questioning my put right now. Nope, I'm right. Nope, I'm right. The safe money is below the 644. Below the 645. I got you like 644.8 area. $640.3. No. Just change that. Alrighty, just change that. And that lines up with my trading view chart. With the profit here at the 637.5. Exactly what I just changed that to. It's the only put that I would see is if we break this control buying algo. Other than that, she's looking very bullish right now. Even with the hesitation out the gate this morning. So I'm gonna put my alarm yeah, 646. Shout out to the team. Yes, sir. Quiet Soul is in the building. It says Grand Rising Team. Big Ben is in the building. Good morning, great day, and grateful to be here on this great day. Jesse Swanson is in the building. Midweek, looking forward to a beautiful day in these markets. Trade well, everyone. Nkosi is in the building. Good morning, everyone. Trade well. I have a put alert at previous day high and the call at 656.40. Thank you, Nkosi, for that. Yes, sir. And I do wind up agreeing with you, as I like that 656 area also potentially. And we also have Dan, the man, is in the building. Dan, good morning, team. And Coach, he said he has a put entry at 649. Okay, definitely a little bit higher than me, but I do appreciate that. Since I probably won't trade, mental game is off. Haven't embraced my move yet, but we are analyzing, and that is one of the best things that you can do, is that you're gathering information, teammate. So even before you pull the trigger, even if you don't pull the trigger, you still have to gather the information and do the recon first. That is what we base our decision off of, not how we feel, but what the market show us. We don't predict, we react. We wait and see what the market does. So there's absolutely nothing wrong with waiting and watching. Actually, waiting is a part of trading. So shout out to your teammate for that discipline. Yes, sir. Jared Lewis is in the building, teammate Jared. So glad you joined us today, teammate, every day. Yes, sir. Today could potentially be a little bit more action, as of course, always, all the big moves happen when retail is not involved. We wake up to these big moves, and as soon as the bell rings, the market starts, hesitating. So again, that shows you even more why we have to trade with edge, why we have to look for the obvious trades, and why we have to stay away from the traps and running into things haphazardly. There will always be another trade. It is always better not to believe anything that you see right now, especially in this day and age. If you think it's going to be that easy. We've already identified the fact that we're at the top of the algo, and that bears have the tendency to come back in at this area, which is why we wanted to be notified, because a little bit above it is a potential call. And we know that's going to be in that 656 area. So all I'm going to do is re-put my alarm. There we go. Yes, sir. Market is doing what we expected to do at the top of the algo, and that is come down. But again, nice big gap up without retail being involved. We've been seeing a little bit of a pattern of that this week. Let's go ahead and pull up the 30-minute chart. And notice that has been the pattern this week. Gap up before retail gets involved. A little sideways action, and then a later afternoon breakout. But again, as we pointed out, we were at the bottom of this larger control selling algo. So the bull stepping back in and taking us back to the top of it was to be expected, as you guys can see here. There you have it. That is what you're looking at right there. That is what we saw. That is what we called out. But the majority of these gaps that took place without us. And that's what I was highlighting to the team. While we have to be careful and can't believe anything, and no one expect that typically when we get to the top of the algos, the bears come back in and let them have it. Okay? So don't be surprised if we see that today. Let me go ahead and put this back down. That was a 30 minute. Well, look what we have happening here. Just as we just spoke about it. The bears coming right back in at the top of the larger algo and letting the bulls have it. Because even though it was a nice bullish run, the bullish run was still contained within the larger selling algo. So all that meant was nice little run to the top, and now we come potentially back down, which is why I stated that I wanted my position to be above the 656. If we get over that area, we can make a run for it. But anything under that area, that's just how it is. So like I said, we clearly know the areas only because the market has shown us. We know absolutely nothing. I know nothing and claim to know nothing, but I do have some special glasses that I use to read the market. It showed me what's going on and where it's going on at. So I said, hey team, let's look at this area. Now, we don't know what's going to happen in that area. If anybody tells you they know what the market is going to do, they're lying. No. We don't know what's going to happen. But we do know where it's going to happen. And that's the advantage of being a teammate of ours. That's the benefit here. We look for pain and pleasure. And that's where you'll find us. Also, we also know that in these unusual times, we have to refer to the larger time frame. And on the larger time frame, the market just put in a beautiful green shooting star. With confirmation trading underneath the 653, it's out of here. If this gets below 653, it's out of here. It's out of here. A nice little 15-minute scalp potentially on the horizon. Not for me, because I'm looking for the easy money. But it is some scalp money out here. Yes, sir. Some scalp money out here. This is some put scalp money right here, right now, in your face. Especially if this market closes underneath 653.2. It's out of here. It's out of here. Gone. Pew. And the bulls understand that assignment as well. So they're not going to give it up just as easy. Let's go to level 2 and enjoy this fight. Yes, sir. The bulls can't give up the 653. If they do, it's out of here. So where are they putting the line in at? They're putting the line in at the 655. Okay. And the bears are pushing below that 655. The bears have a line in at 655. It's a straight tug of war right here. Bears are starting to win. Now let's look at the size. Who's going to come to the bulls' help? Not enough size on the bid. The ask is pushing it down, baby. Down the roller coaster. Yes. The line has been moved now all the way down to the 40. Oh, the bulls can't hold on. Oh, some big orders just came in on the bid. They saved it at the 40. Wasn't enough. Time is ticking, and it is ticking. Oh, no. Down to the 653.3 area. The bears have put a line in at the 653.3. The bulls are trying to hold in at the 653.15. Can they do it? Can they hold the 15? They're doing the best they can. How much time is left? A little less than 2 minutes on this clock. They're holding that 15 because they understand what's going on. Look right here, the 2-minute candle. Look at 2 minutes. You see that bull action right there? As I'm calling it out here on the actual money that's being transpired. Okay, the level 2, the price action, as it's actually happening, the price action, you can then see the candle form based on the price action. Amazing. Amazing. However, we're down to the last minute. The bulls are now defending that 653.3 area to the best of their ability. Whoa, big size just came through on the bid. Huge size just came through on the bid. But is it enough? They're holding the 15. They are holding the 15. Bears are trying to push the market down. The Bears line is the 653.3. They will not allow the Bulls to get over the 653.3, but the Bulls will not allow the Bears to get below the 653.15. 20 seconds left. Whoa. Looks like they just did. Whoa. Backing them up to the 653.3. Don't want that to happen. They don't want that to happen. So they just bounce back to the 653.15 to save it. Look over here at the 2-minute candle. They just tried to save it down to the last 10 seconds. How will this candle end? Big size on the bid. Big size on the bid. This is a very serious area. Very serious. Look how they tiptoeing and tap dancing on a 2-minute chart. Look how they tiptoeing and tap dancing on the 2-minute chart. When you understand the sentiments of the candles, you know. The party is underneath the 653 and not any place above it. Don't get yourself caught in a trap. Read what the live price action is showing you. Now the bulls are gaining some confidence. Now some of these earlier bears here are saying, you know what? Let me go ahead and begin to take some profit. And that's what's happening. Okay, it was a nice run from the 656 down to the 653. They couldn't break it. Now those bears are starting to take profit. That's why you're getting the bounce here. Because in order for bears to take profit, they have to cover. They have to buy their position back. Buying causes the market to go up. But that doesn't mean this is a reversal. This could simply be a dead cat bounce. Who knows? In order for the bulls to truly have the momentum, they have to get back above the 655. That is the only place where bullish momentum will truly come into effect. Other than that, this is just bears taking profit, trying to sucker in some bulls who actually think this is a reversal. To use them to crack that 653. Well, time will tell. Two areas now that's very important. The 655 and the 653. There's going to be some action on either one of those sides. All we have to do is wait and see. Thank you for tuning in to Some Real Change. This is Abdul Shabazz and the team here. The president is giving an April Fool's speech tonight. But that's the worst thing in the world he could do on April's Fool? What? And Cozy, oh man, what does the team think, man? Gosh almighty. 47, let's talk about money, man. 47 is gonna give a speech on April Fool's Day? What are you gonna say, the war is over? It's nice level 2 action. I hope you guys was able to follow me. You know, I love price action. Real live price action. did I learn that from?
Price action?
Yeah. I think I learned that from it was two guys, Insider Investors Underground or something. Yeah. Shout out to Investors Underground. I told you I spend money with everybody. But I learned how to read price action with Investors Underground and with Tim Grittani. Shout out Tim Grittani. They could trade without a chart. Literally, they could trade without a chart. Put up level 2. Tell you all you need to know. Who doing what? All these colors mean something. So, when you had to go through a lesson of determining what the market is doing just from this right here, you understand me? Again, we said the two areas are 655 and 653. So on the bid, the bulls would have to get this up to 655 in order for the bulls to have control. They would have to continue to bid the market up to 655. The bears, on the other hand, would have to keep trying to beat the market down to 653. The closer they get to 653, then now the bears have regained control, regained momentum of the day. The bulls understand that. So once you understand those 2 points, you can just simply look here to see who now is gaining the upper hand. And now you can see it is the bulls as we have gone to a 654.2. Remember, we said 655 is the area. So as we get closer to that, this is showing us that right now on the charts, the candlesticks are going up because the bulls now have control. Okay? It also showing us here that at that 654, the bears also understand that possible bull rush, and they said no, 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 and smack their hands. And now you're probably seeing the candle change colors right now. It just is what it is. Pull the chart up. And exactly. As I said, you're seeing the candle change colors right now. Simply from understanding level 2. It's a great thing. It's a great thing. It really does help when you're trying to get into key areas to see if it's time to go or not. And like Dan the Man always says, let the candle close. Can't go wrong when you're letting the candle close. You can clearly see us here on the 30-minute chart. The bottom middle market came right up to the top of that larger control selling algo and has come down to the 653 area. But there, the bulls found more support and have now bounced from that as the earlier bears started taking profits. But as I stated, just because the bears were now having a bounce did not necessarily mean that it was a reversal, but simply it was earlier bears taking profit, which gave us this bounce from the 653. But however, it could simply just be a dead cat bounce to trick these eager bulls into thinking that this was a reversal and then use them to break the market below the 653. watch out for that potential trap. Team, who also remembers that lesson that we had in volume? That if the current volume candle, okay, does not precede the previous candle, the market is not going to continue in that direction. Okay? And here we had exactly that happen, where we saw this continuation to the bear side. We also see that it stopped happening here at the 950 when the bulls stepped back in. So volume lets you know if the market will continue or not. You want to see the current candle being larger than the previous candle. And in both cases, it didn't happen. So in both cases, you had a nice little scalp call, scalp put. That's it. There was no follow through in volume with the current candle being larger than the previous candle. We're seeing the same thing even happening now. You are not seeing that 955 bullish candle. We're not seeing it larger than the 950. So we're not seeing that follow through of the bullish move right now currently. That's not saying that it won't happen to turn around, because I don't know what the market is going to do. But I'm just showing you how volume helps us read whether or not there's going to be consistency in that follow through move. And the volume could very well step right back in right now and take this market on up. But even if that does happen, you will then see the current volume candle. It'll be larger than the previous volume candle. Very important 10 o'clock candle is what we're also looking at as well. 10 o'clock run, new 30-minute candle, new 15-minute candle, new 5-minute candle, still at the top of the larger selling algo. Can you give me an energy drink, please?
Where? Fridge?
Say it again.
Swallow in here.
Yes. Current candle. The president said, what in the world? The current candle must have more volume than the one before. Yep, volume candle, that is. He said, paper trade. Abdul, are you looking at daily chart volume? No, I'm not looking at daily chart volume. I'm looking at the volume on the 5-minute candle here. Paper trade at 654.95. Or what? What are you taking there, Kosi? A put? I was taking note. What are you thinking, Kosi? There, a put? Yeah. The only thing, right, with this move in Kosi, and Kosi says he's thinking about taking a paper trade here at 654.95. But the only thing with that is that if you look here at the larger time frames, right? Let's start off with the 15-minute. Let's look at each sentiment of each candle, okay? You have a shooting star, and then you have a hangman. It's more doji, but it has more tail than it does wick. So it's a doji, but it's more favoring a hangman. It could also possibly, and I'm saying a hangman more so than a hammer, because hammers take place at the bottom of downtrends. Okay. Nonetheless, you have bears who are in control from the 655 down. You have bulls who are in control from the 653 up, right? So now what can happen here is that these bulls can potentially start gaining momentum if they start getting these bears to start cover. Here in this wick, we have bears right here at the 654.8 area, right? Right where the market is now. But in order for this to be a substantial move, you have to get a close above this area, because you can see that the market has been trading in various areas, but it doesn't matter where the market is trading. It only matters where the market is closing. And we've already seen that the last resistance point was at that 655. Hold on, it smells like something on fire. That last resistance point was at 655. So in order to be safe for a call, you have to wait and see if the market closes above this area and then take us on up above that 656, where I stated before is the only safe area for a call. As we pointed out, the two areas are the 655 area and the 653. Market breaking below the 653 or breaking above the 656. Excuse me on that call. Everything else is a trap. He said I was satisfying an itch. That's all. My real alert is 656. I was thinking no. He said a call. Okay, yeah. Okay, yeah. Again, with market referring to things like this right now, you now got to switch to the, in my suggestion, to the half and quarter hour marks. Meaning you have to look at a trade at 10:15. Then you have to look at a trade at 10:30. And this will allow those quarter and half time candles to close, to really then get a good analysis of what the market is doing, so we don't get faked out by action. But instead, we're taking the same thing that we do on the 5-minute, letting the candle close, and we're applying that same strategy to the larger time frame. This is how we don't get trapped. Same thing on the 30-minute chart. We see we have what is more favorable, a shooting star. Now we know a failed shooting star is a bullish move, because in this wick you have bears who have rejected higher prices from the 656 on down. If these bears have to cover, okay, if they have to cover, you can expect a measure move right on up to the 657.50. But that's where the battle is right now, is that there are bears all in this right now. Let me show it to you. From here to here. Okay. So in order for this to be a successful bullish move, these bears that are in this candle, that are in this wick, they have to get to a position where they start feeling pain and they start covering. When they start covering, you can expect a measured move that it take us. Oh my goodness, the measured move would be ridiculous. The measured move would take you to the 657.8. Okay? But that is what would have to happen. Okay? If that does not happen, you have to remember that in this wick that's in this candle is filled with bears. So to take a call in this area, you got to look at where's your money coming from and are they in pain right now? No, they're not, because all they have to do is double down, average down. However, a failed shooting star is a bullish sentiment, is a bullish move, because all of these bears would have to cover, and bear covering is buying. And again, that's not going to take place until we get above the 656 area, which is why I have an alarm at 655.9. And again, this is looking at the larger time frame. The larger time frame. So if we want to go even halfway between this, let's see where we are at 10:15. Okay? If we're above that 655, okay, at 10:15, let's talk about it. Let's look at it. But if we're not, let us be cautious. Refer to the larger time frames. That was just a quick lesson in the sentiment of the candles. Understanding candle sentiment, which is nothing more than the psychology of the candles. Because even though they use computer algorithmic trading, somebody has to program the computers. Now, when they start running off of AI, then we all in trouble. No patterns will work at all. Nothing will work. Dr. JB's in the building. Yes, sir. Dr. JB says, he's on a 652 call until tomorrow. Alrighty. Plenty enough time for something like that to work out. 652 is a great entry. I know you like to go deep in the money. So we are rooting for you, sir. If we get above that 656, we know you're in the money then. Playing the long game. But we do know, Dr. JB, you've got big balls. No way, I couldn't rest at night. Knowing what's going on in the world. You must know, it must be some peace talk. Tell me what you know. Share it with the rest of the team. That makes you comfortable taking a call overnight in the middle of this war. I want to know. I might have to get you on the phone, Dr. JB, so you can tell us all. What the heck? Could be some valuable information, especially, guys, because the bulls have control of the week. Yes, they do. We were just speaking about that earlier, and it's been a mighty long time since the bulls have had control of the week. But the bulls have absolute control of the week. For now. Again, let's pull up that weekly chart. Oh, beautiful weekly chart. Look at it, how beautiful it is. You can see that market and that beautiful control buying algo all the way till we hit that 697.8. Once we hit that 697.8, it's like we ran into a gate. We could not get it straight. And if you tried to buy in then, you was a little too late. And they really let you have it. Really let you have it. Started off with a double top. After that double top, we then went to a lower high. Showing it to you right here clearly in the Heikin-Ashi view. This is the market week by week, going all the way back to last May. This is a year that you're looking at right now. I repeat, this is a year that you're looking at right now. Market was in a beautiful control buying uptrend, hit the high of 697.8. Then we put in a double top. After the double top, we put in a lower high. Those of us who knew how to read charts saw what was on the writing on the wall, especially once the market got below 680. Straight on down. Now, coming into this week, going back to the regular candlesticks, so very important. As we had weeks upon weeks upon weeks upon weeks of red candles, one thing that we did not have was a red candle that started off red, go from red to green. What a very strong move going from red to green. Additionally, in doing so, this also created this beautiful tail right here on that red to green move, showing the bullish support from the 629 on up. And we've gone from 629 all the way to 654 in a matter of 2 days. Googity Bob. Very strong bullish strength. So I can absolutely see why Dr. JB is playing the long run. As we stated, if the market breaks out of this controlled selling algo, that will be a very nice ascension, as we will officially be in a controlled buying algo. Additionally, putting pressure on last week's bears to now start covering, looking to where their pleasure turns into pain. The bulls are definitely on the attack. The key area is the 656 and then the 658. Well, nothing left for us to do but watch and see what happens. Just want to break it down for you live as we look and see that this is the first green week that we've had in a mighty long time. However, that green week is still contained within a controlled selling algo. And right now, we're at the top of it. Don't know what's going to happen, but it's definitely going to be a conversation. And it's not going to be as easy as you may think. Well, so glad that we're here enjoying this. So glad that we've been able to watch the market gap up without us. And only give us a clear scalp call and a scalp put and nothing else. The market is giving us nothing else. Looking at the larger time frame, look at the sentiment of these candles. There's not a full body candle yet today. Not one full body candle. Shooting star, hammer, hangman if you want to call it, doji, another doji. What is going on? Not one full body candle. Same thing here on the larger time frame, the 30-minute. Not one full body candle. Market ended beautifully yesterday on this green shooting star. As we know, a failed shooting star is a bullish move. But the move happened without us. It happened pre-market. Look at it. The move happened pre-market. Yesterday's close at 650. And then after hours, the market went to 652. And then pre-market, the hours went to the market went to 655, all the way to the 657.5 pre-market. All of this beautiful action that took place without you and I. And now when the market opens, what do we get? Rubbish. Garbage. Tricks and traps. It's no wonder Dr. JB is playing the long game. See what tomorrow brings to avoid the traps of today. But I don't have those size balls. I have to look at what's going on right now and trade what's on the screen. And right now I see nothing. Now yesterday we called out that beautiful 3-candle reversal to the put side. You could have made plenty of money within that 30-minute candle. Again, we also said that the action would happen above the 643. And guess what happened? Once the market got above the 643, she took off. Just that simple. However, you had to wait. And you had to wait for the larger time frame. You had to wait for those moves on the larger time frame. It's just that simple. But here, we're stuck between a rock and a hard place. Nothing here but aggravation and frustration. Well, there's nothing else for me to say. I've said all I can say. I've done all I can do. I've even cleaned my glasses. Only time left to do it, just wait. 30-minute chart, bottom middle. 15-minute chart, bottom left. Let's go ahead and blow up the 5-minute. No need to erase pre-market because all the action happened pre-market that we can use to look to see if the market is truly serious about the move. So we actually need pre-market today. Let me show you what it looks like without pre-market. See that? What I just do? How you undo some? So I don't know what I just did. Undo something. But this is what it looks like without pre-market. You got the gap up from yesterday, and it really doesn't give you anything to go off of, because even as you look to the left, you have to go all the way back left, and there's nothing there, nothing. Until you get to last week sometime. So this is pretty much what you have to go off of. if you took away pre-market. So at least pre-market does give us the most recent resistance areas. So we do want to add pre-market for today. And there we have it. It is what it is. Look at the volume. Look at the volume. Yes, sir. Good deal. No harm, no foul. And he chose to use this time to express his thoughts, do some training without doing any harm to his bank account. You are the smart one. It makes no sense unless you have big money and big idea or some inside information. I'd love to know that. Did you guys see the story about the person who made, I forgot how much it was, in 20 minutes, right after 47 came out with the news Monday that he was postponing the attack? The market went up, and somebody made, a big chunk of money in like 20 minutes. Some great science, great insider information. Time I find out stuff, is the sale is always over with. They down to the last pieces of bread, everything. It's all just ridiculous. I sure would like some of that Nancy Pelosi information. She be knowing everything. Nancy Pelosi be knowing everything, man. I also want to show you guys my trading view chart. As you know, sometimes I just simply go by the colors, follow my crayons, buy above here, sell below here. It hasn't failed me yet. So right now it's also telling me to remain on the sideline as we are still in that larger controlled selling algo, as you can even clearly see here on my trading view chart. Then we get to the bottom, we bounce to the top. We come to the bottom, we bounce up. We come to the bottom, we get to the top. But all of this action is still taking place inside a controlled selling algo. Getting to the outside of it will be great momentum and liquidity and a possible healthy move for the USA. Abdul Shabazz. Gonna turn it over to Kramer and the rest of the team.
Nike shares getting hit hard today. Here's what we learned. So we got more visibility, but also learned it'll take more time to turn this ship. There are signs that it's still working from the numbers, notably North America and momentum in the wholesale business. New products in running and football have been hot sellers. Management also hinting that direct-to-consumer, which is their stores and their website, which has been under pressure, can return to growth quickly. It did grow, according to executives, in February in North America. But China is still a big problem. And EMEA, the other big region, it's going to follow the North American playbook and is just not there yet. The CEO, Elliott Hill, has been making a lot of changes in leadership, including in recent months. New leaders in China, in EMEA, and at Converse. I spoke to Nike about all this last night, and here's the story. In part, because they have that new leadership, there is new visibility now on the depth of the challenges and just how long it will take, which is why they introduced last night longer-term guidance for the first time in a while. The problem is it didn't include growth. And for investors to see long-term guidance, they wanted to see growth. Now Nike expects revenue to decline by low single digits in 2026. Nike's bigger and more complicated than the competition, the On-Runnings, the Hokas. The geographies are more complex, the categories are more, and so they're arguing it's harder to fix all these problems quickly. But investors are short on patience, we know, which is why they and more analysts today are pushing out forecasts of recovery to take longer. Let's bring in one of those analysts, Jefferies analyst Randy Koenig. He has a buy rating on Nike, $90 price target on the stock. Randy, you like the story.
Yep.
But do you agree it's just going to take longer now?
Look, I think you should be an equity research analyst. You encapsulated the summary pretty well of what's going on. But look, I think first and foremost, we can't forget the way that Elliott is attacking the problem, which is one geography at a time to fix, one product category at a time. And for the last 3 quarters, they've shown that progress. Running is up double digits, 20%. And as you pointed out, growing as well. So I think that's the first step of the puzzle. And remember, this is the most ubiquitous brand in the entire world. It's going to take time to fix, and Elliott's the right person to fix it, and he's making the right decisions to fix it. It will take time, but he is making the right strategies.
So what does the timeline now look to you? Now that they do have more visibility, they are giving more guidance. What are we looking at in terms of recovery times?
Look, I think we and the rest of the market had to take a more sober view of what we saw here, and we saw a business that we initially thought would turn in fiscal 27. Looks like it's going to turn in fiscal 28, which ends in May 2028, given the fiscal year. That is the reality of the situation here, and why? The reason why is the company needs to reset product in China. They've already started to see some green shoots there. It takes time. And then Europe took a step back, right? The European market is more promotional. That's a reality. It doesn't help with the Middle East war. It's going to take time to fix there as well. But I think, again, what I'm taking away from this is Nike did a good job of re-solidifying what Nike's great at, which is product and balanced distribution and being the #1 brand. And that's not going to change. And now you can buy that #1 brand at its lowest valuation level on a price to sales basis or market cap basis in 15, 12 years. It's very low, very attractive.
I know you think the price is going to double, so you're telling investors buy hand over fist on the market. So EMEA, I think they tell me they can use the North America playbook, which is working, and they can do that. It just takes some time. China's a whole different story, right? Mono brand, it's the Nike brand. It's much more digital. They have, and this crew, Matt Friend, Elliott Hill, they've turned China before a few years ago under Mark Parker. Remember when China was a problem? They turned the market. What does that look like? Because it feels like that is one of the key pieces for investors to get on board.
Well, look, I think you put up a good point. Is Mark Parker still the chairman? This company has gone through this before. And in fact, the last analyst day they had was in 2017. What did they do at that analyst day? They said, we need to refocus on performance, less Jordans, we got to balance our distribution, and more importantly, we need to innovate. And that's what they did. So this time around, as it pertains to China, they need to reset towards performance products. They did that in a couple stores last quarter. They said that in this current quarter, they rebalanced product in 100 stores, and it actually worked very well. given there's 5,000 points of distribution over there, it's going to take time to reset all the stores in China. So we think that China will improve within a couple quarters, and this is probably why they're having an analyst day in the fall, because remember, as we get to the fall, they're going to lap the tariffs in North America. That means gross margin is going to be up in the North American market. We're going to get Europe set and fixed within the next couple quarters because they did that in North America. And lastly, in China, they're already starting to, they took their pain on inventory write-downs. They're resetting with new product now, and that'll mean by the end of the calendar year of this year, they'll start to bottom out in the China market going forward. So I think that's why you have an analyst day later this year, get people more excited about calendar 27 for this stock and beyond.
So no doubt in your mind, we get long-term guidance in the fall.
Oh, of course. They actually said that on the call, that they're going to be more about giving annual kind of outlooks as opposed to one quarter views. And Sarah said poignantly that they started to kind of talk to this idea of we have a little bit more visibility, but the turn is going to take some more time. So while we're going to see gross margin improve and inflect 2 quarters from now, the revenue of the business is still going to be a little bit challenged. Not a lot. I mean, we're talking about down 2 to 3% revenue. It's not down 10, 20, 30%. But it will be down for the next couple of quarters as they reset the business, reset the products around the globe for the most ubiquitous brand in the entire world.
Yeah, and you know, the negativity comes with a move like this.
Oh, yeah.
Bloomberg has an article about how Elliott Hill talked to staff and vented frustration. He does that after every quarter, you know, and tries to give them a pep talk about where they are in the turnaround. Thank you, Randy. It's good to have you.
Thanks,
Randy
guys.
From Jefferies.
Thank you.
All right, let's get a CNBC News update. Pippa Stevens has that for us. Pippa.
Good morning, David. President Trump is at the Supreme Court this morning for oral arguments in a case that could end birthright citizenship in the U.S. It marks the first time a sitting president has attended a hearing at the nation's highest court. Every lower court has found Trump's executive order limiting birthright citizenship illegal. A decision by the Supreme Court is expected by early summer. NASA has begun fueling the rocket that will launch astronauts towards the moon for the first time in more than 50 years. 3 Americans and 1 Canadian will fly around the moon without stopping and head straight back to Earth in an expected 10-day mission. The launch window is set to open just before 6:30 Eastern Time tonight. And Tiger Woods says he'll seek treatment and focus on his health following a rollover car crash last Friday and his subsequent arrest for driving under the influence. Woods posted the news on X hours after an arrest affidavit was released, showing police found 2 hydrocodone pills on him. That's an opioid that can be used to treat severe chronic pain. Carl, back to you.
All right, Pippa, thanks very much. The president posting this morning on Truth Social that Iran has asked for a ceasefire, although state TV says Iran says that has not happened. Foreign Relations President Michael Froman is going to join us with his take in a moment. As we go to break, watch Hasbro today. Interesting 8K this morning. Under pressure, it discloses a cybersecurity incident involving unauthorized access to its network as we hang on to a gain on the Dow of about 200 points. Welcome back. The president is posting this morning on Truth Social that Iran's president has asked for a ceasefire, which the U.S. will consider, he says, when the Strait of Hormuz is open, free and clear, adding that until then, we're blasting Iran into oblivion. Iran state media has denied that ceasefire request. And of course, ahead of tonight's address about the war by the president, joining us this morning, Michael Froman, Council on Foreign Relations president and former U.S. trade rep during the Obama administration. Michael, welcome back. Good to have you.
Thanks for having me.
A lot of theories about what the president will say tonight. What do you think?
Well, look, I think there are military, there are diplomatic, and there are economic elements of the current conflict. It'll be interesting to see how the president addresses them. We had Rich Colby, the senior Pentagon official here at the Council on Foreign Relations. He laid out what the military objectives were, which were to very much degrade the missile capabilities of Iran, to sink their navy and make sure that they couldn't defend their nuclear program any further. Those have been largely achieved. Now, however, Iran has basically waged war against the global economy by closing the Strait of Hormuz, and we are now fighting to reestablish an opening of the Strait of Hormuz, which was, of course, open before this conflict began. So there are only two ways of opening the Strait of Hormuz. One is to negotiate with the Iranians, and when you look at the Venn diagram between what we're asking for, the 15 points of the president's demands and the 5 points of Iran's demands, there's almost no overlap between those demands, or militarily putting boots on the ground to open the Strait of Hormuz with all the uncertainty and the downside risk associated with that.
Right. Do you think the movement of assets, by the way, which is still moving towards the Middle East, is a suggestion that a ground offensive is in the cards?
Well, the George H.W. Bush carrier is on its way. There are paratroopers that are now there. There's special forces that are there. Certainly, the Pentagon is making sure that the president has all the options available to him should he decide to take military action against Kharg Island or at the straits themselves, or against the places where the enriched uranium may be being stored, to try and secure that. All of those are difficult operations and could involve, significant U.S. assets on the ground. We're unaware that the president's made any decision at this point as to whether he goes down that route. Maybe he'll be talking about that tonight, but at least he'll have all the options available to him.
What is your assessment about the success rate thus far? If the goal was to, get rid of the threat, nuclear weapons, missiles, as the administration has laid out, where are they at this point in doing that so that Iran can threaten the world and the West with, heavy weapons and terror, as it has been?
Well, I think when you look at the basic military objectives that were laid out at the start of this campaign, I think the administration's made significant progress on all of them. But I think what Iran has showed is that in this kind of asymmetric warfare, with a relatively small number of drones and missiles, they can continue to wreak havoc on the global economy by threatening shipping in the Strait of Hormuz and holding the rest of the world hostage. And they're counting on the fact that this pain will affect us more than them, and that they can continue to export their oil. In fact, they're getting higher prices for it now. Now the sanctions have been lifted on the oil that's on the seas, as is Russia, and so their view is all they have to do is survive. The U.S. has to win, and that's a very asymmetric kind of conflict.
Michael, how do you respond to, critics who would say at the end of the day they're going to end up with something that doesn't look that different from the JCPOA that he tore up, during his first term?
Yeah, no, look, I think it's a legitimate criticism. The question will be how much further can they go? Of course, the situation's changed quite dramatically since then. The proxies have been very much weakened by Israel and by U.S. actions. Although, as we've seen from the Houthis, they're not completely down and out, and they can continue to wreak havoc on the region. And their nuclear program is fundamentally different. It's buried under rubble. It'd be very difficult for them to reestablish it along the path that they were on before. Of course, there still is this 450 kilograms of enriched uranium that has not yet been secured, and that has got to be a top concern going forward.
Really quickly, Michael, do you think there's a risk that the U.S. could pull out of NATO? I wonder what the damage could be here of the Europeans rejecting assistance to the U.S. and President Trump, continuing to threaten, we will remember.
Yes. Now, he has threatened to do that. There is actually a law on the books that says the president can't do that without the consent of 2/3, I believe, of the Senate. But there are a lot of ways he can weaken NATO. It's simply by saying, nobody can force the United States. Nobody can force the president to deploy troops. Article 5 is only as credible as the U.S. leadership says it is. And so there's a lot he can do to weaken NATO if he's upset with the Europeans and others for not aiding in this effort. Obviously, everyone's hopeful that that's not what he does, because there's so many other issues at issue with NATO, including as a defensive alliance, dealing with the Russian threat, which is still very real, and we're seeing every day in Ukraine.
Yeah, the follow-on effects of that are use of their airspace, military bases in Europe, Greenland, would all be issues of discussion if that were to happen. Michael, we'll talk soon. Appreciate it as always. Thank you.
Thank you.
Coming up, the news slamming shares of Restoration Hardware right now. The stock cut in half over the last year. And later on, the CEO of crypto asset manager CoinShares joins us as the company goes public today via SPAC. We'll be right back.
Can you profit from rising oil prices without diving headfirst into the energy trade? We're going to hear from an expert who will tell you how to do just that. Tune into our Market Navigator segment later on today on Power Lunch for those trades, 2 p.m. Eastern Time.
Welcome back to Squawk on the Street. Here are three big movers we're watching right now. Restoration Hardware shares slumping after disappointing results and guidance, with executives there pointing to tariffs and adverse winter weather as big headwinds. AI memory chip makers catching a bid after big declines over the last week, and it's not just U.S. equities. Shares of Samsung and SK Hynix in Korea also popping double digits. And then a number of food companies on the move following results out of Lamb Weston, Cal-Maine, and Conagra. Kind of mixed picture there. Conagra did see some sales growth thanks to the refrigerated and frozen brands, offsetting some of the weakness, Carl, in the snacking portfolio.
Still ahead this morning, an inside look at the $30 trillion battle brewing over wealthy investors. That story when we're back in just a moment.
Trend Tracker is sponsored by CME Group. CME Group, where risk meets opportunity.
Welcome back. There is a $30 trillion battle brewing over who will manage the wealth of some of America's richest families. Robert Frank is here. He has the story for us. Robert.
Good morning, David. Great to see you. Well, as wealth grows more concentrated at the top, the business of managing those fortunes is booming. The invested fortunes of high net worth investors, so that's those worth at least $5 million or more in investable assets, is growing more than 9% a year. It's expected to top $30 trillion by 2030. That's according to new data from Cerulli Associates. Now, when it comes to market share, the dominant players right now are still the wirehouses. They manage over $7 trillion of those high net worth investments. Broker-dealers come in second with $4 trillion, followed by independent RIAs and private banks, each with about $3 trillion. But here's where it gets interesting. The growth right now is all going mainly to the independents. So RIA is growing 13% a year. That compares to wirehouse and banks, which are growing about 11% or 8%. Now, the reasons: more advisors with wealthy clients are leaving the big firms to start or join their own RIAs. And the IRAs at the same time are offering a much broader array of services to now compete with those big names. You've got trust and estate planning, taxes, bill pay, even private jet solutions, concierge medical, all to better compete with the big financial names. Now, for more on the battle to manage the fortunes of the wealthy and how it impacts clients, you can sign up for the Inside Wealth newsletter out tomorrow morning at cnbc.com/insidewealth. So the whole landscape right now of managing the money for the wealthy, which is as we point out, a $30 trillion pie, is growing, is really shifting as these RIAs start to pull some of the top advisors. And by the way, when an advisor leaves, 70% of their clients follow.
Right. Well, that's a key part of it, isn't it? When they sign on with one of these registered investment advisor firms, these sort of independent firms, they have to bring a certain amount to at least step into the compensation that they potentially are available.
That's right. And what's attracting them is not just the compensation, but also the equity. So being able to own a piece of that firm, whereas, you're working for Morgan Stanley, Goldman Sachs, B of A, you're getting paid well now, very well, but you just don't have that equity upside. And so that's what's driving a lot of this, is that the advisors are moving and the clients, not necessarily that the clients are choosing one model over the other, it's that they follow their advisors. And so that's why this is a growing business and very profitable one, but the margins are starting to come down a little bit because compensation costs are going up to keep the good talent.
Is this all U.S. wealth, or does this include international?
This is just the U.S.
Yeah.
Just the U.S.
Is it a much different story when you consider overseas?
Well, internationally, it's still very much dominated by the big banks, private banks, because you've got overseas, particularly, it's family businesses that do a lot of borrowing from the banks for their company, and then the company says, oh, well, we'll also sell you some hedge funds and private equity and all that stuff. So slightly different model, but eventually the RAs, even the ones that are consolidated in the U.S., are now starting to branch overseas.
I do wonder how much of AI is going to disrupt some of their
100%.
business.
Yeah. That will be one to
Everybody will
watch.
have their own agent doing everything.
Yes,
for them.
needs an
Including my
RIA,
private jet,
agent.
making my private jet bookings.
You're a stateful agent.
I need a stateful RIA
Do you?
robot.
Yes.
I guess.
Okay.
I don't know.
We'll get on that.
Robert, thanks.
Thank you, guys.
Right. Crypto, meantime, recovering a bit this week on this better equity bid. Still off the highs, of course. CEO of CoinShares will join us next as that company goes public via SPAC. As Money Movers begins in a minute. Good Wednesday morning. Welcome to Money Movers. I'm Carl Quintanilla with Sarah Eisen, live at Post 9 of the New York Stock Exchange. Stocks continue to rally here on this Iran war optimism. The president says Iran has asked for a ceasefire. We're joined by one former top U.S. Mideast diplomat who says none of the options on the table right now are very good.
Plus, activist investors putting M&A back in the spotlight with Q1 notching a record number of mega deals. We'll discuss which sectors remain ripe for shareholder activism and deals for the remainder of 2026.
Crypto investment firm CoinShares making its NASDAQ debut. We're joined by the CEO, talk about their growth strategy. Crypto stocks have seen a sector-wide decline over the past 6 months.
First up, though, in the markets, as Carl mentioned, there is optimism. And you see that in this rally, which is extended from yesterday, which was another broad rally. S&P 500 up another 1%. It's pretty broad. The only sectors lower right now are energy and consumer staples, which, of course, were the outperformers during the war, and the concerns there about higher oil prices and the economy. Industrials, so cyclical groups at the top of the market, up 2% today. Communication services, information technology. As we try to monitor whether this comeback can continue after a rough start to the year, Treasuries are also rallying, turned around a little bit with the 10-year yield down to 4.3 on the back of some better, I would say, economic data.
Yes. Let's begin with the latest in Iran today. The president, of course, is set to address the nation tonight. Our Eamon Javers is in D.C. Morning, Eamon.
Yeah, good morning to you, Carl. President Trump is at the Supreme Court right now. He's taking in the High Court's oral arguments over birthright citizenship, a right enshrined in law and the Constitution since the 1800s. But the Trump administration is hoping to overturn it. Oral arguments are today. Decision not coming for a couple of months. It's the first time a sitting president has ever listened to oral arguments at the Supreme Court. We'll watch that to see if he makes any comments about the war or anything else to reporters on the scene. Meanwhile, the president giving us a sense of his thinking this morning ahead of his address to the nation this evening, taking to social media to say Iran's new regime president, much less radicalized and far more intelligent than his predecessors, has just asked the United States of America for a ceasefire. We will consider when Hormuz Strait is open, free, and clear. Until then, we are blasting Iran into oblivion, or as they say, back to the Stone Ages. Now, the president also gave an interview to Reuters today saying the U.S. will be out of Iran pretty quickly, but could return for spot hits as needed in the future. And the president said he is absolutely considering an attempt to withdraw the United States from NATO. So a lot of questions around that. Setting up his 9 p.m. speech to the nation tonight, guys. Is this going to be about the end of the Iran war? Is it going to be about ground troops in Iran? You know, both possibilities are open at this point.
Yeah, I mean, there are questions, right, Eamon, about who he means when he means the new head of the regime, right? I mean, they still have the same president as they did before, but I'm not sure that's who the president's referring to.
Yeah, exactly, and we just don't know. I mean, the White House has declined to say whether or not, who exactly they're speaking to in Iran. The question is, was this a statement made in these private negotiations that the Pakistanis are mediating, or some public statement that was made? We just don't know. The White House has been, strategically quiet on who it is that they're talking to, who it is that they hope might take over leadership in Iran after the war. So we'll have to wait and see. Meanwhile, you're looking at the oil situation becoming increasingly dire around the world as entire continents are facing sort of the end to oil shipments from the pre-war era. And we now are starting to go into an era in which oil is going to be extremely constrained in economies around the world.
Yeah, which is why it's so key to hear what the president will say tonight, I guess, about the Strait of Hormuz and whether there will be efforts to open it or not. Eamon, thank you very much. Keep us posted. Eamon Javers in Washington. For more on the market as we kick off the second quarter, let's bring in Renaissance Macro Research Chairman and Head of Technical Research, Jeff DeGraff. Since you pay attention to the charts and the technicals, Jeff, just this two-day rally here on optimism that the end is coming sooner here for the war, does it have legs?
I think it's got another probably 1.5% to it. Keep in mind the breadth yesterday was okay. It was about 83% advancers. We like to see something closer to 90. Today it's about 72% advancers. So it's off a little bit. That said, we were right on the cusp of being oversold in our oscillators and some of our metrics. So it certainly has room to mean revert. But you've got the 200-day, which right now is roughly 66.40 on the S&P. You've got the 50-day up to 67.90-ish. I think the 200-day will be formidable without some type of improvement in breadth. But as far as I'm concerned, this is an oversold rally that was sparked by some news and some optimism, but there's more to do.
What do you think is the trigger point for the last few weeks? It really has been oil, right? Higher oil prices, stocks sell off. But as we've gotten more economic data and sort of more comments from the president around potential deal making, I mean, is it still the Iran headlines that are driving in the driver's seat right now?
I mean, that's part of it because you're seeing it in risk premium, you're seeing it in real rates. So real rates have really gone up, right? So real rates are kind of what's left with a 10-year note after inflation expectations. And we've seen those plummet. So even though the near-term inflation is up because of oil, the longer-term inflation expectations have really come down a lot. And that implies that there are tightening financial conditions, and that's what those real rates are suggesting. And I think that's the real risk, is that the Fed's focused on the very short term with what's happening to oil and the impact of that on near-term inflation, but the long-term inflation picture is deteriorating, or I should say actually getting a lot better, but that's at the expense of growth. And so this is all becoming part of that growth scare. And it's going to be a very fine balance to try to manage our way through that, particularly with a new chair coming in. It'll be, I think it's going to be a really challenging 3 to 6 months just to see how the Fed handles this.
Well, I'm fascinated today by your new playbook, Jeff. We're seeing the closest parallel to the 1970s in decades. Not a recession, you argue, not a soft landing, but what you're calling a prolonged slow burn where real returns erode. Can you explain what you're thinking about?
Yeah, well, it is because of that rock and a hard place, and so you end up with kind of this elevated, not the 2% in terms of inflation that the Fed's hoping for, but you end up with something that's a little bit more elevated, probably 3 to 3.5%. That pushes down the longer-term returns for equities, and it just becomes kind of a quagmire. The Fed can't really cut rates because of inflation, but they want to because of unemployment, and it just becomes a little bit more challenging. Now, that's the base case. That base case is about, in our view, about 35%. I mean, there are ways that we can get out of that. Maybe AI is the magic elixir here. But that's certainly what we're watching. And what we've seen so far, up through that is it's certainly more parallel to that than not. There will always be nuance. We're certainly appreciative of that. I would say the risk here right now is that we're kind of tilting our way more towards that decline in growth. Not the inflation part, but again, that will be the issue with near-term oil prices and what that path through is. And we saw it in PPI today, right, with the ISM. We saw PPIs jump without really any impact on growth. That's not a great place for the Fed to try to cut rates into that.
Prices paid. They rose 7.8 points.
Right. Yeah, prices paid. It keeps coming up. Capital Econ out a couple of moments ago saying on past form, that index would conform to CPI, I don't know, maybe go into the low 4s. Is that too aggressive?
I don't think so. I mean, that's not really my bailiwick, but when we look at what it does to equities, equity returns in this zone of growth and inflation are not great. And I think that's a really important overlay to how we need to be thinking about things. And keep that in mind with...
Unless it's temporary, unless it's, I hate the word transitory and the Fed won't use it again, but unless that's what we're looking at here.
It is, but I think to get those data points in the right direction is going to take probably several weeks, if not several months, and 2 or 3 months to get that going. And between here and there, the equity market's going to have to deal with that, and I think that's going to be the challenge.
Yeah, I guess the last thing I'd add, we got mortgage apps today, and mortgage rates have moved higher each of the last 4 weeks, and every week has been by a greater degree of magnitude. That's not reassuring.
Look, the charts in home builders have been bad. They continue to be bad. The charts of building products are bad. They continue to be bad. This has been a long train, if you will, and we don't see the caboose yet. So I think there's still more pain there.
Can I just also ask you quickly about the tech trade? Because, leadership from memory names, Micron's back on top after a wobble. Like, how does the AI trade look to you? And is it a mono trade right now, or do you have to be more selective?
I mean, there is kind of a one dimension that's played itself out, and we can see it in momentum. I mean, momentum, you have to go back for both high beta and high momentum, the performance of those two factors. You have to go all the way back to the 1999-2000 era to see something similar. So that obviously has us on edge. That said, the charts are still good. The momentum is still there. So we just want to be really, really careful that when that breaks, we're not going to whistle past the graveyard and we're going to take our ball and go home. But that said, I think one of the things that we're adamant about right here is that clients need to be buying relative strength highs. That's how you get yourself out of these things, because those are most likely the leaders in the next leg, whatever that looks like. And so,
who is that?
If it's making a relative strength high, it's probably buyable.
Who's the relative strength high stocks?
Well, you're seeing it in the not Micron. Micron's had too big of a correction, but some of the semiconductors like ADI, AMAT, CLAC, those names look good. You could buy oversold conditions in uptrends. That would be a Micron and a Google. Those look pretty interesting to us as well. But again, it's all within the context of understanding that momentum is stretched.
Got it. Jeff, thank you. Always make the
Thank you.
technicals interesting. Jeff DeGraff from Renaissance Macro.
Still to come this hour, former Assistant Secretary of State for Political Military Affairs, Puneet Talwar, why he says a deal on U.S. terms seems unlikely, given Iran's belief in its own strong position.
Plus, Barclays with a new report looking at what sectors could be most ripe for activism. Snap, the latest example, with tech the most targeted sector in Q1. The author behind the note joins us to name names when Money Movers returns.
Welcome back. The president takes to Truth Social this morning, saying Iran's president has asked for a ceasefire, which the U.S. will only consider once the Strait of Hormuz is reopened. It comes with the president set to address the nation later tonight with an update on the Iran war. Joining us with his thoughts this morning on what to expect from here, Puneet Talwar, former senior Iran advisor and assistant secretary of state for political military affairs under President Obama, former ambassador to Morocco under the Biden White House. It's good to have you back. Thanks for the help this morning.
Thanks for having me again, Carl.
On this request for a ceasefire, Iranian state TV says it's not true, but there are these lingering reports about maybe they'd be interested in a Russian mediator. Maybe the Pakistanis and Chinese could be a guarantor of sorts. How are you reading it right now?
Well, I think there's a lot of confusion. There are a lot of contradictory messages. And what's clear is that there doesn't seem to be a very consistent and reliable channel of communication here. From what we know of public reports, there is a lot of activity by intermediaries, and that's not ideal because messages can get garbled, things can get lost in translation, and that can mean the difference between a ceasefire or escalation. We've also seen suggestions that perhaps there are text messages being exchanged, which is somewhat better. What you really want in this kind of a situation, and what we had previously when I worked with President Obama, is direct face-to-face communication. And when you have something of this magnitude and this consequence going on, you really need that face-to-face conversation.
Are you a believer that the Gulf states as a group are interested in de-escalation or pushing the pedal to the metal?
I think there's a split within the Gulf states. I think the two largest Gulf states, Saudi Arabia and the United Arab Emirates, believe that this cannot happen again. They want this brought to a conclusive close. They do not want to see their economies disrupted the way that Iran has done it this time around. And so they would like to see things go forward to a decisive close, whether that means regime change or a regime that has no ability really to threaten them again. Other Gulf states, particularly Qatar and Oman, Oman, you will remember, has been the mediator up till now. They believe that actually there needs to be a different kind of a settlement. They are not as hard line in their position as Saudi Arabia and the United Arab Emirates.
So what is the resolution, do you think, especially with the Strait of Hormuz? Like, what does the exit look like here for the U.S.?
I think we're in a tough spot here. The options are not really very good for the president. I hope that he's going to provide some clarity this evening to the American people on his plan to bring this to a successful close. And I think the options really are down to three. He can try to escalate militarily and go after the two main objectives that are there right now, which is to reopen the Strait of Hormuz, and that'll only be a partial reopening, even with military force. Or he could try to also go after and seize the highly enriched uranium that Iran has. So that's option one. Option two is a diplomatic deal of the type we've described, but it's very difficult to imagine how that comes to a successful close because Iran believes that it's in a strong position because it has the world economy in a stranglehold. And the third is what the president suggested yesterday and the day before that, which is that we can basically declare victory, walk away, leave Iran in control of the Strait of Hormuz, and basically say to the world, over to you. And I think none of those are particularly appealing options right now.
Big piece in the FT this morning about the UK and Starmer pivoting toward the EU after what the FT calls Trump's taunts. I wonder, obviously a lot of these economies are in a worse position economically as a result of this than we are. Do you think that the fissures between the US and the Europeans will grow wider?
Unfortunately, I do. I think they've been growing wider over the past year, and I think the threat made in the last day by the president to withdraw from NATO would be particularly disastrous if he actually followed through with that. That actually just plays into Iran's hands. It makes it believe that it's winning. It also plays into the hands of our other adversaries, Russia and China. This is the most successful alliance in the history of the world. In a few days, we're going to celebrate its 77th anniversary. And I think actually following through with a withdrawal from NATO would damage our security.
But what also plays into Iran's hands and makes them think they're winning is the Europeans not helping the U.S. and Israel by letting them land planes and helping them open the Strait of Hormuz. What is the strategy here when it comes to Europe doing that? Why is it siding with Iran?
I don't know that it's siding with Iran. I'll tell you, when I was doing this previously in 2011, Iran made a threat to close the Strait of Hormuz. But at that time, we had a very strong international coalition that we had very deliberately built. And so when Iran made that threat, we were very quickly able to rally them and also to threaten the use of force, and Iran stood down. Over the past year, we've seen the alliance come under great strain with threats over Greenland, with the belittling of our NATO allies, and other things that we've done with the tariffs, for example, and that has not left a very good foundation. And I think what you're seeing now is a result of that, and the absence of consultation where they didn't feel that they were actually involved in the process at all. They actually, I think, view Iran very much as a threat. I think the problem is that it's very difficult to bring them in. They don't understand where we're going. And so I think that's really the fundamental problem.
Yeah, the rhetoric from MERS in particular has gotten more strident over the last few weeks. We'll see what we get tonight, Puneet. Hopefully get your help on the other side of that in the coming days. Thanks so much.
Thank you.
Puneet Talwar.
Still ahead, some new reporting on Nike, PVH, and what those retail results are telling us about the consumer. That's next.
We'll get to this big move in RH today. The CEO with some, as usual, dramatic remarks about the state of the housing market. That's coming up on the other side of this break.
Welcome back. Let's get to some earnings movers this morning. First, Nike is dropping hard off the lows, but down 14%. There are still some signs of a turnaround that's working there. North America business, momentum in wholesale, but China's still a big problem. And also EMEA, Europe, Middle East, not there yet. I spoke to Nike, and here's the story. They do have some new visibility on the depth of the challenges and how long it will take, which is why they introduced longer-term guidance for the first time in a while. The problem is it didn't include growth. Nike expects revenue to decline by low single digits in 2026. It's a bigger and more complicated story than some of their competitors, so it's harder to fix the problems quickly, and investors are losing patience here when it comes to the turnaround, even though there is evidence in places like running and football that the new products are working. And then their shares of PVH sharply higher today after the owner of Tommy Hilfiger and Calvin Klein beat earnings and revenue expectations. I did talk to the CEO, Stefan Larsson. He told me they've seen positive momentum in 2026 with spring selling up for both brands. They're taking up a step in marketing. He told me Calvin Klein specifically is getting a boost thanks to the new series Love Story, Carl, which he says 40 million people have now watched, the highest streamed TV show on Hulu ever. Of course, that follows the relationship between John F. Kennedy Jr. and Caroline Bessette, who worked at Calvin Klein. CEO said that the show drove an increase in search and e-commerce, and they're really leaning into and leveraging the brand's 90s focus. On tariffs, which has been a problem for the international brand, he said that they are mitigating it. Will do so by 75% by the end of the year. And while he says the macroeconomic environment is still uncertain and tough, he says when PVH leans into the DNA of the brands, they see consumers and wholesale partners respond really well. It's been a turnaround story and a process. I asked where he is. He said they're in a place where they built the foundation to start to turn the consumer flywheel. Very CEO speak there. And step by step, they will drive growth with increased pricing power and margin. I think that whole 90s story of both Calvin Klein and Tommy Hilfiger is something that Larsson has really tried to recapture in marketing, in product. Tommy just signed Travis Kelce to be a spokesperson. They've had a number of other sort of celebrities like Bad Bunny, which have helped turn as they've also turned the product. But the Love Story phenomenon, wow.
That's amazing. That is
amazing. And they did not participate in that.
No,
it was a nice surprise.
It's all zeitgeist.
Yeah, exactly. I mean, I asked him, I said, like, did you sponsor? I mean, because there's so much of that 90s cool Calvin Klein because she worked there.
She did work there, yes.
And he said no, but they are seeing a big impact across all product lines, even underwear.
I was just looking at PVH year to date. I mean, the gains on the year they're better than TJX. They're better than RL, which is essentially flat.
Well, look at where they're coming from, right? I mean, that was when he came in, a few years ago. That was a story that was tough, and they faced a lot of macro challenges, tariffs. They had specific China challenges when it comes to the Chinese government opening up competitive things for them. So there was COVID. There were all these challenges for brands that were kind of left behind, and there has been Larsson has. This is the guy who turned around Old Navy, H&M, and he has really leaned into what has made those brands special, which was they're strong brands. They were strong brands in the 90s, and young people. He said his biggest accomplishment, he told me, so far in this turnaround is bringing young people back into the brand with that nostalgia.
Right. And you saw the best component on retail sales today was department stores, up 3.
I know, department stores and apparel. Yeah. It was a surprise. I agree with you.
Meantime, earnings and new data paint a kind of a grim picture for the housing market. RH shares are under significant pressure today. Let's turn to Diana Olick for more on that. Morning, Diana.
Good morning, Carl. Let's start with RH, which missed analysts' estimates in a big way. That's the retail side, but it was CEO Gary Friedman's comments about the housing market on the analyst call that were particularly striking. He said, "We're compounding clutter from tariffs, global discord as a result of war, and the most dire housing market in decades." He also said we're now in the 4th year of the worst housing market in 40 to 50 years. That hasn't happened in my lifetime. So pretty clear where he's at on housing, and that brings us to the data, the weekly mortgage applications out this morning. The average rate on the 30-year fixed rose last week to the highest level since August, and that tanked total applications 10% for the week. Refis, of course, hardest hit, down 17% for the week, and they were just 33% higher than the same week a year ago. earlier this year, when rates were lower, refi demand was more than twice what it was a year ago. Now, applications for a mortgage to buy a home dropped 3% for the week, and they were just 1% higher than the same week 1 year ago. And maybe I buried the lead on this one, but that 1% is really significant because this spring was forecast to be much better than last year, with mortgage rates expected to be lower and the economy stronger. It is clearly not shaping up that way, as we are now at the very start of this all-important season for housing, and it looks like we're where we were a year ago. Guys, back to you.
We're wondering to see when the industry starts bringing numbers down for the year. We'll see, Diana. Thank you, Diana Olick. Meantime, close to session highs here. Let's get a news update with Pippa Stevens. Hey, Pippa.
Hey, Carl. Luigi Mangione is back in federal court today. Mangione is accused of killing the United Healthcare CEO in December 2024. His defense team is asking the judge to delay his federal trial until January of next year, paving the way for them to try to postpone his state trial as well. His lawyers argue that the competing trial schedules make it difficult to prepare his defense. Visa is launching new artificial intelligence tools to update its credit card charge dispute process. The company tells CNBC exclusively the tools are designed to reduce costs and customer frustrations related to disputed payments. In 2025, Visa processed more than 106 million charge disputes globally. That's up 35% from 2019. And Hasbro is investigating a cybersecurity incident after identifying unauthorized access to its network last week. The company says some systems are now offline and they are using temporary measures to keep taking orders. The toy maker says it is still assessing the full scope of the impact and is working to review impacted files. Sarah, back to you.
Okay, thank you, Pippa Stevens. Getting some news now on the IPO market. Mackenzie Segalis with that. Mackenzie.
Sarah, so Bloomberg's reporting that SpaceX has filed confidentially for an IPO, putting Elon Musk's rocket, satellite, and AI company on track for what could be the largest ever public listing. Now, according to that draft paperwork to the SEC, SpaceX is targeting June for a listing date. SpaceX could seek a valuation above $1.75 trillion and raise as much as $75 billion, which would easily top Saudi Aramco's $29 billion record debut. Now, to handle a deal of this size, SpaceX has lined up a heavyweight bank roster that includes Morgan Stanley, Goldman Sachs, JP Morgan, Bank of America, and Citigroup. Guys?
Okay, a lot of interest in that one, and with a good portion for retail investors as well. We'll try to get more on that. Thank you, Mackenzie. After this, Snap becoming the largest target of an activist, target of an activist investor, not the largest. But what sectors could be ripe for more activism in Q2? Barclays just out with a new note looking at that. They lay out the findings next.
CEO of crypto investment firm CoinShares is with us. The company makes its NASDAQ debut today after completing a SPAC merger. Stock down a few percent on a pretty good tape. Dow's up 400. Stay with us. Getting some breaking news on Lilly this morning. Let's turn to Angelica Peebles. Hey, Angelica.
Hey, Carl. Well, the FDA has approved Lilly's GLP-1 pill, orforglipron, and it will now be known as Foundeo. So this once-daily pill will start shipping from Lilly Direct on Monday, and Lilly says it'll be available at pharmacies and on telehealth platforms, quote, shortly after.
It's more accessible. It's easier to fit into your daily routine. We have great data on maintenance. A lot of people reach their goals on injectable and then, want to go to something less invasive than injecting themselves once a week. Some people don't mind that, but some people do. So here's an oral option. Or some people have been held back by that barrier, and now they can have an oral option. Or maybe some people couldn't afford it or didn't have insurance coverage. We hope to expand insurance coverage, and of course it will be more affordable even for those paying out of pocket.
And price will be a major factor here. So people with insurance coverage can get Foundeo for $25 a month. That's with a coupon from Lilly. And people paying cash or out of pocket can get it for $149 to $349 a month. And that's depending on a dose. Remember, that was thanks to the deal that Lilly struck with the Trump administration last year. And starting in July, seniors on Medicare can get the pill and other GLP-1s for $50 a month as part of that deal. And again, price is a huge factor here. And that's especially important because this pill isn't effective as Lilly's weekly shot Zepbound. People lose about half as much weight with this pill, and that's really the debate on Wall Street now, is how big of a drug can this become when people seem perfectly fine giving themselves a shot once a week. So we are all very interested to see how this shakes out, guys.
I still think a pill seems a lot easier than a shot. I mean, doesn't Novo have a pill that's been approved? Is there any early data on how that's working out?
They do have a pill that's approved, and that's been a very strong launch. And even Dave Rick says that they look to that as proof that there is demand for a pill. And one interesting distinction here that Lilly is making is that their pill is easier to take. So with Novo's, you have to take it first thing in the morning on an empty stomach with just a little bit of water. And so Lilly is really leaning into the convenience here, saying that you can take it with your other medicines, you can take it with, eat whatever you want to do. And so I think that'll be really interesting to see how that competition between these two longtime rivals plays out.
Yeah, just the next chapter of it, basically. Thank you, Angelica. Angelica Peebles. Take a look at shares of Snap, still higher today after activist investor Irenic Capital revealed yesterday it has built a stake and suggested several changes to boost the stock. Snap just the latest to become the target of an activist campaign in what was a slower first quarter for activism than a year ago. Our next guest out with a brand new report examining the activist environment so far this year and how the regulatory backdrop could impact campaign activity in 2026. Joining us here at Post 9 is Barclays Global Head of Shareholder Advisory, Jim Rossman. Welcome. Nice to have you.
Thanks for having me on the show.
So what is your thesis about what we'll see in terms of activism this year?
Primarily focusing on what is AI going to do to business plans. And we're about to see, I think, and we're in the middle of a generational change in corporate spending on technology and CapEx. And I think AI is going to be the big theme of 2026, and we're already seeing it. There have been at least 4 or 5 campaigns this year already that have an AI angle.
And what is the activist edge in that battle? Because it's not like they know more about AI than these companies.
The edge is you're too slow, right? You're way too slow.
It's the same kind of edge they've had in other issues.
You're going to need fewer employees, and you should be investing in the things that you think are going to work going forward with AI. And you should discard businesses that maybe you started investing in a few years ago that just aren't going to play into that factor. The other area, it's not only tech companies, it's also FIG companies. One of the interesting things about the first quarter this year is we saw more FIG campaigns than we usually see. Usually it's the 5th or 6th targeted sector, but this year we had 4 or 5 campaigns, and most of it was focused on what are you going to do with those big data sets, right? Are those going to be sort of disintermediated by new AI models coming from tech companies?
Do you think the mix of friendly to hostile will be lean one way or the other?
It's already an aggressive environment. And right. I know the data shows that global activity slowed down. But if you look at just the U.S., there were 41 campaigns. That's in line with last year. And if you look at what happened in the fourth quarter, there were 84 campaigns this winter, which is the highest level I've seen in probably 10 years.
Are they successful for shareholders?
I mean, it's hard to measure what success is. What they measure is, am I successful for my LPs?
And are they?
Generally, the top activists have produced returns year after year. In fact, if you look at my data, the top 10 activists account for 49% of the campaigns. And that's because dollars are flowing into them to pursue more campaigns.
Elliott.
I was going to say, who's got
Elliott, Starboard, Irenic is kind of the new kid on the block. Those are the leading activists.
Why has Elliott been so active?
And at what point are they spread too thin?
So the interesting thing about Elliott, and I've been telling folks, there's really Elliott and there's everybody else. I mean, Elliott now has 80 billion. The next closest activist has maybe 10, 15 billion. They've got 80 billion. They can run 18 campaigns like they did last year globally. They can put $1 to $2 to $3 billion at work in every campaign. And because they can make money in other pockets, they do a lot of direct investing in companies. They've got a private equity sleeve. They can be more patient than others. If you look back at their track record, 35 plus years, 8 to 10% a year, only 2 losing years, it seems to be working.
Have boards been conditioned to have an open mind when they're approached, or to instantly get defensive?
I think boards have pivoted over the last decade. And you can see that in the number of board seats that are awarded. It's been going up steadily. We already hit 45 this year. And also the accelerated pace of CEO departures, which I started tracking last year. 32 U.S. CEOs left their jobs within 12 months of an activist arriving. This year, we're already at 9.
Whoa.
So boards are acting, and I think it's a new form of kind of board capitalism. And if you look at Fortune Brands, the board pivoted after Ed Garden showed up. CEO was gone before he started the job.
Yeah, running.
That's a different board.
So technology, is that the most in the crosshairs?
I think technology is most in the crosshairs. I think healthcare is underappreciated right now. I think there's been so much policy uncertainty since the Trump administration came in. People don't know about reimbursements. They don't know which drugs are going to get approved. And I think there are a lot of undervalued healthcare companies. Third area is FIG, and fourth is industrials. Just
financials.
Yeah, sorry. And fourth is industrials, just sort of generally saying, you know, we're going through a whole new phase of, you know, re-industrialization of economies. The world, because of the geopolitical disruption, is more fragmented. Industrial companies need to focus on what are they doing at home? Infrastructure, right, for energy, materials, chemicals, defense. I think that's going to be a big part of the campaigns in the second half of the year.
But do you think thematically it will, the lead will be, you have too many people and your CapEx is not high enough?
100%. I think that the argument's going to be you're not spending your dollars on the right things. You need to focus on your expenses. You need to set profitability targets aggressively, and you need to shift your dollars to where the puck's going.
Well, you know we'll be all over it here at CNBC, as always. Jim, thank you very much for joining us with the new report from Barclays.
When we come back, CoinShares making its official debut on the Nas this morning. CEO of the digital asset manager will join us right after this. Dow's at 430. Welcome back. Digital asset investment firm CoinShares a bit lower this morning after marking its market debut via SPAC on the NASDAQ. Company oversees more than $7 billion in AUM, mostly in Europe, but is looking to expand its presence here in North America through the U.S. listing. Joining us this morning in a first on CNBC interview is CoinShares co-founder and CEO Jean-Marie Magnetti. Jean-Marie, great to have you. Thanks for the time this morning.
Thank you for having me, Carl. Nice to be here.
We kind of built this into the intro, but it does sound like it's an attempt, a move to build some AUM here in the U.S. after a pretty long existence in Europe.
Yeah, we've been a well-established company in Europe. We have been profitable every year. We've been growing every year. And, we probably, the simplest way to play digital asset growth via a company with a very easy to model business. And, Europe was a foundation for us, and we see U.S. as a growth story.
Do you think either from a regulatory standpoint or even a cultural standpoint, the sledding will be easier here than there?
Well, if we just look at the current market condition, we're in a bear market. But bear market are really for serious companies to get listed. The bull market are really for the hype. The current environment is a perfect pitch book or perfect pitch deck for CoinShare. And we are not listing because the market is easy. We are listing because the company is ready, and that's really the important point.
Waiting to hear from the booth if we lost our audio. Jean-Marie, are you there?
I'm here.
They're still we're working out some kinks there.
You'd think between us and the NASDAQ there'd be an easier time with the audio component. We'll try to get him back and talk in a moment. In the meantime, is Apple's crackdown on AI going to leave it on the wrong side of history? We'll get to that debate as well after a break. Welcome back. CoinShares chief is with us after some technical difficulties. Jean-Marie, appreciate you sticking with us as we work out the kinks, make sure Sarah and I can hear you. We were talking about the model, and it's largely fee-based revenue. I wonder if the volatility in the digital space has been manageable over the last, say, 6 months.
Yeah, the volatility has diminished, and when it comes to CoinShare model, we don't need digital asset in general to go up. We need people to own digital asset, and that's what makes our model valuable.
What do you think creates the atmosphere for a bid right now? We don't know. It's been a lot of discussion about whether it's an inflation hedge, a method of payment, simply risk-based.
Yeah, look, I'm not really in a position to comment specifically about Bitcoin or digital asset per se. I'm really focusing on creating value for our shareholder, and what we're making sure is like our business is ready to be able to welcome new shareholder at CoinShare.
The stock's down 20% here in the debut. I am curious why you decided to go public now when the crypto has been underperforming in this bear market and the stocks have gotten hit harder than some of the cryptocurrencies.
Yeah, first of all, we didn't have to list in the US, we really choose to, and we decided to do that because trust is not declared, it's something which is demonstrated. Bear market in general are for serious companies to get listed because it's harder. Bull market are much more for hype. In this market environment, this is a perfect pitch deck for CoinShare. We are not listing because the market is ready or because we're picking up a high spot, we're listing because the company is ready, and that's much more important.
Meantime, you've been around in Europe for, is it 12 years?
Since 2014, yeah.
And is the mix between institutional and retail, is it dramatic one way or the other?
It is comparable. It started in 2014 fully retail, and as the time evolves, it's becoming more and more institutional. Europe was really the foundation for us, and the US is our growth story.
Interesting. So yeah, a lot of the models working the other direction, but it's a curious story to have you here after having been in Europe for so long. We'll keep our eye on it. Appreciate you joining us as always. Congratulations, Jean-Marie Magnetti with CoinShares.
Want to hit Apple now, cracking down on AI coding apps, blocking them from updating in the App Store or taking them down entirely. Deirdre Bosa has more in today's Tech Check segment. So what is Apple doing here?
So, Sarah, first, let me just explain. These are AI or vibe coding apps like Replit. They're for ordinary people. You just type a prompt describing what you want. AI creates it. Zero coding experience needed. So it does in the AI era what Apple's founding idea was 50 years ago today, and that is democratize computing power. The iPhone put a computer in everyone's pocket. Vibe coding puts the ability to create software into anyone's hands. So you might think that Apple would actually be all over this, but instead it's standing in the way. Apple's crackdown here, they cite safety concerns. It says that these apps can make software that their reviewers never see, and that goes against policy. But here's the thing. The software opens up in a browser, so it's just like clicking a link in Facebook or X that brings you to an outside website. And if it really was about safety, Apple should have just banned all of these apps instead of putting them in limbo for months like they have. Think of it this way, guys. Imagine if Apple had banned WordPress from the App Store in 2010. WordPress let anyone build websites and build businesses from their iPhones. Apple didn't review each one of those. Vibe coding is that same on-ramp today, and Apple is blocking it when it should be rolling out the red carpet. App Store submissions, they are up 60% year over year, in part thanks to this trend. Apple can actually monetize that. But the builders, if these apps aren't updated, working the way they should, they don't actually need to go through the App Store at all. They can just build for the web instead. Open up a laptop, build it instead of doing it on their phones. That way, there would be no App Store, no Apple review, no 30% cut for Apple. And if the company keeps pushing them away, that is exactly what they will do. Now, Apple is already late to AI. This move risks making it irrelevant to the next generation of builders in AI, guys.
Given what you know about Apple, Dee, what do you think their motive is for approaching it this way?
It's a great question, and it's very curious because on one hand, if you have this new generation of app builders putting them on the App Store, that's good for Apple's ecosystem, right? You have more ability to monetize it, more control. What some might think, and I've been talking to a few people about this, Apple has its own tool called Xcode, but you need a Mac to be able to create with it. So it might just be sort of internal confusion. At least that's what it looks like from the outside, is no like real strategic policy towards this, but maybe more like internal confusion. On one hand, the coding side wants people to use Xcode, but that is not what Replit and some of these other apps are. So the App Store isn't able to actually, let these apps update or taking them down entirely.
What is Apple actually saying about it?
Apple says that this has to do with security, right? That everything that's created within these apps changes the app because there's new software. But that's exactly what Facebook and Twitter, and by the way, Claude, which is an app on the App Store that is on my phone right now, you can create an app with that, yet it's not banned or not able to update. So it's a really curious, strange fight that risks putting Apple really on the wrong side of history here when, they need to make some right moves in AI.
Yeah, classic Apple response, though, something revolving around security and privacy. We'll keep our eye on an interesting wrinkle. Thanks, team. Deirdre Bosa.
Stock market is holding up pretty well. This is the second day in a row. We're seeing a nice 1% at least gain here in the S&P 500. In fact, we're powering higher than that right now. NASDAQ, look at that, 1.7%. So real comeback. Clearly, there's some optimism about what the president might say tonight. Still a lot of focus on the Iran war headlines, the fact that he posted on social that they want a ceasefire. Treasuries are rallying as well. So we're going against what we've seen in the last few weeks as a result of the war. We also got some better economic data. Highlight, private sector jobs came in better, retail sales came in better, manufacturing came in a little better at the headline level, but that inflation component was hotter in there too.
Yeah, holding $6,600 index down again. I think this is following the worst two-day decline for the Dixie since the beginning of the year, more or less.
Reversal of the war trade, basically.
Obviously,
it was higher oil, higher dollar, higher treasury yields.
Yeah, big unwind. Let's get to post 9 and the half.
Carl, thank you. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour, this market bounce, which is, as you know, continuing today. Can you believe in it? That's the question. Or are stocks still vulnerable? We discuss and debate that key question with the investment committee. Joining me for the hour today, Joe Terranova, Liz Thomas, Jenny Harrington, and Stephen Weiss. I'll take you to the markets. 12 noon in the east, and we got another pretty good one going. Dow's good for almost 1%. S&P and the NASDAQ are now above that, and crude oil is lower. That's helping. Yields are down. That is helping. Liz, some are, asking the question, is this a short covering rally? Is it more durable? JP Morgan today says it's a bounce, but the technical setup still suggests vulnerability. So I'd say if we get back above the 200-day moving average, I think that would be a sentiment game changer. We're still like 38, 35-ish points away on the S&P from that. Do we need to get above that level again to make people into true believers?
Well, I think there's a few things that would need to happen. From a technical perspective, yes, because it did change sentiment when we dropped below it last Friday. So getting above the 200-day and staying there convincingly, I think would help from a technical perspective. We're in this weird range right now, again, on technicals, where we're looking at levels that used to be support that are now resistance, right? So we don't want the market to be making lower lows. We don't want there to be a new trend channel. So yes, that would help. However, the risks have not gone away as far as the war is concerned. And last week on Closing Bell, I said this, I stand by it. Unless the Strait of Hormuz is back open and this supply shock has dissipated, we're still in the same situation. I think we all want a ceasefire, but that doesn't necessarily solve the problem. So I think there continues to be this fear and even fragility that the market has not priced in the possibility that things do continue to get worse. Now, of course, we're going to hear comments out of the administration that things are perhaps getting better and that progress is being made. And I do think we can have these little counter-trend rallies, but there is still potential, if not high potential, for the market to continue going down.
What do we think, Joe?
So first of all, as it relates to the 200-day moving average, we've now had 8 consecutive closes below that level. When you look at trend following systems, generally, if you are 8 days below the 200-day moving average, the time to spend above it needs to be greater than those 8 days. Let's say you spend 100 days below the 200-day moving average. Then it's a shorter time frame, but you only had a short period of time and 8 days below it, so you need to exceed that for systematic trend followers to go back and establish longs.
Does that mean that you would answer the question, or you would agree that we're still in a fragile place? You think this is more durable now that we've had this follow through so far today?
I think a couple things happened. First of all, the news broke during the second half of our show yesterday.
Right.
Not really enough time for a lot of the rebalancing that was going to occur at the end of the quarter to really be affected in the marketplace. So I think today you're going to see an extension of what we saw yesterday afternoon, where a lot of shorts are going to cover. Look at the momentum funds once again today. The momentum funds are far exceeding the S&P equal weight and the S&P outright. That's indicative to shorts being unwound. If you look at a basket of Goldman Sachs, the 50 most shorted stocks, that was up 7% yesterday. So no, I think barring some news headline that's extremely bearish, I think just the simple technical dynamics of the market, this should extend over the next several days. This rebuild in momentum, this rebuild in short interest.
There's an assumption, Jenny, that tonight, the president's going to address the nation and sort of make it clear that the end is near, rather than getting a little more protracted boots on the ground or setting the table for anything like that. So for now, the market's comfortable in believing that. We'll see what happens at 9 o'clock tonight, obviously. But Ed Yardeni is pretty convinced that what we're seeing in the market, both yesterday and then again today, is legit, where he says if Trump's declaring mission accomplished, then so are we. Regarding our stock market correction call, we will probably lower our recession odds back from 35% to 20% once we have a better handle on whether the conflict is actually over. Of course, we reserve the right to change our mind as often as the president does, he says. Nevertheless, we're maintaining 7,700 on the S&P for year end and our commitment to his roaring 2020s base case. Time to move into the Yardeni camp and think post-conflict now?
Maybe, but I agree with Ed like 90% of the time, and I don't think I agree with him full throttle on this one. You know how they talk about the fog of war? I think that's where we are. And even if Trump goes out tonight and says, all right, it's over, we're still in a fog, and we don't know where things are going to land. So we don't know yet where supply chain disruption is really going to fall out. I think the next 2 weeks until earnings get kicked off, we could just be really reactionary. And I'm not sure that anything that happens in the next 2 weeks should be insightful or should be predictive. It's going to take until we hear those earnings calls that we start to figure out what's becoming clear, what's coming out of the fog of war. Things like helium, right? We don't really know what helium disruption is going to be. We don't really know how much is offline and how much is online and how that's going to affect chip production. We don't really know what's going on with LNG. We don't really know how much oil, even if Trump says, oh, it's all over, we don't really know how much damage has been done and how much oil can start flowing and where those prices can be. So I think we need to get to earnings before we can start to say anything definitive.
Okay, so on that note, Bank of America is talking about that today, and I thought had one of the notes of the day, honestly, to set up a good conversation, because you would assume, oh, sure, oil prices, Weiss, are going to remain elevated, and then, well, that's going to destroy input costs for companies, then margins are going to come in, multiples are going to come down, and so on and so forth. Bank of America has a little bit of a different perspective today, where they suggest that oil is more of a headwind for GDP than for earnings and stocks. They say higher oil is worse for U.S. GDP than for the S&P. Our economists bumped down their 2026 U.S. real GDP forecast from 2.8 to 2.3, but energy costs are a relatively small portion of total S&P operating costs. They maintain their $310 earnings forecast, which is 13% year-over-year growth. It's an interesting call, but I feel like it sets up a good debate over where we go from here, even in an environment where oil remains a little elevated for a little longer than people may be comfortable with.
Yeah, so let's just go over in answering that question what's happened. So what's happened is, and the reason why, and we'll get to this later, I started to put money into the market. As I said in my note to you and the producers on Monday, is that Trump's talking about regime change. And that clearly didn't happen, but that's his off-ramp. And once that happened, it was saying, I want to get out of this, and I want to get out of this as soon as possible.
And that's kind of the
Mission
message he's
accomplished.
trying to sell
Right.
over the prior
And he
days
sold
and
it,
even again this
right.
morning.
So what he sold it to is a market that was perhaps oversold, where there was short interest, and into month end, we're looking for marks. I'm surprised of the carry through today, but that's based upon what happens in the speech tonight, where he's going to reiterate, I'm tired of this. So now, when you go back to your question, oil, that's the great unknown, right? Because you're essentially ceding control, if you don't do anything, to Iran and the Strait of Hormuz. And that will increase if they get their way, and apparently, Trump is willing to let them get their way into a toll road, into restricting what goes through. So when you get to GDP, yes, it's a nominal input supposedly in the S&P, but that's the S&P broadly. For some companies, it's a tremendous cost. So you've had to pass on tariff increases. Now you've got to pass on oil surcharges that go into it. So I'm not so sure. So I do think it hits GDP, but I do also think you got to be careful as to which companies you're getting involved in.
But let's be honest. If investors thought that earnings were going to deteriorate meaningfully because of an increase in oil, the market wouldn't look like it does both yesterday and today, because that story is still intact.
So
as of today, the earnings story is intact.
So it is intact, and it's going to stay intact when companies report and give guidance.
Right.
Because CEOs tend to be optimistic, and they're going to hope, and they'll deal with it later if it doesn't happen, that oil prices are going to come down. And keep in mind, oil is much trading on the reality of the commodity as it is on what speculators believe. So you could very well see oil continue to come under pressure until something else changes. So again, that's why I put money in the market, not all the cash I had, but a decent amount.
Yeah. So just piling onto that too, this Bank of America note, to me, I read it and I thought it was a very first derivative argument, with the second derivative being exactly that, which is when does it start to hit the consumer? And that's where we're in this super ambiguous time period, which is if the Strait of Hormuz stays, closed for 3 months, even if we declare victory and oil prices stay high, that impacts the consumer so much more. So it's so important for us to see what the CEOs say when they're looking at the actual consumer and starting to say, like, all right, we're seeing a little bit of weakness. To your point, they're always overly positive. So it's going to be a lot of reading between the lines.
I would almost say that, in one instance, this maybe has an analog back to the tariffs.
Yep.
Of thinking in terms of what you just said. Well, at some point this is going to hit the consumer, isn't it? And it's going to have a negative impact. But you know what? The stock market and the great companies in this country have an amazing ability to deal with stuff. And they figured out a way to deal with tariffs to a point that stocks reached new highs, even in the face of tariffs, albeit not as large as they were on Liberation Day, and I think we all know that. Nonetheless, the market figured out a way to get beyond that, and so did companies. And they'll probably figure it out again, X certain specific idiosyncratic stories where input costs are a huger part of the bottom line. But otherwise, maybe we figured that out too.
So I have two thoughts on that. And the first is, what's the smartest thing you can do as an investor? You never bet against the U.S. and you never bet against the U.S. consumer in the long term. In the shorter term, I've been thinking about the same thing. And I think the difference here could be that Trump had more control to ratchet back the Liberation Day tariffs than he may have to ratchet back.
Oh, no, I don't even think it's a question. I think, of course.
Yeah.
But I'm making a bit of a nuanced argument that's a little different. This is nothing like tariffs in the sense that the president doesn't have the same kind of control that he did to say, oh, you know what? We're not going to do 100%. We're going to do whatever. This is obviously different. They don't control everything that happens in what is now a more chaotic part of the world. I'm only suggesting that if you're saying, well, sure, if oil prices remain this high for long, I mean, maybe the consumer's going to pull back. I'm just saying, like, the market has figured out how to get beyond that until it actually sees the impact.
And it's a battle of time periods. How long does it last, and when are people willing to put money to work? And I think that's what's so hard right now, is dealing with the short term and the long term. The long term, American consumer wins. America wins.
Let me ask you all this. Let's assume that we are days or a couple weeks, a few weeks, whatever, as the president has suggested, maybe 2 to 3 more weeks or whatever it is, away from this legitimately being a different story. And we've moved on in some respects. What does the post-war playbook look like? What is it supposed to look like? Do you sell your energy names that have led as a result? Do you go back to believing in the broadening story of all these other cyclical areas of the market that can once again take the lead? Or do you acknowledge that things are going to remain potentially challenged for a bit, so you go right back to the mega caps?
There's a lot there, but I like where you began it, which was, do you sell energy? And I think that's the thing that's in front of all of us right now, including the viewers. Keep in mind, there really has been nowhere that you could hide. There's been no particular asset where you could have safety during this period except oil and energy equities. What that means is that there has been significant usage of energy equities and oil itself as an institutional hedging mechanism. It's been the hedge. It hasn't been, let's go buy volatility. It's been, no, you own energy equities, you own oil.
The volatility has gotten more expensive.
Coming into this, there was fundamental reasoning to increase your exposure to energy. We talked about that coming into the year. On the other side of this, I think you maintain your exposure to energy. But if the purpose for energy in your portfolio has been that it is a hedge, I think this is a moment where you need to reduce your allocation to energy. On the other side of it, you maintain the position to energy, because I'll tell you what, I don't think energy is going to fall very quickly back to the 60s. I think there's going to be an overwhelming hesitancy, in particular for the hedge fund community to say, let's go short energy. Why would you do that when the potential for there to be one headline that could flare up at some point, whether it's 6 weeks or 2 months from now? I don't think whatever we're going to hear tonight signals the end of any type of friction and consternation in the Strait of Hormuz.
So, how would the rest of you answer that question?
Okay, so to be really precise on it, LyondellBasell was one of my holdings. It was up 80% on the year. What did I do? I cut it in half. Because there's no version of even the oil prices and the petrochemical prices that had moved up that justified an up 80% move in that one stock. So you take half off the table. But I only took half off because I'm not sure how long it lasts. What did I do with the proceeds? I repurposed them into stocks that had fallen because interest rates went up and petrochemical prices went up. So presuming it doesn't last forever, I think that's what you do. You just do like disciplined portfolio management.
We'll get to those later, by the way.
Yeah.
You're teeing up sort of yield proxies,
right,
that you did put money into. That I don't want you to do those now because I want to save that, but I hear where you're going.
Yeah, and remember last week I said I bought Clorox. Why did I buy Clorox? Because of the petrochemical fuel price spike punished Clorox. It was down, as we discussed, over 32%. So you kind of just manage your portfolio. Take the things that have worked off, add to things that are punished.
Liz.
Okay, so looking at the energy trade in particular, I absolutely agree with everything that Joe said. I think if you've been using this as a trade to play the war, then you probably have to start unwinding that position, because we will see big movement in oil prices if there is a convincing de-escalation. But I don't think it goes back down to pre-war levels. I think it probably hovers somewhere between 70, 80, maybe 70 and 90 for a while. And the industry has structurally changed because of this. There's been damage done to infrastructure that's going to take a while to repair, and it just takes a long time to ship energy from the Middle East to everywhere it needs to go.
Yeah.
So I do think there's still opportunity in energy stocks, and you can buy those. As far as the consumer and GDP and opportunities there, I would be careful in consumer discretionary, because increased energy prices has not created demand destruction at this point. It's not high enough, hasn't gone on long enough, but all of the optimism that we had about the consumer coming into the year, much of which was predicated on stimulus, that stimulus has now been eaten up by increased gas prices. Mm-hmm. So I think consumer discretionary is going to hit a little bit of pressure for the rest of the year.
As typically happens, in the hours leading up to a presidential address, either news or leaks of what the president may say start to trickle out, and maybe we have one here from Reuters, which is citing a White House official that the president tonight is expected to reiterate in the address the 2 to 3 week timetable for ending the operations in Iran. So if there was any sort of ambiguity of, well, is he going to do that, or is he going to potentially lay the groundwork for boots on the ground? It appears as though it's the former, as people have been trying to anticipate as the market has been up for a second day in a row here. So knowing this, this question to all of you becomes even more relevant and pertinent. The post-conflict playbook reads like what?
Well, first of all, I wouldn't pay much attention to those because they should be written in invisible ink because he could change his mind right up while he's giving the speech.
But let's just assume that this is this is the base case.
But that's an important point. That's an
of course,
important point.
but let's play the cards that we have in our hands.
Okay, so in terms of energy, I don't think this is dramatically different. Obviously, there are nuances, but every time it's different than other situations where we've seen a flare up in the Middle East. So lots of tourists come into the energy stocks, they bid them up. And so while the fundamentals may actually be improved, you're betting that those tourists have already left and aren't going to impact the trading. I'm making the other bet. I think that energy, if we see a cessation of the conflict, I'm betting energy does come down. It may go back up to answer the fundamentals, but the near term on energy, in my view, the risk reward is decidedly unbalanced in terms of going lower. Obviously, headline dependent on the Strait of Hormuz.
So, but then the third part of my question was, do you go to the mega caps, which have found themselves?
So I think you do.
Again,
Absolutely. I think the market is telling you today that it wants growth. The market is telling you it doesn't believe that the broadening out narrative, which we carried into 2026 from 2025, plays out here. Steve, to your point, okay, if oil prices fall, I don't think you believe they're falling back to 60.
No.
But if they fall and they remain above where the previous range was over the last several years, maybe there is a little bit of pressure on the consumer.
Well, yeah,
and in that environment,
the consumer they may be in a net neutral position because they're about to get a lot of tax refunds.
You know what? Not
that may
so far.
replenish
Since you just bring that up, I might as well just say it. I mean, so far, the indications are that refunds aren't as big as people were expecting them to be.
Yeah.
That's been in many, many notes that have come out from strategists.
But it still is cash in their pocket. So whether it's 9% better than last year or 5%, it still is a balance that's going to increase in their cash.
Well, you're still going to have...
It's a one-time cash in their pocket at the same time as their expenses on non-negotiable items like energy rose.
But
so
keep in mind, they're naturally optimistic, right? Which is why the market goes up 90% of the time. So they're going to assume that, like past oil shocks, this is going to abate.
Joe's answer makes perfect sense to me because, of course, if you're still going to have growth scare questions.
Yep.
As a result of oil being elevated, gas prices being elevated, and in that environment, would anybody be shocked if you have now a comeback in the mega cap names? On that note, many are in need of one. Microsoft, worst quarter since 2008. We read that to you yesterday. It was initiated by today at benchmark. 450 is the price target. CG Capital says they like the Mag 3 now, which is Alphabet, Meta, and Amazon. And Weiss playing right into this question. You bought more Meta.
I did. I just thought, I didn't understand why it traded down so much on the court decision, which just take a long time to play out. So I didn't buy more then because you can't catch a falling knife in this market, but it seemed to have reset. And I think got overdone, added on, to the decline that we saw on Monday, the reversal. So I just thought it was a good spot to add. It was already one of my largest core positions. This obviously made it supersize the position. And I'm comfortable with it because I think they will still be a winner. And I know all the debate about having to buy stock to offset your option, all that. I get that, the increased CapEx spending. But I want them to invest in the future because AI is where it is and where it's going to be. We're just at the beginning of it.
I'll tell you what, I mean, the other thing, we're still on memory watch, so to speak, right? Watching these memory names like Micron, which, that specific one has gotten hit pretty hard. It's down 10% in a month. Weiss, you bought this as a fresh buy?
Yeah.
There was time years ago you used to own this name.
I used to own it.
It was like a hedge fund hotel for a while, too.
Yeah.
Maybe less so now, but it was, like 5 years ago, like one of the preeminent hedge fund hotel names that you would see. It's obviously had, it was up 11% here. So it's a pretty good rebound, right? Why'd you buy it now?
Well, I thought it would bounce, so I thought the market was going to bounce, and I thought the ones that got beaten up the most, the Momo stocks, of which this was one until it got killed, they did have a great quarter. I'm as suspicious as ongoing supply-demand being intact for memory as anybody. And I come from a time where these stocks consistently traded at single-digit multiples because they're commodities. However, now you're eating up so much memory in the market, and they're basically done for this year in terms of their earnings, and it's selling at a discount to the market. I would never think that a slight discount to the market would be appropriate for this. It should be at a 50% discount to the market. But I like the momentum, so
I think it actually is. I think on 2026 and a half or 2027 earnings, I think it is trading at 10 times earnings. And
27, yeah.
Yeah, and the crazy thing about that is if you look at earnings expectations, it's like 50, 60%. So you could have almost the share price stay flat and it returned to its former 5 times earnings. It's pretty compelling, even to me.
Got some news on General Motors. Phil LeBeau has it for us. Hey, Phil.
Hey, Scott, take a look at shares of General Motors reporting its Q1 sales dropping 9.7%. Remember, that's compared to Q1 of last year. And in March of last year, ahead of the expectation that the Trump administration was going to announce huge increases in tariffs, which ultimately we had with Liberation Day, when they did announce tariffs going up on imported vehicles, there was a surge in sales in March of last year. So keep in mind, this comparison of a decline of 9.7% is compared to last year when it was just sort of a strange first quarter. One other thing, their inventory, 516,000 vehicles, a little over that. That is flat compared to Q4, so they're not building up inventory. And perhaps we're seeing EV sales perhaps finding the floor, Scott, because after the big drop-off in the fourth quarter, they were up 2.5% compared to the fourth quarter in Q1. Still way down compared to where they previously were, but maybe there's a floor being built there for EV sales.
Yeah, well, I would bet the last month of the quarter played a significant role in that, given the 5-week now war and the way that oil prices have reacted and gasoline, too. Phil, thanks for the update. That's Phil LeBeau with breaking news. Coming up, speaking of breaking, we have new developments now on what could be the biggest IPO ever. SpaceX reportedly filing now confidentially to go public. Mackenzie Sagalas is standing by with those details straight ahead. Welcome back. We're following developing news now on SpaceX and the IPO, the company reportedly filing confidentially for one a little bit earlier today. Mackenzie Sigalos has more for us. Hi, Matt.
Hey, Scott. So CNBC's David Faber confirming with sources that paperwork filed confidentially with the Securities and Exchange Commission shows SpaceX on track for a June IPO, setting up what could be the biggest listing in history and the first in a wave of blockbuster AI debuts this year. The company could reportedly seek a valuation of more than $1.75 trillion, but details, including the number of shares to be sold and the expected price range, would come later in a subsequent filing. Now, for the offering itself, Reuters says SpaceX has tapped Morgan Stanley, Goldman Sachs, JP Morgan, Bank of America, and Citigroup for senior roles, while building out a much larger bank syndicate around them, 21 in total, according to that report. The company is also said to be weighing an unusually large retail allocation that could reach as much as 30% of the deal, 3x the normal range. And that helps explain the intense focus on which platforms could get access to those shares, with Morgan Stanley's E-Trade seen as a leading contender for smaller investors. Elon Musk, though, pushing back on the idea that Robinhood and SoFi could be cut out entirely, posting on X that those reports were false. Scott?
All right, well, I guess to be seen. Mac, thank you. Mackenzie Sigalos with the latest on what is going to be a hot IPO. There's no question about that. All right, stock of the day today, Nike. How could it not be? I guess it could easily be RH. See those shares today? RH is getting destroyed, but we're going to go with Nike today, which is down as their outlook has disappointed. They expect a 20% sales decline in China. It's the second largest market, downgraded by Matt Boss of JP Morgan, who, look, has been on with me on Closing Bell and thought maybe that they had turned the corner, that's one interesting call. Part of this, though, Weiss, analysts have looked at the Nike report and said the read-through is positive for the stock that you just bought more of, DKS, Dick's Sporting Goods.
Yeah, so I bought more, excuse me, of this yesterday morning, and I was looking great for a while, but I'm staying there. It's now a good size holding for me. The read-through was great. U.S. has turned for Nike.
That's what they say. The North American business remains a bright spot, and that's why they glean good things for Dick's from this.
Exactly. And if you take a look at what's hurting Nike, it's increased competition. Guess what? Dick sells the competition.
Yeah, right.
So there's nothing here that's bad. You're coming into, again, the sports season, right? Outdoor weather. They've not been disintermediated by Amazon or Walmart or anybody else that'll continue. New store format is phenomenal. It's like an amusement park. So I think it's the best positioned retailer out there. Costco may be as well, but they're much more expensive.
All right. Let's go to Dominic Chu now with a CNBC News update. Hi there, Dom.
Good afternoon. Scott, Amazon's cloud computing operation in Bahrain was damaged on Wednesday after an Iranian strike. That's according to the Financial Times. It comes a day after Iran's Revolutionary Guard Corps threatened attacks on several U.S. tech companies. NVIDIA, Apple, Microsoft, and Google were flagged by the Guard as quote-unquote legitimate targets in retaliation for U.S. and Israeli strikes on Iran. The NFL has approved a succession plan for the sale of the Las Vegas Raiders from controlling owner Mark Davis to Silver Lake co-CEO Egon Durbin. The league approved Durbin buying a 3.5% stake of the team at an $11 billion valuation, and it gives the option of Durbin purchasing an additional 3.5% stake in the near future. Durbin and a partner purchased a 15% stake in the team back in 2024. And a Delta connection jet approaching New York's LaGuardia Airport mistakenly contacted the wrong air traffic control tower last month. The flight was on final approach when the crew radioed JFK's control tower instead of LaGuardia's. The flight performed a go-around and later landed safely after contacting the correct tower. So, Scott, some of these travel mishap stories still irking travelers. I'll send things back over to you.
Yeah, Dom, thank you for that. Dominic Chu. Coming up, calls of the day. One firm says the next $100 billion industrial is in sight. Joe owns it. We reveal it next. Let's do some calls of the day today. Quanta reiterated a buy at B of A. They call it the next $100 billion industrial is in sight. That's what they say. They say their targets are achievable. Joe owns the name. The power names haven't traded all that well this week. We've obviously been watching events in the Middle East, but how do you view this one now?
Oh, this is one of the better trades that we have established in the Joe T ETF. So for Steve's comical comments during the commercial break, you're up 240% since October of 2023. And this name was early identified as participating in the AI infrastructure build out. It's about electrification, it's about fuel diversification, and it's about an antiquated and aging utility grid, and they're contributing on all their metrics. Free cash flow continues to accelerate. The company has had double-digit revenue growth over the last 5 years, and looking forward, the valuation on this company, a forward valuation of 43, I consider that somewhat reasonable to some of the others that are participating in that logistical build-out as it relates to AI and data center demand.
Did Weiss make an out-of-character, snarky comment about Quanta or the ETF in which he is a investor in?
So as you said, can it go to 100 billion, and it is 82 billion right now? Steve said, well, did you own it initially at 200 billion?
No, I didn't say that. I said, is it 200 now?
Implying that I owned it at 200 billion. Great company.
Check the paperwork that you get from the Joe T
I'm a huge supporter.
Come on,
It served Joe T served me well.
All right, check the
If I don't get thrown
paperwork.
out of the fund, that is.
That's the committee's discussing that now. Disney upgraded to outperform at Ray J. We see the current macro backdrop and international visitation headwinds as an opportunity to invest at very attractive valuation. By the way, Kramer this morning said Disney's not an expensive stock anymore. Those were his exact words. It's like cheap. 15 times or something like that.
It's
I think that's what he said.
14 times earnings, 9 times EBITDA, 7% free cash flow yield. Earnings are expected to grow 12% next year, 10% the year after that, 11% the year after that. This is one where you almost don't even need to tell the story. You can just look at the numbers. But on the story side, it's pretty great too. So the stock, as we all know, has been under pressure for a long time because of cable. Linear and cable and sports, that's all down to 33% of operating revenues. And the balance, theme park, movies, streaming, like that should get a premium. That's 70% of the business at this point. When you have a franchise like this, it should not trade at 14 times earnings. This goes a little to our conversation about Micron, right? I don't know if it should trade at 10 times or 8 times, but I know it shouldn't trade at 5 times. This is all I know is it shouldn't be 14 times. Not sure if it should be 17 or 18, but it should be a lot higher.
All right, Costco reiterated outperform Bernstein, consistent growth for decades to come. That's what they say, Joe. Speaking of a stock that I think, some had thought was a little expensive, what about now?
Second half of 2025, it struggled. It's had a remarkable comeback here in the first quarter of 2026, along with Walmart, along with TJX. It's really about the consumer going out and looking for value, being very price conscious, and Costco and Walmart, with their scale, have the ability to serve that type of consumer.
Jenny's got enterprise products. Target today raised to $40 from 34. Hold, though, at Jefferies.
Right.
What do you think? They think it's a more fair valuation where it is now.
Right. I mean, it was a little bit of a belated price target upgrade, but it's trading at 37.5. This is the kind of company that you can hold pretty much forever. It's a old school midstream pipeline, tens of thousands of miles that transport oil and gas here, there, and everywhere. And this goes a little bit back to our conversation about energy. I'm happy to sell a Lyondell where there's huge fossil fuel exposure. It's an energy company. There's relatively little fossil fuel exposure. I've owned this since 2001, and you know what my annualized return is? 9%. And I'll bet you that over the next 10 years, my annualized return is going to be about 9%, a lot coming from the dividend. So it's a great one to own for the long run.
All right, we're going to take a break. We'll come back. We'll tell you about a sector that just had its best day in almost a year. We know the market was up big yesterday, so many sectors did well, but this one in particular. And there's more news today. Find out how the committee's playing it next. right, welcome back. Shares of Eli Lilly are higher today after receiving FDA approval for its GLP-1 pill. Stock up 4.25%. Joe T, this is part of yours. This company's been buying companies lately. It's one of the reasons why healthcare may be turning around. Some say biotech ETF just had its best day in almost a year.
Yeah, and it's biotech that really is the derivative trade off of what we heard from Eli Lilly. And over the last 2 days, the two deals that were announced, totaling well over $13 billion. So when deal activity is coming back into an industry, that's a display of extreme confidence. I mentioned before, I think the market's searching for growth. Biotech is an industry that delivers that growth for you. So right now, universally, the ETF holds Merck, it owns Gilead, it owns Amgen, it owns Regeneron. Those are all large cap with a touch into that biotech industry itself. And then personally, I have the XBI. I've maintained that position since the end of the summer. I did sell a little at around 124. Interestingly enough, someone said to me this morning, "Oh, you sold some." I said, "Okay, yes, I sold some." And when you sell some of an existing position, you hope that that's a bad sale, because that means the rest of your position moves higher. You don't want to look like a hero and say, "I sold 20% of the position, it was a great sale." Well, you stuck with the other 80%. I'm glad I maintained the rest of the positioning. This looks to me like it's breaking out to levels we have not seen since 2021 for the XBI.
Jenny, you have a fair amount of healthcare medical device names in your book.
We've got everything from Pfizer, Bristol Myers, Glaxo in the international portfolio, Regeneron, Thermo. And what I like about these here and now is that when we're talking about this environment with so much uncertainty, these are stocks that are trading at pretty big discounts comprehensively to the broader market, huge free cash flow yields. Many of them have huge dividends, but you know that their products aren't being replaced by AI. And even if the consumer weakens, even if we have like higher oil prices for a long time, everything they make is still going to be needed. So I like it as a stable, cash flow oriented part of the portfolio.
What about healthcare?
So I've been bullish on healthcare for a long time, unrewardingly, but I'm going to stick with it. And the growth story, I think, is intact. You can find growth in pharma and biotech. That remains a story. Other fun fact, if you look at oil price shock regimes, a year out from the beginning of that shock, outside of the usual suspects like petroleum and coal, healthcare is actually one of the better performing industry groups. So I'm sticking with it.
All right, coming up, I'll tell you about those moves that Jenny has. Remember, we teased those a little bit earlier. We'll go through those. Santoli, though, he's next. Welcome back. Senior markets commentator and overtime co-anchor Michael Santoli joins us now with his midday word. Do you take today's follow-through as confirmation of anything or not yet?
I would say it's constructive for sure. I think it's also somewhat rational as a kind of incremental repricing of the possibility of maybe more de-escalation than we thought we were going to get at the end of last week. The fact that oil is actually showing a little bit of downside gives some credence to it, I think. We're not seeing this kind of buying stampede. There's not a lot of urgency. It's not the kind of action that you see coming off of a major low where it seems like we're getting escape velocity. So we don't always have to get that. We didn't really get as washed out as we often do before you get one of those episodes. And the S&P 500 has right now been hesitating for a couple of hours right below one of those levels where it would be logical for the first rally, to kind of fail or fade a little bit. So I think you have to be watchful about it. Crude WTI still well above 90 means it hasn't broken down. So I think that's why, we're doing kind of baby steps around the edges. Let's be open-minded. Let's be balanced as opposed to leaning too far in one direction. Some of the positives, though, obviously banks more than fully participating this week, the 2 days of trading that we've had, 3 days. And then, I think the megas have taken a little bit of the reins and have started to actually perform here. So we do have a narrower advance, but it's still broadly positive.
We still need some degree, I guess, a confirmation of some kind that this is actually ending soon, a coherent, understandable idea that this is really going to end, the strait's going to open, the burner's going to come off of crude, so to speak, and we can sort of exhale at least a little bit.
You need a line of sight to those things, if nothing else. And I don't know if we're getting that tonight. Obviously, the higher the market goes, the higher the stakes are for actually getting new, fresh, and believable good news as opposed to just the prospect of it. And, I think that's the game that we're in right now.
Okay, Michael, I'll see you this afternoon. Thank you. That's Mike Santoli. Coming up, more committee moves. Told you Jenny now doubling down in one area of the market she has loved. She'll tell you what it is next. We're back. Told you Jenny was buying some more names, at least adding to. And it's all in the REIT space. Why?
Why? So what happened to REITs in the last few weeks? As the war broke out, interest rates went up, REITs collectively traded down, not necessarily because of anything any of these companies did wrong. So I bumped up my positions where clients were underweight or didn't own them already in Millrose Properties, Ryman Hospitality Properties, and Vici Properties. So you've got Millrose, that's a land bank for Lennar. You've got Ryman, which is huge non-gaming conference centers where many of their conferences are booked out up to 5 years in advance. And then you've got Vici Properties, which is a triple net lease REIT, where they have huge tenants like MGM who are not going to say, hey, Vegas is having a tough time for these few weeks and interest rates are up a little bit, let's cancel our 30-year lease on the MGM Grand. They're just not doing that. So they have huge, stable cash flows. All of these companies trade at 10 times or less FFO. They have yields in the case of Millrose of 11 times, Ryman 5 times, Vici 6.5 times. I'm sorry, yield percents. 11%, 5%, 6% yields. So they're really low valuations, really high dividend yields, really stable companies. You don't need to worry about AI pressure. You don't need to worry about oil pressure. And it just traded off. So I thought, okay, I've got Lyondell up 80%. That seems stretched. I've got these down a ton. I don't know that interest rates are really going to sustain at about 4.5% on the 10-year.
Do you think they peaked? Is this part of it?
I think so. You know, even when I say I worry about what comes next and I worry about the supply chains, I think probably we've seen the worst on oil prices. There could be an end on interest rates. I think, you know, there could be panic moments, but probably we're past the worst.
All right, all three getting a little bit of a move here as you talk about them. We'll do finals after this break. All right, I hope you'll join me 3 o'clock Eastern today on The Closing Bell with Cheryl Young, Lori Calvasina, Stephanie Aliaga, Dan Ives, Warren Pies, and Lo Tony on that SpaceX IPO. We'll do that 3 o'clock Eastern. Obviously, this market's going to get interesting today. It always has in that last stretch. We'll take you through it. Weiss, final trade.
FTAI, it's meaningfully off its highs, and if you believe the momentum continues, this will be a prime beneficiary.
Okay, Jenny.
Okay, Ethan Allen, 7% dividend yield, 12 times earnings, no debt. To some degree, Restoration Hardware's pain is their gain.
All right, stock's down just a smidge today. Liz Thomas.
QQQ, there's been a lot of multiple compression since October highs, but earnings continue to go up. I think that dislocation closes by prices going up.
Multiple going back up a little bit over the last couple days.
That's true.
But you are correct. There has been a considerable amount of multiple compression there. Joe T, the camera's on you.
A lot of CapEx going on in the semiconductor industry, semiconductor equipment names benefiting from that. I gave you Teradyne yesterday. I'll give you that again today.
Again today? How original.
Not original.
See you at 3.
All right, see you at 3 for sure, Scott. Welcome to The Exchange. I'm Dominic Shewan for Kelly Evans today. Stocks are extending their gains at this hour as optimism around an end to the Iran war is growing. Tech and small cap stocks are leading the gains so far. The NASDAQ, the tech heavier one, is getting closer to 2% higher, and the Russell 2000 small cap is up about 1.5%. Within that technology trade, another up day for the Mag 7, with Google as the standout in that group. Semiconductors also higher, and so are pockets of the memory trade, with SanDisk and Seagate seeing some bigger gains today. Yields are on the move, with the 10-year benchmark note yield dropping below 4.3% and hitting a new 2-week low earlier today, now just slightly back above that level, as you can see there. And oil prices lower, with U.S. benchmark West Texas Intermediate dropping back to $100 per barrel. Brent is down to $101 per barrel. That brings us to the latest on Iran and the president. Addressing the nation later on tonight, Eamon Javers is live in Washington, D.C. with what exactly we can expect from President Trump in this prime time address. Eamon.
Hey there, Dom. President Trump is back at the White House now after spending part of his morning this morning listening to oral arguments at the Supreme Court. And we're watching for any indication of what he might say now in his address to the nation tonight. His repeated threats, to remove the United States from NATO have certainly gotten widespread attention in Europe. The president of Finland, Alexander Stubb, posted a short time ago on social media, spoke with @Real Donald Trump. Constructive discussion and exchange of ideas on NATO, Ukraine, and Iran. Problems are there to be solved pragmatically, he says. The president, for his part, also posted on social media today saying that the government of Iran asked the United States of America for a ceasefire. He said the U.S. will only consider that after the Strait of Hormuz has been reopened. But the Associated Press is reporting that a spokesman for Iran's foreign ministry called Trump's remarks on Tehran allegedly asking for a ceasefire, quote, false and baseless. And so that's where we stand ahead of the speech tonight. A very wide range of options for what the president might say, but it's clear that he's spent at least some of the day today talking about the future of NATO and contemplating end of war scenarios for Iran.
All right, Eamon Javers, thank you very much for that preview of what we can expect tonight. Stocks are moving higher as oil is back down to $100 a barrel. And while that's still high, our next guest points out that we are in a much better place right now on inflation, on earnings, and the broader economy overall than this last time oil was at this level. So that was 4 years ago, by the way, following Russia's invasion of Ukraine. Joining me now for that story is Carol Schleif over at BMO Capital Markets, Chief Market Strategist over at BMO Private Wealth. Carol, this is an interesting situation with markets because with today's gains, we're just a handful, a few percentage points away from reclaiming record highs in the S&P 500 and the other major indices. Is this at all a surprise to you?
It's not necessarily a surprise, and it's really important for investors to remember, too, that there's been a lot of repositioning, a lot of resets underneath the surface. You saw, even while the averages are flat, you've got the broader markets flat. You've seen significant transition from the leadership that had brought us to the dance, if you will, and those that are continuing on. It's indicative of, as you alluded to, the strength in the underlying economy. We entered this yet another shock of, that we've had sort of repeated one-time shocks in the last 4, 5, 6 years, and the economy just keeps getting back up and coming back in even stronger. But you've definitely seen the broadening. You've got small caps, you've got mid caps, you've got the S&P equal weight outperforming those old technology names. So you've seen significant significant repositioning under the surface that is belied by the averages being so close to all-time highs.
Carol, I mean, speaking of dancing with who you brought, you can maybe look at it as two different dances that we've seen over the course of the last few years. One dance where the people that we brought with us were the Mag 7 stocks and tech, media, and telecom names, and this latest dance, if you will, for the last couple of years in that broadening out trade, value cyclical sector, small caps and whatnot. So if we're going to dance with who we brought for this next dance, who should we take?
I think pieces of both, because we still think you'll see that technology. You have two big things going on. You've got a shift in lots of geopolitical issues, lots of policy issues that have been brought in the last year and a half in particular and set us in a new direction and teed us up for some different infrastructure build and lots of things going on in the economy. We've also got this really strong technological innovative cycle that we've unleashed. AI is the poster child for it, but we've also got robotics, we've got cyber, we've got all kinds of things that are continuing broadening out, and that will have quantum at some point. We've got lots of different things going on that are supportive of a whole bunch of our economy doing quite well.
Is it a problem for this market to have $100 per barrel oil, both on international and U.S. benchmarks? And will it be a problem going forward, or is this something that markets can adjust to and companies can adjust to for their cost structures going forward?
It's definitely a change from where we were. We had some pretty record low, not record low necessarily, but inflation adjusted low energy prices going at the end of last year. But it's important to remember we're a significant energy producer, not just us, but North America in general. We're less tied to the way we were, and even the economy, the way it's structured, is less energy intensive, if you will, with multiple sources of that energy. So it's problematic for inflation. It could, in the short run, trip markets up when headline inflation prints higher. It'll print up conversation around what will the Fed do. But I think underneath it all, this economy is one that will continue to power through. And I just heard our BMO economists talking earlier this morning that if you inflation adjust even $80 or $90 a barrel, even $100 a barrel oil, we on an inflation adjusted basis had that for close to 10 years in the from the early 2010s on, in terms of where energy prices were, and the economy remade itself just fine and continued to power through.
All right, so you've powered through oil. Now talk to me about powering through the credit cycle right now. How worried should we be about private credit and what's happening in certain parts of that market?
We think the headlines have definitely accelerated, if you will, but a lot of times those headlines are conflating issues going on. Is it a problem with the underlying credit, or is it a problem with the delivery vehicle and the understanding of more recent buyers of that delivery vehicle? And we don't think it's widespread problems with the underlying credit. And indeed, when you look more broadly at credit in particular, yes, you're going to have defaults here and there. That's a normal part of doing business, but it's not a substantial part of the industry. And you've got key industry players out there raising funds and increasing credit lines so they can swoop in, if you will, and start buying up some of those distressed sales that other managers or weaker hands might need to let loose of, not of the underlying credit, but to meet redemption requests and some other things. So we're not that concerned about private credit, and we think a supportive economy will support the lending market as well.
A number of folks out there on our air have talked about being opportunistic in certain parts of those private credit markets with the sell-off there. Carol Schleif at BMO Private Wealth, thank you very much. We'll see you soon.
Thank you.
All right, so thank you. Our next guest went all in on energy at the end of last year, you may recall, but less than 4 months later, he now says it's time to sell. So let's bring in Carter Braxton Worth, the founder and CEO of Worth Charting, a technician, looks at the charts, looks objectively at the price action. Carter, this is a victory lap for you because you were bullish on it and it came to fruition on energy. Why now are you making this call to lighten up and sell?
Yeah, I mean, I think, look, not all breakout moments, potential for a real re-rating to the upside happen, but when they do, I think it's right to harvest. And so that is the thinking here. It's an epic move. The S&P 500 energy sector, of course, is up 14 weeks in a row. It's never happened. Up some 40% in a matter of 3 months, and at this point we think it's discounting all that's knowable about the prospective upside. Now the first comment, what about $250 a barrel? Okay, but let's look at the charts. We are now 32% above the 150-day moving average, and that is the highest reading ever recorded. And so it doesn't mean one has to be, hysterical. It's just acknowledging that the breakout, the potential for a real re-rating has come. And at this point, we think it's right to harvest, as simple as that.
All right, that's the energy sector. If you take a look at that vis-a-vis what's happening with the price action in crude oil, I understand that there are a lot of extraneous factors that are weighing on this, geopolitical concerns and everything else, but the price action is the price action. What exactly do you think happens with, let's just say, WTI crude prices? We've been kind of coalescing around $100 a barrel for a while now. What exactly could we see in the coming weeks?
Yeah, so we're thinking lower, but let's discuss it. The first thing to note, of course, is that the broader the market, the more wisdom there is in price. The NYMEX contract for WTI crude is very thin. Only a few players are in there. I would say that's ridiculous, but it's true. If you look at the mass retail and a lot of big portfolio managers, they express their view on the energy market through energy shares. And as a testament to that, think about January. We know it was that Sunday night, March 2nd, on Monday, we gapped up when the attack began, yes? Okay, but in the month of January, oil was up 3%, hadn't moved. But XLE was up 10 and OIH was up 14. The shares market was anticipating this event, interestingly. And now we are as overbought as we were in COVID. You can see that price oscillator there. That plunge is COVID 2020 low. This is the equal and opposite. Those are huge news events. It gets abandoned. No cars, no planes, no trains moving. COVID, and now it's adored. Big news each time. COVID's big news, attack on Iran is big news. But it's, we think it's finished, and we would reduce exposure.
I mean, negative prices happened during COVID for a barrel of crude oil for the future side of things. This is, again, if you're characterizing it as corresponding with that particular move in COVID, there could be a meaningful correction to the downside for some of these energy stocks and the oil. So if you were to place a bet on one of those, the commodity or the levered companies to it, where do you think the biggest opportunity would be?
Well, you get much more leverage, of course, in the futures account if you're going to actually short WTI crude on the NYMEX. But if you're more pedestrian, and I say that in the best way, not a negative way, I think you can just do it through shorting XLE. There's other ETFs that capture the XOP. But the thinking here is let's start with the broad base case that most people don't short, most people are long. If you're long and you've had some nice gains, take some measures. Sell calls, trim, do something before, as the expression goes, someone does it for you.
All right. Carter Worth with the outlook on oil and energy stocks. Thank you very much. We'll see you soon, sir.
Bye.
All right, coming up on the show, retail sales coming in better than expected, but the latest ISM data is showing price increases as a result of the Iran war. So what does it all mean for the economy and the health of the U.S. consumer? We'll dig into that story coming up next. Plus, is it time to buy the backbone of the AI economy? One firm is initiating a half dozen tech stocks with buy ratings today, including Microsoft, which is down 30% from its record high. We're going to look at which names have the most possible upside ahead. The exchange is back right after this.
This is The Exchange on CNBC.
Welcome back to The Exchange. The latest economic data painting a bit of a mixed picture when it comes to inflation vis-a-vis the consumer. Our Steve Leisman is here to break it down all for us, and just how many cross currents do we have to deal with now with regard to the U.S. consumer, the war, and everything else that's happening with
Yeah, do you ever fish a stream where there are three different coils and you're trying to get to the fish on the other side?
You're the guy who would know this.
That's where I'm up. But some reasonably upbeat economic data, Dom, hitting the wire this morning on jobs and consumer manufacturing before it all changes with the surge in oil prices. So just keep that in mind as I show you what happened. In retail sales, a positive 0.6. That's a good number after an upwardly revised negative 0.1 for January. ADP coming in down a little bit from the prior month, but above expectations. And that ISM also above expectations, ticking up 0.3%. That's a good number. It was the third month in a row that ISM has been above the 50 mark, signaling expansion in the manufacturing sector. But there were signs the Iran war is already having an impact. Commentary in the ISM report included quotes like this from a fabricated metal producer. We're seeing steady increases in activity, but geopolitical issues and the Iran war are already waning sentiment. And then you get a respondent from the chemical industry saying geopolitical tensions related to the conflict in Iran are contributing to rising manufacturing supply costs, and ongoing tariff uncertainty is negatively impacting purchasing strategies and cost forecast. Prices are already a problem. Take a look here. The price index in the ISM report hitting 78. It's the highest level since 2022, and it's up about 20 points since January. I don't know if that already incorporates what we're going to see or if there's more to come. But both jobs and consumer spending bear close watching now, with an eye on whether employers hold back from hiring amid the current uncertainty, and if consumers dial back or shift their spending in response to the bigger part of their paycheck or a larger part of their paycheck now going to pay to fill up the tank.
Okay, so we've had these types of scenarios play out to varying degrees over the course of even just the last 5 to 6 years with regard to inflation, fuel costs, egg costs at one point. But the consumer has remained resilient amidst all of that stuff. Is there any reason to think that this time around it's different?
No. I mean, I think the consumer will remain resilient. You do have much lower confidence levels. They did tick up last week, but in general, they've been relatively depressed. The consumer will pull his and her way through this, but my point is that there will be shifts. You can't rely upon the data. One thing I didn't like in the retail sales report this morning is this was a delayed February report, and gasoline spending was already up 0.9%. So that was a concern because it's going to get worse. And you just wonder, Dom, if you get to a point where we had the inflation in the wake of the pandemic, it's remained relatively high. You have the tariff come through. At some point, maybe you do kind of get more meaningful shifts in consumer spending.
In other words, the survey becomes reality.
Exactly.
The pessimism that you might have actually translates into actual.
And so far it hasn't. And I think you're right to point out the resilient consumer. I think that's the way that Wall Street is betting on it. But you just can't be sure that that's the way it's going to end up because of the kind of pressure. One of the things you watch is not did prices rise, but also the speed with which they rose. You know, one day you're spending $50, the next day you're spending $80. So that can be a big shock to the consumer.
All right, so we're going to take that speed and vector and put it in context with the business side of things now. So we'll stick with that retail trade. Shares of Nike are getting crushed today. The retailer beat on the top and bottom lines, but issued a weaker than expected sales outlook for the current quarter, and amid revenue struggles in China. Nike is in the midst of a big turnaround under CEO Elliott Hill, who took the helm back in October of 2024. But Wall Street is starting to question just how long the turnaround could take. Speed and vector. Joining me now to discuss this is Stacy Widlitz, president of SW Retail Advisors, and Jan Kniffen, J. Rogers Kniffen Worldwide CEO. Thank you very much for joining us here. You heard Steve's report just now about the resilience of the consumer and whether or not we could see higher fuel costs eventually really take their toll on the consumer. Jan, I'm going to go to you first. From a macro level, is the consumer in an okay place?
Well, Steve gave you the economist both hands, right? I'm going to give you my view. The consumer is in good shape. The consumer has falling inflation, despite the fact that Steve's still worried about it. Big tax rebates, lower tax rates in general. They've got solid wage growth, and they've got low unemployment. $3.80 gas won't stop them if that's what we're going to get. We've had it before. And the war in the Middle East won't stop them unless it results in trade imbalances severely or it does something to inflation that's severe. I don't see either one of those happening. So I'm feeling pretty good about the consumer overall. They've been solid. even like Steve mentioned, consumer confidence, which I have no faith in anyway, did tick up a little bit though. So if you're going to look for a data point, at least went the right way. So I don't have a big concern about this year for the consumer. I think they'll be solid. Yes, the lower end's still tough. Luxury's good. In the middle, it gets tough, but there are still great players in there that are winning. Walmart tells you the story. Walmart's good every time they report.
All right, so that's that side of things. We can make the transition now to what happened with Nike, Stacy. What exactly did happen? Is it an indication of the consumer? We know that there are some specific issues with regard to the greater China market for the outlook at Nike, but what happened?
I don't think Nike is an indication of the consumer. Nike is an indication of a turnaround that's not taking hold. And we upgraded the stock after 2 years with a sell on it, and we were early and wrong. So, put that out there. But what Nike talked about is North America was gaining traction. It was up 9% last quarter. It decelerated to 3%. And by the way, they're talking about their sell-through being below plan in North America. And that is the region that represents half of the business that's supposed to have turned. Then you're looking at Europe, which is also down high single digits. Again, sell-through below plan. So, we've got a situation here where we're likely going to see more promotions, specifically in the European market. And to me, there's incremental question marks on wholesale in the US because all of the increase in North America was wholesale driven, and a lot of it was distribution, more distribution driven. So I think there raised more questions in this earning release than give us encouragement going forward.
How much of this story, Stacy, if I can stay with you for a moment here, how much of this story around Nike is idiosyncratic, to your point about the turnaround efforts that Elliott Hill is trying to implement there? How much of it is microeconomically focused on Nike, and how much of it is macro focused on footwear? And I'm not saying that any of these are linked directly, but we got the Allbirds news. They've basically sold their IP for $39-40 million after topping $4 billion in valuation at one point. We saw On Holdings. Yes, they've been a standout so far, but even they've kind of given some back in recent weeks. What exactly does it say about footwear, and are there certain parts that are better positioned in your mind than others?
Absolutely. I think in business, the business has slowed down slightly, but still, if you look at On's numbers, they were fantastic. If you look at Hoka's numbers, they were better. Adidas numbers are holding in there. Some promotions in the US, you've seen a little incremental here. So I think it was very much a Nike focused issue. And also, if you listen to Dick's Sporting Goods last week, they talked about margins getting better. They talked about inventory being cleaner, and there were all positive signals there. Foot Locker is 60% exposed to Nike here. So some mixed, definite signals there, but I think this is a turnaround that is just going to be way slower than the street expected, while most are sticking with it.
All right, Jan, if we take this kind of retail trade on athleisure and footwear and expand it out a little bit more, you had mentioned the likes of Walmart, other kind of bigger players. If we look at the retail landscape right now, are there places that you feel as though will be the outperformers if that consumer does in fact hold in and weather the oil price and fuel spikes in the coming 6 months?
Well, I'm a perma bull on the 5 best retailers in the country: Walmart, Costco, Home Depot, Dick's Sporting Goods, that Stacey just mentioned, and TJX in that order. So I'm always positive on them unless something's going terribly wrong. Beyond that, the middle, the part that nobody really likes, I still like Levi's and Contour and Tractor Supply and Casey's General Store and Boot Barn and Aritzia and Urban Outfitters and Nike, of course. And why do I still like Nike? Well, you've been a competitive golfer all your life. I've been a competitive runner all my life. I bought my first pair of Nike waffle trainers in '75. For 10 years, I haven't run in Nike. I just bought Vomero and Pegasus Zoom. They went away from sports. They got too much into style and casual. They're getting back there. They went away from the local retailer. They went away from the big boxes that sold them, and they tried to sell it online. They're moving back there. So Stacey's 100% right, because Stacey, her analysis is always really, really good. But longer term, this Nike thing's going to work. The question is, when's it going to show up? The real question, though, is will it ever show up in China? And unless it does, it's hard to get really positive. It is going to show up in the United States.
All right. Big story and a complex one for sure. Thanks for breaking it down for us, Stacey Widlitz and Jan Niffen. We appreciate it. Coming up on the show, home builders are coming off their worst month in over a year. The sell-off happening as mortgage rates have hit their highest level since August. So how long will it take to get some relief in rates? That's next. And as we head out to break, check out Eli Lilly popping 4% after the FDA approved the company's new GLP-1 pill, Foundeo. CEO David Ricks telling CNBC that while it's not as effective as its weekly shot Zepbound, it could be more attractive to people who value convenience. More of today's biggest movers when we come back after this commercial break. All right, it's a lot of green on the screen. Stocks right now are, again, near their session highs. The Dow Industrial's up about 450 points to 46,792. It's a 1% gain. North of 1% for the broader S&P 500, 6608, up 80 points. And the tech-heavier NASDAQ composite right around 21,970. It's up 380 points for a 1 3/4% gain there. Intel is moving higher after agreeing to acquire Apollo Global's 49% stake in its fab joint venture in Ireland for more than $14 billion. The deal will be funded with cash and debt and is expected to be accretive to earnings per share starting in the year 2027. Hasbro is lower after disclosing a cybersecurity incident, saying a third party gained unauthorized access to its network, prompting the company to take systems offline. The investigation is ongoing and interim measures are in place and are they could lead to some certain operational delays. So Hasbro shares off 4.5%. And then airline stocks are moving higher for a second straight day amid optimism about a possible de-escalation to the Iran war. Alaska, United leading the way higher. United, by the way, coming off an 8% gain in yesterday's session. So flying high, pun intended. Well, mortgage rates are moving lower after touching an 8-month high last week. The recent spike in rates is putting a dent in home buyer and refi demand as well. Diana Olick has the details on the current state of play for mortgages. Diana.
Well, Dom, you're right. Mortgage rates did move lower to start this week as markets react to the most recent rhetoric on the Iran war. But last week, the average rate on the 30-year fixed rose to the highest level since August, and that just tanked total applications 10% for the week for mortgage demand. Refis were, of course, hit the hardest, down 17% for the week. They were 33% higher than the same week 1 year ago, but earlier this year, when rates were lower, refi demand was more than twice what it was a year ago. Applications for a mortgage to buy a home dropped 3% for the week and were just 1% higher than the same week 1 year ago. And maybe I buried the lead on that there, but that 1% is significant because this spring was forecast to be much better than last year, with mortgage rates expected to be lower and the economy stronger. It is clearly not shaping up that way. Just ask the CEO of Restoration Hardware, which missed analyst estimates in its big way for its quarterly earnings. On the analyst call, Gary Friedman said, "We're compounding clutter from tariffs, global discord as a result of the war, and the most dire housing market in decades." Real estate agents I've been talking to for our next quarterly housing market survey, which is out next week, say both buyers and sellers are suddenly pulling out of the market. Dom?
For the all-important spring shopping season as well. For that, Dinah, thank you very much for that story. Now to Julia Borston for a CNBC News update. Good afternoon, Julia.
Dom, protesters gathered outside of the Supreme Court as President Trump intended oral arguments in a case that could end the constitutional right of birthright citizenship. The president sat in the front row for more than an hour and left after the government presented its case. So far, several justices have expressed skepticism over parts of the administration's position. A federal judge has delayed the trial of Luigi Mangione to October of this year. Mangione is accused of killing the United Healthcare CEO in December 2024. His defense team asked for a 2027 trial start date to help them better prepare for both his federal and state trials. Mangione has pleaded not guilty to all charges. And traffic deaths in the U.S. fell to record lows in 2025, according to new data from the Department of Transportation. Just over 36,000 traffic fatalities were reported last year. That's a nearly 7% decrease from 2024 and the second lowest traffic fatality rate in recorded history. The report also found that traffic fatalities were down in 39 states. Back over to you.
Good news for commuters like me. Thank you very much, Julia Borston, for that. Coming up on the show, software stocks have been hammered to start the year. The IGV ETF is coming off its worst quarter since the great financial crisis. But one Wall Street firm says the pullback is creating long-term buying opportunities. The analyst behind that call will tell us where those opportunities are, coming up next.
As America celebrates its 250th anniversary, CNBC spotlights the companies that rose with the nation and continue to shape its future.
I'm Bill Ford, Executive Chair of Ford Motor Company, a company that my great-grandfather, Henry Ford, founded in 1903. Through his innovations on the vehicle and, most importantly, the assembly line, he really helped create the middle class in America, and he gave the average American the freedom of mobility that they didn't have prior to the Model T. Most people never traveled more than 25 miles from home in their entire lifetime. I think what it did for America was allowed people to choose where they lived and where they played. Prior to the assembly line, cars were hand-built, and you could make just a few a day. And all of a sudden now you were making 20, 30, 40, 50 an hour. And that changed everything. It brought the price down. It made it so that the average American could actually own one. And it really changed the way all manufacturing in America was done. He also doubled the average wage of the day to $5 a day, and he began profit sharing. So his own workers could then afford the vehicles that they were making. We were the arsenal of democracy in 2 world wars. Fast forward to when COVID hit, we transformed our plants to making PPE equipment. Once again, we proved to the country that our industrial know-how is something that the country benefits from. What's made us a great company is we have so many multi-generational employees, dealers, suppliers that have been with us for our entire journey. And we want to continue that, well into the future. If you look back at our last 250 years, it's been an amazing run for our country. And when I look ahead, that same opportunity is ahead of us, but we have to come together as people. And I believe if we do that, our future will be every bit as bright as our past.
Welcome back to The Exchange. The Mag 7 names are rallying for a second day, but the group had a tough March, of course, and a rough first quarter overall, especially for Microsoft. The stock is closing out its worst quarter since the financial crisis in 2008 and was by far the worst performer of those Mag names, down more than 20%. But our next guest says he just initiated coverage with a buy rating and a $450 target price. That's what's got him so bullish on things, and we're going to ask him about that turnaround effort and why he's bullish. Joining me now to discuss that story is Yi-Fu Lee, senior analyst over at Benchmark, which is a StoneX company. Yi, thank you for being with us right now. Let's start with that Microsoft. Let's start with that Microsoft trade first.
Yes.
Because it has been maybe the arguable epicenter of this kind of Mag 7 meltdown that we've seen since the highs. Why the buy rating and why now?
Because we think Microsoft is a core investment holding for the long term, just because, yes, we understand they spend over $70 billion in CapEx, but the flip side is they're not building and waiting for the customers to come. They already have very great visibility on the pipeline of customers. So they are building these data centers, purchasing these cutting edge GPUs from NVIDIA, AMD, and have a great customer base. So we think the sell down, the drawdown is very overblown, and this presents an opportunity to buy and hold Microsoft for the long term. And what I recommend to my client is, if there's any weekdays, then start loading up on Microsoft. And we're not looking this from a short-term perspective, more of a long-term horizon. Sorry, Don.
All right, so there's also some other software names that have been hit recently that you are initiating as well. I'm looking specifically, let's start with, say, some of the SaaS type companies like ServiceNow. You've got a buy rating with a $125 price target. Even some of the infrastructure plays, right, in cloud, like Snowflake, buy rating $190 price target. What exactly is this ecosystem telling you about just where you think we can go, even with the AI spending picture and the gargantuan nature of the money that's going to be deployed?
What I could say, Dom, is there is no AI strategy without a data foundation. And like you said, names like Snowflake, ServiceNow, these are quintessential firms. Like it's good that OpenAI is very good at analyzing things, but at the end of the day, you still need the underlying data. And Snowflake is the cloud data warehouse. Their core business is the trusted custodian of the world's largest firms, the data source that is generating the intelligence in the AI. So we think Snowflake is a stayer. We really like Bill McDermott leading the charge at ServiceNow as well. We think it is really too cheap to be true. Trading at mid-single digits right now. And again, it's unjustified as this is a rule of 50 plus grower. You know, we're talking about top line, maybe 20 to 25%, 30% in the free cash flow margin. And we think it's gonna be here to stay because they have the right AI strategy. Whether you build it, which they have a strategy with their control tower, or you buy it straight from them, ServiceNow should be a long-term platform here to stay.
All right, I was recently, Yi, at a tech executive forum down in Florida. A lot of senior tech leaders from Fortune 100 type companies and CISOs, CIOs, CTOs. And one of the things that came up in those discussions at that forum was just how important cybersecurity is going to be with the evolution from generative AI into having AI agents in many parts of our lives. We're already seeing that play out now. So let's talk about the cybersecurity story and why you are so bullish on them and what stands out to you.
Thank you, Don. And cybersecurity is the sector I like the most, actually. And I would like to highlight CrowdStrike as my top cybersecurity pick. We like this platform. We've been following the story even since they were a private company. Went through the IPO in 2019. We think that they have a great management team led by George Kurtz, Bert Parder, CFO, great cutting-edge product line, top-notch management team, and we have a good path to double the ARR by fiscal 2031 to over $10 billion. And we see it, like we talk about AI, whether it be OpenClaw, things like Anthropic Claw is gonna, kill the entire SaaS sector. But at the end of the day, we forgot the other part of the equation. When you introduce new technology, there's going to be greater risk. And what we believe is CrowdStrike is at the cutting edge to protect you in this AI super cycle. And I want to mention one more thing, Don, is I want to give a call out to Datadog as well. We like them from an infrastructure software side just because we like the organic story. Both of the two founders, just like CrowdStrike, they've been with the firm, Olivia as well as Alexia, driving the product line. We really like their new products in SRE, Site Reliability Manager, applying AI to the story as well. So both Datadog and CrowdStrike, we believe, is a long-term stayer, long-term winner, even though there could be some AI headline disruption headwind, but we think it's more noise than bite.
All right, cybersecurity, a big play there for Yi-Fu Lee. Thank you very much with Benchmark. We appreciate it. All right, coming up on the show, sticking with the AI trade, Apple changed the tech landscape with the Apple One computer 50 years ago, half century. These days, though, it's widely seen as falling behind the AI race, but is the company actually just playing the long game? What Apple insiders are saying coming up next. Welcome back. Apple was incorporated 50 years ago today. Big anniversary. Half a century later, the company is famous for its innovative hardware and it's notorious for its closed ecosystem. Apple is taking a different approach when it comes to artificial intelligence, though, but one some insiders say fits just right into its playbook. Mackenzie Sagalos has the story in today's Tech Check. 50 years later, the long game in AI. What does it look like, Mac?
So, Dom, as Apple marks its 50th anniversary, the big question is whether the company squandered its lead in AI. And to answer that, I went straight to the people who helped build Apple: Steve Wozniak, former CEO John Sculley, and the engineers behind the iPod, iPhone, and Siri. People who were there for some of the most important chapters in the company's rise. And what they told me is that, yes, Apple did lose the first round of AI and a multi-year head start, in part because the same privacy culture that helped define Apple also left it poorly suited to the first phase of generative AI, which rewarded companies willing to train on enormous amounts of user data and pour money into cloud infrastructure. That's never been Apple's model. So now, once again, Apple is leaning on its frenemy Alphabet, this time for its Gemini models to help rebuild Siri. But almost everyone I spoke with described that as a stopgap, not a surrender, because Apple has broken dependencies like this before, whether it was in maps, chips, or other core technologies. And the pattern is really familiar: partner, learn, then build its own. It's also a playbook that's worked for the company before. Come in late, let others prove out the market and battle over the best models, then fold the winners into Apple's hardware ecosystem, where it still controls the interface, the distribution, and gets to take its cut.
And Mac, its installed user base. So how much of that story for the long game in Apple is about whether or not the installed user base can stay with the Apple ecosystem, and then how do they grow it?
Well, that's what Tim Cook, their CEO, put in a memo to employees today, that they have 2.5 billion devices in hand. And part of what this recent hardware lineup that they put out just last month is about is putting more devices out at the lower end of the spectrum. MacBook Neo, a $599 MacBook, the 17E, which is their budget version of the iPhone, now equipped with all these AI capabilities. And that's what's so key, really maximizing that installed user base. And they're going to have different phases of this AI rollout that really maximize how customized their machines are, and being able to use that on-screen context, all that personal data that they have access to. So this rebooted Siri, it's going to use Alphabet's Gemini models. And then we're also seeing Siri open up to a chatbot of your choice. If you're a Claude user, if you are a ChatGPT user, you're reportedly going to be able to plug in whichever bot works best for you.
All right, so Apple capitalizing on that installed base. Mac, thank you very much for that. Mackenzie Sagalos with the Apple at 50 story. Coming up, gold and the GDX, the gold miners ETF, is up 6% today, on pace for its best week since March of 2023. But it's down 16% since the start of the Iran war. With President Trump saying Iran has asked for a ceasefire, we'll discuss whether now is the time to buy gold miners and maybe the gold itself. That story is next. Welcome back to the exchange. A mixed bag for commodities in trading today. Oil prices are lower, but gold is hitting its highest level since March 19th and on pace for its first positive week out of the last 5. The miners are also climbing. Our next guest says the gold rally will pick back up if oil prices continue to cool off. So here with me now for the case is Tim Seymour, Seymour Asset Management CIO. He's also a CNBC contributor. So, Tim, we talked a little bit yesterday about just what happens with regard to the U.S. versus international trade. But now let's break down the commodities. Why does gold stand out to you?
Well, we definitely have the potential to have less Fed concern. So we were talking a week ago about an emergency rate hike, possibly. Less Fed equals less dollar, less safe haven. We clearly have a lot less froth in gold. But the fundamental backdrop for gold has been central bank diversification, as we know. In a world where post-Iran, the world is looking for energy independence, and that will be major investment across energy. I think we know the theme for the last few years has been dollar diversification. So the idea of gold, both as an asset allocation for portfolio holders, whether that's 3%, 5%, whether that's 1% that you never had before, gold exists differently as it did years ago. And if you remove the safe haven dynamic, if you remove a stronger dollar, and obviously if we get less inflation, it means we have an easier Fed, and that's great for gold. It's been proven to be a great backdrop.
All right, if that backdrop is in place there, the gold miners, they are, again, more levered to that gold trade, the underlying commodity. Just how exactly should you view the gold miners trade? Do you just take the basket approach, do the ETF, or are there places specifically that are better positioned than others?
I think an ETF approach to owning gold miners is great, because I think what we've seen over the last 15 to 20 years, if you invest in miners, you know some are more efficient than others. We know there are operational challenges. We know there can be politics and volatility around the world. But the reality is that gold miners as a group in a up market for gold, especially one where we have less inflation and we're more concerned about some of the dynamics, but the higher gold price has meant the upgrades for the gold miners. I think after, first of all, let's be clear, we've rallied almost 17, 18% off the lows in the GDX, which is a gold miners ETF. I am long that. I think the dynamic for gold almost 8% off those lows. I think miners are going to be slower to get back to the leadership that they showed ahead of the metal pre-inflation concerns. I will say, in a higher inflation environment, what we've seen in the past is that miners anywhere, gold miners especially, were not performing when gold was rallying. I do think you want to think about splitting that allocation probably in half, or 2/3 gold, 1/3 miners to get some of that beta. But either way, the argument around gold, whether it's an environment that is de-escalation in the Middle East or whether it's the environment that we may have had, there's no question to me that gold is a part of the portfolio that a lot of investors for the first time in years have been spending time with. And I think that's part of what made this volatility since the Iran war so extraordinary.
All right. Tim Seymour, Seymour Asset Management on gold. Thank you very much. We appreciate it. That does it for us here. Thanks for watching The Exchange. Power Lunch with Brian Sullivan is coming up right after this. Quick break. Keep it right here.
Stocks burning higher once again as a big part of the market does something you would not have expected. Welcome to Power Lunch, everybody. I am Brian. Kelly is off today. Stocks higher again. President Trump set to speak to the nation tonight as the president of Iran confirms some positive reporting from yesterday. Oil is lower, back below $100 a barrel. We'll show you the real state of the Strait of Hormuz and highlight a huge plea from one of the Middle East's biggest names. Is it time to back up the truck and buy stocks? We've got real-world advice for you. Wells Fargo's Oh-Sung Kwon and Citigroup's Alex Saunders. It is an absolutely jam-packed hour. We have got a lot to do. Markets across the board, but your tippy-top performers in the S&P 500 are the big AI data memory plays. Many stocks that until recently had the biggest runs up this year. And they got sold off, but today they're running back up, and there is some news. So let's kick it off with Christina Partsenevelos here to tell us what is steering some of these stocks to double-digit gains. Christina.
Yeah, these tippy-top stocks. So it is really risk-on for traders today as momentum names come rowing back into favor. Leading the charge, like you said, you got memory makers like Micron, flash rival SanDisk, Western Digital, Seagate, and these four stocks really perfectly capture today's risk move. They were among the biggest winners in the S&P 500 just last year, each soaring by triple digits as AI really supercharged demand for memory as well as data storage. From a fundamentals angle, analysts say last week's jitters over Google's memory compression algorithm and reports of over-ordering at OpenAI were likely overblown, which is why memory really sold off last week. And then OpenAI's fresh rounding this week, funding round, also gives it more spending power for high-end AI hardware. The rally isn't limited to just memory, Brian. Optical chip suppliers are also catching a bit today, too. Lumentum up almost 10%, Coherent almost 6% as investors really rotate back into high volatility names tied to next generation connectivity. And don't overlook Intel, which rounds out the day's top S&P 500 movers. The chip giant is up after agreeing to buy Apollo's 49% stake in its Irish fab for roughly $14.2 billion, funded partially by $6.5 billion in new debt. The deal pretty much hands Intel back full control of the site, strengthening its turnaround story and improving its credit profile starting in 2027. So overall today, traders are just really leaning back into semiconductors, betting the AI hardware boom still has legs.
Got stocks to the green, Intel's up, and an Ireland reference to cap it all off. Christina Partsenevelos, thank you very much. All right, so let's now bring in Dan Niles. He's founder and head of Niles Investment Management. All right, Dan, we got a lot to get to, but I want to follow up on Christina's news. You own Intel, you like Intel, maybe some of these other names. What does the news from today, if anything, do for you?
Well, I mean, it just confirms in my mind that you still have a lot more legs to go in this AI trade. And what I would remind investors of is if you go back to the internet infrastructure build out, at that time, Cisco was the internet infrastructure play, right? It was the NVIDIA back then. And in 1997, you had a macro scare with the Asian currency crisis, the Thai baht selling off. Cisco at that time, intra-year, was down 38%. And then in 1998, you had the Russian bond default, long-term capital management, and Cisco was down 37% that year. It finished both of those years after those sell-offs intra-year up 31% and up 150. So I think it's a similar situation right now where you had some scares. Obviously, we have our own macro crisis this year with Iran. I think hopefully that's behind us in a few weeks. And then you're back to where having agents show up in AI, you know, as shown by Claude and OpenClaw, I guess it's called now. And that's going to drive a 10 to 100x increase in the number of tokens you need to produce that.
Okay, quickly, I want to go back to that point. I know you're not a political strategist, you're not a military strategist. Heck, maybe you are, but I don't think you are. So we're all kind of guessing and hoping what happens with the outcome. Let's assume there is an end to this war one way or the other, next couple days, next couple of weeks, kind of what you just referenced. Would that change at all the way you look at this market?
No, I mean, the only thing it changes is that it becomes even more risk on than it is now. And what you saw, I think, is Well, there's two phases to this. If you go back to the end of February, the Magnificent Seven stocks were struggling. They were already down year to date. Yep. The S&P was flat. What was working was the asset-heavy, low obsolescence risk companies. And I call it, you need to get messy. And if you look at that group, utilities, materials, energies, staples, and industrials, those stocks are up, I think, 13% year to date. They're up between 6 to 31%, depending on the subgroup. You compare that to the Magnificent Seven, which I think right now is down about 11% year to date. And so those stocks were doing better beforehand. You then got to the Iran war, went risk off, they sold off even more. Now they're bouncing back. The war goes away, you get to go back to focusing on fundamentals, which look actually pretty decent given what's going on in the background in terms of agentic AI requiring 10 to 100x computing power.
All right. This is, I think, going to surprise a lot of our viewers. It surprised me, to be honest. But with the gains of the last couple of days, both the small cap index and the mid cap index in the S&P are actually higher this year. The small cap 600, Dan, is now up over 4% year to date. I bring this up, they're not huge indexes, but they're sensitive to the domestic American economy. I know with all the doom and gloom out there, people are going to be surprised to hear that any stock index is actually higher this year. Does that, maybe not, but does it tell you anything about how the market maybe perceives the American economy?
Well, yeah, there's two parts to this. Go back to the end of February before the Iran war, and Magnificent Seven stocks are under tons of pressure. And those indexes, by the way, you just mentioned, were up year to date. And so I think what it shows you is you need a broader exposure than just 7 names. Because within those 7 names, you have some that I think are going to be really great, and you have others that I think you're going to have real problems with. And so it comes down to, you just can't say, I'm going to buy them all, and you're going to be fine. Because valuations coming into this year were high, and those sectors you just mentioned, Brian, have sort of been forgotten for the last 3 years in a one-way AI trade where everybody's going to win. And then starting in late October of last year, people started to question, does it make any sense to think OpenAI can spend $1.4 trillion when their run rate revenues are $20 billion? And so
I'm assuming the answer to that would be no to you.
Yeah, it's absolutely no, because I don't even think they're a long-term winner. I think that's Anthropic in terms of the private companies, and it's Google in terms of the public companies. And so you've got investors starting to finally get a lot more discerning around this and sort out the winners.
Okay, quickly, let me ask this, because OpenAI, whatever, they've got some weird marketing campaigns to commercials, billboards on the West Side Highway that I don't understand. That's a marketing issue, but I bring it up because let's assume if OpenAI, ChatGPT, is not the winner, and they're a private company, can the stock market still do okay, Dan, even if they don't do okay? It's a question I've been asking for months, and I still don't know the answer to it.
Well, which stock market? Because you just brought up, you have a couple of subsectors that are actually up year to date,
as we just referenced.
So if you're just going to say I'm going to own 7 stocks, then you probably have a problem. If you look at it and you say, well, which are the companies that benefit from AI? There's no question that they benefit from AI. They have, lots of assets that AI is not going to replace a truck, an airplane, a train. You pick it. Mm-hmm. Those industries will benefit. Then it's a much different question. So I don't think it's as simple as saying, well, can the stock market do well? Well, it depends on which part of the stock market. I've been saying for a while, you need to be in other names other than 7. Beginning of the year before the Iran war already showed that. Yeah. During the Iran war showed it as well. And coming out of this, those asset-heavy names are still actually doing okay. Yep. And so I think that's how you need to think through this.
And if you're small and mid-cap, you're actually higher this year. And nobody, I think, but us and a couple people, maybe watching and listening would know that. Dan Niles of Niles Investment Management, really appreciate it. Thank you very much. All right, folks, it's not all sunshine, lollipops, and rainbows out there. Today, Wells Fargo lowered their year-end price target in the S&P, taking it down to 7,300 from 7,800, adding that the Iran war was not their base case heading into the beginning of the year. I'm not sure it was anyone's base case. The new target incorporates emerging risk from the global oil shock. But let's be clear, despite this slight come down, Wells Fargo still structurally bullish on American stocks. $7,800 to $7,300, not a huge cut. Why make it?
Yeah, I mean, I thought that was a prudent thing to do. That Iran obviously wasn't our base case heading into the year.
It was nobody's. We didn't have this.
Exactly.
Nobody I read or anything said we're going to go to war with Iran.
Exactly. And now we're incorporating that risk that has emerged. And we're still structurally bullish. I mean, to your point, 7,300 is still 10% plus upside from here. That being said, I think the market's still going to remain pretty volatile over the next couple months. I don't think the setup for stocks is that favorable, especially at these levels.
Okay.
So as of last week, we estimated that about 2 quarters plus of this disruption was fully priced into the equity market, which is actually more than what the oil market was pricing in. So for the first time since the war began, the equity market was pricing in a bigger war risk than oil. So at that point, we were like, a lot of that has been priced in. But after yesterday and today, we just priced out about a quarter of that disruption. So equities are now pricing in less of a war risk than oil.
Well, yeah, and my point on the small and mid cap stocks, those are almost 100% domestic American companies that sell to people in the United States. They're not global multinationals. The fact that those indexes are higher, with oil around $100 a barrel and gasoline at $4 a gallon, there's a disconnect there, Oh-Sung. The market is saying, I think, that $4 gallon gas is not going to kill the American economy. What do you think?
I agree with that. I mean, I think the economy is going to be fine. I think earnings are going to be fine too. So a lot of people talk about the 70s. I mean, the oil intensity in the economy versus the 70s
way lower now.
Is down 75%. So it's no longer that 70s economy anymore. Also, the One Big Beautiful Bill tax returns, obviously, that was a real bull case for equities and to the economy heading into this year. That almost gets that actually more than gets wiped out over the next 12 months. But the point is, it's over the next 12 months. Yeah. The cost of living impacts over the next 12 months, whereas the tax return is happening today. So over the next 6 months at least, the average U.S. consumer is actually going to break even. Mm-hmm. But then that's the average consumer. I think this is a K-shaped widener that the bottom 40%, they lose right away, whereas the top 20%, they are still going to benefit by about $1,500.
And it's hard to say because I understand your point. And the bottom part of the economic spectrum has never, I hate to say this, been that relevant to the stock market, correct? I mean, because there's not a huge amount of consumer spending. It's not something I want to say. I want everybody to participate. But it's kind of the reality. And that $4 gallon gas is annoying to a lot of people. But the market, not me, but the market has said maybe it won't matter that much. I want to go back to what you just said, which is that about volatility this year. Because coming into this, before the Iran war, we talked about it, that midterm election years tend to be more volatile, that top to bottom, the market tends to fall 15% roughly on average in midterm election years. So strip out the Iran war. What would you expect from the rest of the year?
I think the biggest risk to the equity market this year, and this is something that we have been highlighting even before Iran, is the second half inflation. So inflation, at the end of the day, is too much money chasing after too few goods. Money supply has turned. Inventory levels are pretty low. We are firmly in a restocking cycle, as you saw this morning from the ISM data. So if that's the case, that those are the drivers of inflation that we were highlighting as a risk into the second half of the year, and the Iran war happened. So I think the risk has gone up. That's essentially the biggest reason why we lowered our S&P target. Yeah. At the end of the day, though, I think equities are going to be fine if the Fed is okay with, say, 3% plus inflation.
Are they?
I don't know.
What do you think?
I mean, I think there's a chance.
What is your chief economist whispering in your ear, Oh-Sung?
I think there's a chance that they are okay with it because I think both Washington and the Fed want to inflate out of this deficit issues. And if that's the case, I mean, we've been talking about this, but this is a debasement cycle. that if they are okay with it and they're just running it hard, that's the debasement cycle continuing. And the example that we give is look at Japan. They are running it hard. That's the perfect example of the debasement cycle. Their FX is collapsing, rates are ripping, stocks are going higher. So debasement itself isn't necessarily bearish for equities. Everything is
by the way, Japan's had like 12 recessions in the past 8 years. I mean, I'm being facetious, but your point is well taken. Oh-Sung Kwan of Wells Fargo, always love having you on set. Thank you very much.
Thank you.
All right, so a lot going on, folks. Let's take a look at today's market movers, and one name that can't seem to do it lately. Sorry, that's Nike. The stock not participating. In fact, Nike's heading for its worst day in nearly a year. Nike warning that sales will fall for the rest of this year. Nike keeps tripping up investors. The stock trading at 11-year lows, and it's actually wiped out about 45% of investor value since Elliott Hill returned as CEO in 2024. But here's a bonus trending ticker, Eli Lilly. That stock up 5%. The FDA approving its daily GLP-1 weight loss pill called Foundeo. Lilly CEO Dave Ricks told us this morning it's quite a big moment, and investors might agree. All right, lot to do. We are just getting started. Oil moving lower today on hopes President Trump will lay out a real path to peace in his primetime address tonight. Plus, can't we all just have a good old-fashioned rocket launch? 4 astronauts about to lift off to the moon. First time we have done this since 1972. Barely when I was even born. How the launch could spur a new wave of investments here on Earth. A reason to cheer and all, whatever your differences. Just love a good old-fashioned rocket launch. And we're back right after this. All right, welcome back. As investors wait for an update from President Trump tonight, he will address the nation 9 p.m. Eastern Time. One of the Middle East's most influential leaders is sounding the alarm, rather bluntly, warning about the global fallout of the Iran war. In a LinkedIn post, Dr. Sultan Al-Jaber, who essentially runs the UAE's energy strategy, writes that Iran's actions in the Strait of Hormuz, quote, represent global economic extortion, a threat the world cannot tolerate. Dr. Sultan goes on to say, quote, disrupting Hormuz hits food prices, airfares, energy bills, medicine costs, and much more. This is not about oil supply. It's about everyday affordability for billions of people. We're already seeing the effects around the world. Of course, here in the United States, gas prices have risen above $4 a gallon in some areas. In Germany, electricity costs, which were already soaring for the last couple of years, are now nearly 4 times higher than in France as natural gas supply is tightening. And Indonesia now limiting impact or fuel sales to blunt the impact of the conflict. In fact, shortages, as we have said for weeks, may start to trickle through more economies. And for many emerging economies, the poorer economies of the world, across, say, Africa, Latin America, and even parts of the Middle East, IMF economists say this is the equivalent of a large, sudden income tax. Put simply, the conflict is sending shockwaves through the global economy, and Dr. Sultan's message is clear: the world must act together. All right, on that, let's bring in Matt Smith. He is lead oil analyst at Kipler. They've been tracking and helping us and the world track flows through the Strait of Hormuz and now the Bab el-Mandeb Strait as well. You got 2 straits on the brain, Matt. We're glad to have you back. Talk to us first about Hormuz. Has it gotten any better the last couple of days?
No. Answer is no, Brian. And so, while we did see an increase in traffic going through on Saturday, that was an anomaly as opposed to the start of a new trend. And so we're just back to a handful or less vessels passing through there every day. So no real change as there hasn't been for the last month.
Okay, we have, and there's a narrative going around that the ships that are going through, Matt, are really paying a toll, effectively a tax to Iran so they won't get hit. They're basically buying their protection, if you will. What can you tell us about that? And do you have any insight or visibility or expectation of when things might return to, quote, normal?
Well, in terms of the traffic going through there, the majority of it remains to be Iranian crude. And so the unsanctioned tankers, shadow fleet that are going through there. There is the odd one that is passing through there. It's not for us to speculate whether they are paying tolls or not. All we can say is that perhaps they are humanitarian cargoes. So because of fuel scarcity, we are seeing the Iranians let some of these cargoes go through. But for the most part here, it is still these Iranian crude tankers that are passing through and nothing much else.
Yeah, and we've seen the Saudis. They had a lot of foresight, I think, a couple years ago to build this huge pipeline literally across their country into the Red Sea. Your data and other data I've looked at, Matt, suggests this might be maxing out at 4 to 5 million barrels a day. How have flows in oil and shipping changed in the last week or two?
Yeah, so as you mentioned, the East-West pipeline there is getting up to capacity, we hear. But in terms of what can be loaded out of Yanbu in the Red Sea, we're maxing out, to your point, around 4.5 million barrels per day. Typically, you see about 750,000 barrels a day out of Yanbu. That heads north, it goes to Egypt, to then go into a pipe to go into the Mediterranean. But what we're seeing now is a change in behavior as we see these flows ramping up. We see them heading south. We see them declaring for China, for India, for South Korea. But what has got to happen is they have to pass Bab el-Mandeb here. And that's where the Houthis in the last few years have been firing pot shots at tankers going through. So the concern is that whenever there is an escalation from the US or Israeli side with Iran, there is a tit-for-tat escalation on the Iranian side. So if we were to see boots on the ground, whether it's at the Strait of Hormuz or at Karg Island there, it seems that there's a natural progression there for the Houthis to get involved and fire at those tankers that are passing around Bab el-Mandeb, which is hugely problematic, right? Because then you cut off the 4 4 million barrels a day that are passing through there from Saudi. And so the only other flows we see are going via Fujairah, and that has been bombed in recent days. We still saw a loading yesterday, but hugely problematic. The one thing is, Brian, you can actually get a VLCC. This is a very large crude carrier. That's what these long haul vessels are, carrying 2 million barrels. They can pass through the Suez Canal if they're not fully loaded, if they're partially loaded. But if 90% of the crude from the Middle East there goes to Asia, and so it would have to go through the Suez Canal, around the Mediterranean, around the Cape of Good Hope, and so that would take another 4 weeks, something like that.
Yeah, because Suez can only accommodate a certain type of vessel, certain depth vessel. Talk to us about Asia, because I want to drive this point home to our audience very clear that even if the war ends tomorrow, let's say Iran agrees, we agree, there's no more fighting. It's going to be a long time before things in Asia get back to normal, right, Matt? Because you and your team, and I want to give a big shout out to your team. They've done a great job helping us here, helping me personally. A lot of the ships, the last ships of LNG that were going from the Persian Gulf to Asia are arriving now or have already arrived from Qatar. There's nothing behind them, is there? Like, Qatar's offline. This is it. This may be what they get from Qatar for the next couple years.
Yeah. No, exactly. And you can look at South Korea, you can look at Thailand, you can look at Taiwan, and that you see on the weekly data, those flows are just drying up from the Middle East because those cargoes that loaded prior to the war are now being discharged. And so those flows are dropping off. Now, we do have the Saudi crude flows that are going to pick up there, but essentially those flows still arriving over the last few weeks have been a cushion. So these Asian refiners have been able to take that crude, they've been able to turn it into products, where in the weeks ahead here, as those flows dry up, they have nothing to refine. They're dialing back on those runs. That means that not only domestically, they're not getting the jet, the diesel, the gasoline that they need, but they're also not being able to export it. And so then suddenly a South Korea that sends a lot of jet fuel into the US West Coast, those flows are going to slow down. We see inventories in Japan being drawn down there as they are taking that SPR and refining
Matt, I'm
it
sorry to
themselves.
interrupt. Out of time. Is it possible that the U.S. state of California has some kind of fuel shortage of diesel, jet fuel, something in the next couple of days or weeks?
Weeks, and it's going to be jet fuel first, yes.
Wow. Matt Smith, Kepler, doing a great job. Not sure when you're sleeping, but we appreciate you, Matt. Thank you very much.
Thank you.
All right, folks, speaking of energy, be sure to sign up for our forthcoming energy-related newsletter called Power Insider. It's going to be a weekly piece, key news, meeting power players, insight, and more. It's going to launch in a couple of weeks. You can use that QR code on your screen or sign up today. All right, 5, 4, 3, 2, 1. Get ready. The big SpaceX IPO, it's about to blast off, and we'll talk about it with an investor in SpaceX next. All right, as Americans prepare for the historic launch of the Artemis II moon mission this evening, yay rocket launch, many investors are also getting all geared up for an historic stock launch, the SpaceX IPO. The highly anticipated IPO expected to raise around $75 billion for SpaceX, which would give the private space company an out-of-this-world valuation of about $1.75 trillion. Okay, that's a big number. Let's put that in perspective. A $1.75 trillion valuation would make SpaceX smaller than Amazon, but bigger than Broadcom, bigger than Meta, bigger than Tesla, and bigger than Walmart, even making it really the 6th largest company in America. Joining us, Eva Ottos, COO and Chief Investment Strategist of ER Shares, also an early investor in SpaceX through her fund. Eva, good to have you on.
Thank you for having me.
How did we oversell that? How big of a deal is this IPO?
It is one of the biggest deals going. It's going to be the biggest IPO, as you said. The next closest, and certainly in the U.S. history, the next closest one will be Saudi Aramco. We think if there's one company, private or public, in the entire investable universe that we would own, that would be SpaceX. And that's why, as you said, it's our biggest weight in our XOVR ETF. We have very strong conviction in this company.
Maybe given it's SpaceX, it's bigger than this, just this investable universe. Maybe it's all the universes. Okay, it's very, listen, it's, right. Thank you for laughing at that. It's very cool. Rockets are awesome. But what do they do that deserves that kind of valuation?
Yes, it is the moat. It's one of the very few companies globally that actually has a moat. And it has a moat, a very well-diversified moat across many industries, space, AI, telecom. And think about it, when Amazon is launching Amazon Leo, and in order for them to meet the FCC deadline, they need to use SpaceX. When you make your biggest competitor your biggest customer, that is a real moat. So we're the first ETF to democratize private equity. We included private companies in it. And we decided to invest in SpaceX and not OpenAI or Anthropic, because in these companies, AI models can be easily replicated. There's not a real moat. The moat is infrastructure. So now with XAI and SpaceX together, you actually have a moat.
Yeah, we're looking at Anthropic and OpenAI, and who knows where this will all go, but I think your point is well taken. And that rocket scientists, actual rocket scientists, are harder to find than software programmers. And is that sort of the idea around this, which is that what SpaceX does, and maybe Blue Origin, Jeff Bezos, and Leo, his company, Amazon, that is just takes decades to get good at.
Correct.
Decade, if you ever get good at it.
Correct. And we think Elon has put together the best team. That's why they have a reusable rocket. They are the most cost-efficient and reliable rocket operator. We believe Elon is the greatest entrepreneur of all time. We think it's a combination of Carnegie and Rockefeller together.
He's going to be a trillionaire, I think, after this. He might be. I'm not joking. He's going to get close, because this is going to be, if those numbers are accurate, this will be bigger than Tesla. Do you worry there's too much Elon Musk risk in this, that he's too relevant to all these companies? No. Sort of that key person risk?
I think it's actually to the benefit, because now he owns the whole supply chain. Just sort of like Rockefeller, he owns everything linked together. So his competitors are going to be using him in order to put rockets up in the space. So once you get to that point, then you kind of have a monopoly. That's why we think the valuation is justified, because this is not just a tech play, it's an infrastructure play. It has monopolistic characteristics.
You guys do a lot more than just SpaceX. So how much, if at all, does this IPO, SpaceX IPO, does it matter for the overall market?
Yes.
Because if it goes well, I do wonder if there's like an element of investors who've been kind of flittering around the edges that might think, oh, this is cool. Maybe it's time to get in. I don't know.
We see, and that's the reason we democratized access and provide access to retail investors that are being locked out of these opportunities. This is the biggest, we believe, opportunity of the last decade.
Wow.
And this is a unique IPO for three main reasons. First of all, it's the biggest IPO.
Yeah.
Secondly, there's going to be 50 to 75, as you said, billion of fundraising on day one. This is a historic number. And third, if there is an S&P 500 fast track inclusion, that's going to have a buying pressure that's going to mitigate the selling pressure that we see after the 6-month lockup. So So and by the way, that's also going to have buying pressure before the launch.
Buying pressure, not selling pressure, buying pressure.
Buying pressure, because you have 7 to 10 trillion in mutual funds and ETFs of passive money following the S&P 500 index, and you also have 8 to 11 trillion of corporate mandates following the index. So if that money comes in, and if SpaceX has now a 2% weight in the S&P 500 index because it's going to be similar valuation of Tesla now, then that 15 to 20 trillion equates to 300 to 400 billion of buying pressure once the company goes public.
We're talking about rockets. I feel like we should bring in Carl Sagan because it's like he's talking about billions and billions of stars. We're talking about trillions and trillions of dollars. I love it. We just want a good old-fashioned rocket launch because it's cool and it's like not political. Eva Ados, ER Shares, really appreciate your time.
Thank you for
Efaristo. Efaristo. All right. All right, let's get over to Julia Borston for a CNBC News update.
Brian, President Trump is looking to skirt a Democratic filibuster to get funding for ICE by June 1st. Trump said on social media he would like the bill to go through the reconciliation process, which would allow it to pass with only Republican votes. It is unclear what such a bill would entail. Trump said that ICE and Border Patrol agents would be paid through funds already authorized by Congress in the so-called Big Beautiful Bill until funding is secured. A Russian military transport plane crashed in Crimea, killing all 29 on board. Russia's state news agency, citing the defense ministry, said the preliminary cause of the crash was a technical malfunction and there was not an impact on the plane. And the NBA is fetching bids upwards of $1 billion per team for its upstart league, NBA Europe, The Athletic reported, citing sources. NBA Europe would compete with the Europa League, the premier basketball division on the continent currently. Brian, back over to you.
I thought all the good European players are coming here. Who knew? Julia Borston, thank you. All right, stocks, they're higher today, but not everybody is buying the rally. One major firm downgrading U.S. equities a little bit. We'll talk more about that and the risk they see to you and your money next. Obviously, it's been a very good couple of days for your money and the markets. Optimism and some hope grow around a possible solution, an outcome, an end, whatever you want to call it, to the Iran war. President Trump will speak more on that tonight. But there are also some mechanical things happening in the market which aren't getting a lot of attention, including there was a massive computer buy program that hit the market earlier this week that likely helped push stocks higher. Now, your next guest recently took down some of his overweights on stocks here and around the world, moving U.S. and Japanese stocks to neutral, not underweight, just neutral. Alex Saunders, research strategist at Citigroup. Alex, welcome back. Do any of these headlines last couple of days make you think about pushing those ratings maybe back to like an overweight? And if not, what would?
Yeah, thanks for having me back, Brian. As you say, we moved equities to neutral. We're not outright bearish on equities, and we see this much more of a risk management exercise. As you had just mentioned there, we have a long weekend coming up. We had lower liquidity. There's some technical positioning reasons that we saw potentially a rally yesterday. And we know that conflict escalation tends to happen on weekends. The equity market has moved, but we would say it's moved more than the oil market in terms of pricing that de-escalation.
So I want to be clear to our viewers and listeners then, Alex, this is a very short-term call on the market.
Correct. We would say that the risk reward right now for being long equities is just not as attractive as it had been prior.
When would it be? What would you have to see to flip back to be more bullish?
So I think the speech that you mentioned tonight is going to be important. Hopefully we see a cessation of hostilities or a de-escalation. But the second most important thing is the oil price. So we'd like to see more meaningful downside in the oil price, and allied to that, a resumption in exports. So normally we would say that the economy is state dependent. Right now we would say the economy is straight dependent.
Yeah, and I'd referenced, and I don't want to put you on the spot, Alex, I'd referenced these buy programs that have been hitting. There was a huge technical short ahead of that. So can you just, in sort of layman's terms, please, because I know you know the inside of the market, explain to our audience that are not professional traders some of the mechanics that have been going on in the market the last couple of days.
Yeah, so I think positioning is always important. In these sorts of markets, when we have these large potential shocks, positioning becomes very, very important. And I would put positioning into two buckets, really. The first bucket is futures traders, very nimble traders, very dynamic. Those traders went outright bearish, and our quant equity team has models that showed that they went outright bearish just at the beginning of this week. Now, some of that will have reversed. Some of that will be due to technical factors and the fact that we were on a month end. There was rolling of some options contracts. Month end, when equities are down, you tend to see rebalancing into equities as well. So I think some of the moves that we saw yesterday in particular were related to that. Now, there's also the longer term positioning, and we analyze the positioning of managers with a longer horizon, so call it a more traditional 3-month to 12-month horizon. There, we have seen a noticeable shift in sentiment, but we haven't seen a shift in actual positioning, which again points to the risk reward. If we don't get a soon resolution in terms of the conflict, the risk reward is for equities much lower or slightly higher.
Alex Saunders of Citi, really interesting stuff there on the markets, inside, under the hood. Alex, we do appreciate it, and we are watching the president tonight. Alex, thank you very much. All right, sort of on that note, there's a news alert that you have to know about. We got President Trump speaking tonight, but there's also been a headline from Iran. I want to be clear, this is somebody who claims to be an Iranian spokesman for whomever is running the government, in that the Iranian president, Pezeshkian, will issue a letter to the American people likely later today. Again, this is a headline on X from a spokesman representing the Iranian president. Again, we've made it very clear. The president of Iran could say they're running the country. The theocracy may have something different to say, but either way, watch for a potential letter from those purporting to run Iran to the American people tonight. We assume it's going to be more of a message of peace. We don't know, but it's just something else to kind of be paying attention to in the market. All right, speaking of the markets, we just showed you stocks right now. What about bonds? 10-year yield kind of hovering right around that 4.3 mark. And if you're in the market to buy a home, I know it's the spring selling and buying season. It's not great news. I'm sorry. U.S. mortgage rates climbing for a fourth straight week. Nationally, the rate on a 30-year mortgage increased to 6.57%, according to the Mortgage Bankers Association. And that is actually the highest level on the nationwide average mortgage since last August. It's up about half a percentage point from just 1 month ago. So mortgage rates and interest rates going up, at least for now, not down. All right. Coming up, oil is down, but crude oil still hovering around $100 a barrel. What your market navigator says, not too late to cash in. Find out why next.
Discovery Houston, press to ATO.
Liftoff of mission 41D, the first flight in the orbit of Discovery, and the shuttle has cleared the tower.
3, 2, 1, 0, 0. Discovery, going throttle up.
Discovery's 4 computers now have primary control of critical vehicle functions.
Welcome back to Power Lunch. I'm Dominic Chu with your market navigator today. If you aren't already invested in energy, is it too late to jump in and benefit from those spike in oil prices? Our next guest says no and has a twist on that energy trade. So joining us for the case is Skylar Winan, Chief Investment Officer at Regan Capital. So Skylar, let's talk about if you don't want to deal with what could be an overbought condition in oil and oil stocks. How exactly do you play energy from a derivative standpoint? And I don't mean futures and options.
We got two great energy names, one of which, Trinity, TRN, the largest rail car owner in the United States. They also are one of the biggest lessors, and at 97% utilization rate, when we think about deglobalization, as well as, what are the issues going on right now, Strait of Hormuz and shipping, we're talking about being able to ship via rail car. And it's not only oil, it's wheat, it's other commodities that they're going to benefit from. The other one being Weyerhaeuser, WY. This is the largest public landowner in the United States, trading for about $1,500 an acre. They own over 10 million acres, and you can benefit from housing, you can benefit from direct lumber sales, but you can also benefit from royalties and land sales. So they can sell land, they can sell royalties on their land, they can lease their land, and if we go the other way, they can also sell to carbon capture regimes for folks that want to just own that land and be able to benefit from carbon credits. So two great names, one's $2.5 billion, one's about $17 billion, that can benefit in that non-energy sector from high oil.
All right, Skylar Wynant at Regan Capital with the case for how to play energy without energy stocks. Thanks for that. And by the way, keep it right here. We got more Power Lunch coming up right after this break.
I got to wrap it up with this. Got some more headlines about the war in Iran. Vice President J.D. Vance has been speaking with intermediaries to Iran as recently as yesterday. That according to new reporting from our colleagues at MS Now. President Trump reportedly has directed VP Vance to communicate privately that he is open to a ceasefire as long as certain American demands are met. So again, they're apparently, according to MS Now and Reuters, back-channel communication, Trump to Vance, Vance to intermediaries, purporting to speak with those who say they are in charge of Iran. Again, we hope that's the case. We want that to be the case. We're just not sure who is running Iran right now. But either way, certainly is good news. And the president will address the United States tonight, 9 p.m. Eastern time. We'll see if we get more. Apparently also a new letter or a post from Iran will be going out to the American people later today or tomorrow. A lot of fast-moving headlines. Here's what we do know. The markets are up, not as much as they were, but the Nasdaq's still up about 1%. The S&P 500 up marginally. Small caps, mid caps, they're now higher on the year. I'm heading to a great friend and country called Canada. I'll see you in a couple days next week. Closing bell starts right now.
All right, welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with another jump in stocks as the president signals a coming end to the war. Here is a look at the majors now. With 60 to go in regulation, we have had some nice follow-through from yesterday's big rally. Lost a little bit of steam in the last 30 minutes or so. We'll keep an eye on everything over this last hour. Big banks and some of the industrial names today, two of the strongest groups. It's been another pretty good day for the mega caps, led by nice jumps in Meta and Alphabet. And there is Apple marking its 50th anniversary today. It, too, is in the green. Semis are strong as well. Micron with a massive snapback today from its large and recent decline. There's the stock getting about 8+% back, but some of the other chip materials names are on the rise as well. Not Nike, though. Shares are tumbling today. Its outlook falling short of expectations. Its China business under significant pressure still. The stock down about 15%. It does take us to our talk of the tape, the investor playbook, if in fact this war is nearing a conclusion. Let's first go to Washington for the very latest as the president gets ready to address the nation this evening. Our Eamon Javers is in our bureau in Washington with more. Hi, Eamon.
Hey there, Scott. White House officials have started to give reporters a sense of what President Trump will say in his address to the nation tonight, but they're not indicating that the president will make any major announcements or news, although, as we know, that can always change. A White House official tells CNBC the president will give an operational update on the progress of Operation Epic Fury, which they say is meeting or exceeding all benchmarks. He's expected to say the U.S. military has been successful in achieving all of its stated goals prior to the operation. Those include destroying Iran's ballistic missile and production facilities, annihilating their navy, ensuring terrorist proxies can't destabilize the region, and guaranteeing that Iran can't obtain a nuclear weapon. The official also says the president will reiterate the 2 or 3 week timetable for concluding the operation. We heard him say that on camera as recently as yesterday. Now, with all that said, it doesn't sound, at least so far, as if the president's going to use tonight's address to announce an end to combat operations or a major escalation, but we'll have to watch at 9 p.m. to find out, Scott.
Yes, we will. And we will talk to you many times after that. Eamon, thanks so much. It's Eamon Javers in Washington. As you see, oil prices, the key question now, not moving all that much, still elevated as the Strait of Hormuz remains effectively closed. Pippa Stevens has more on that angle for us today. Hi, Pippa.
Hey, Scott. So modestly lower here with oil hovering right around the $100 level. And the last of the pre-war loaded cargoes are now being delivered, meaning the extent of the supply shock has not yet been felt. Data from Kepler showing that Middle Eastern barrels, excluding Iranian crude, in transit to Asia has plunged to just 13.5 million barrels this week, down from the typical pre-war level of over 110 million barrels. And Bank of America is saying today that their new forecast is for oil to stay around $100 per barrel for the rest of this year, assuming the war ends at the end of this month. And if not, crude could average 130 for the year. Now, the energy sector is on track to snap its record 14 straight weeks of gains. B of A noting that investors are dumping individual names in favor of broad exposure. Energy ETFs seeing the biggest inflows since the start of the Russia-Ukraine war. Scott?
I appreciate that update from you, Pippa Stevens. Thank you very much. Now to our panel, Rockefeller Private Advisor Cheryl Young, RBC's Lori Calvasina, JP Morgan's Stephanie Aliaga. It's good to have everybody here at Post 9. I get the feeling from reading everybody's notes that the common theme is that all of you are trying to look past this, to look through it to the other side as to how you should be investing, thinking that this is going to end pretty soon. Is that fair?
Hopefully very soon. I mean, Trump's indicating that. That's what we're hearing. We'll find out a little bit more tonight, I think.
Yeah. So how is that impacting what your thoughts are on the market itself?
So I think that you have to really understand the risks that we have with all the geopolitical tensions. And you also have to look at what was working prior to going into this. Energy was already up 25% year to date going into the war, and people are kind of forgetting that that was already a major theme because of the massive need for energy in AI build out in data centers. And so I think energy's gotten really extended, but it's still a very interesting sector. It's something that I think you have to hedge right now with where it's trading. But outside of that, you have to really look at how is the economy doing. The economy is doing pretty well overall. We're still seeing really robust earnings growth in stocks.
Lori, it sounds to me like you are very much aligned with Ed Yardeni, who says, if Trump is declaring mission accomplished, then so are we regarding our stock market correction call. We'll probably lower our recession odds once we have a better handle on whether the conflict is actually over. We reserve the right to change our mind. Nevertheless, we've maintained our 7,700 S&P 500 year-end target. Yours is 7,750, and it hasn't changed. So you're in camp Yardeni.
Yeah, so we changed our process a little bit this year. So we're doing a 12-month forward look, and we update that monthly. We haven't made any changes. And I would say what I've been trying to emphasize to people is just take it one day at a time. I think I've said everybody needs to take a deep breath more times than I can care to remember. But the reality is that we know that we will come out of this. And so what I've really been debating is that if we're looking at sort of the short-term interim downside, are we in a tier 1 drawdown or a tier 2 drawdown? Now, what I mean by those, tier 1, that's what we're in, garden variety, 5 to 10%. Market's trying to stabilize in here, and I think we did sort of come to the brink, whereas one of my colleagues told me this morning things were starting to get a little dicey. If you go back to the GFC, if you don't stabilize around 10%, what we've seen in these corrections is you tend to go down at least 14. And so tier 2 for us is a 14 to 20% growth scare type drawdown where you're fearful of a recession or an unwind, but it's a near miss. And I found, frankly, as I was talking to investors last week, and I did a big, sort of a 4-day trip, frankly, talked to more investors than I can even remember. But I found that most people were sort of debating the same as well. We're not really, we're starting to hear questions. Are earnings expectations going to be hit? What are your stress tests for GDP? But nobody's using the R word right now.
Yeah. Are we capable of the last 2 days suggesting that now we have firmly stabilized in your mind? Or are we still a little dicey? How do you feel?
We're still a little dicey in the sense that we haven't reached an all clear for markets on the geopolitical front. That's absolutely still a risk, but markets don't necessarily wait until they have the all clear, right? And neither should investors. By the time that we get the all clear, it tends to be too late. So you need to make sure your positions, your portfolios are right sized to now an increased likelihood that we wind down here within a number of days or weeks. And what does that mean? I mean, it means that we can refocus on some of the fundamentals that we think are still very much intact, even with this war having lasted a month. And a lot of the resiliency that we're seeing and the upgrades we're seeing on earnings around the AI theme, many of those names of which valuations have come down to meaningful levels. I mean, the top 10 stocks in the index are at their lowest valuation relative to the broad market that they've been in the last 5-6 years.
The key of what you said is most especially the earnings outlook. It hasn't changed. And if anything, it's gone up. So people are still, holding on to the dream that earnings are going to live up to where their expectations are, even if oil prices remain elevated. And on that note, I thought Bank of America had a note that was worthy of debating today, where they suggest it's oil being elevated is more of a headwind for growth than earnings in stocks, in which they say our economists bumped down their real GDP forecast from 2.8 to 2.3. But energy costs are a relatively small portion of total S&P 500 operating costs. We maintain $310 for earnings, which would be 13% year-on-year growth, right? That's still pretty robust. And that's why they say you can look through this to the other side and earnings are going to live up to the hype. And thus, if they do that, then stocks have to, right?
We hope so, but there's still a lot of things that can go wrong. Scott, we're seeing disruptions. For example, today there was news about tea being, the supply chain issues with getting tea to places in cosmetics. And so I think there's still a lot of ambiguity about what the risks to supply chains are. And I think one of the big questions I would have is there's still a lot of issues in the region where, for example, AWS got hit 3 times in early March. It's not really hitting the news a lot, but there was a lot of disruptions to banks in the Middle East. There was disruption to Snowflake. There's still problems that could come out of this. And remember, consumers are 70% of the economy. So when I go fill up the gas tank, I don't think a lot about it, but I can guarantee my 22-year-old does.
I mean, you manage money for wealthy family offices. Are they at the point now where thinking we should stay more cautious? I mean, your constituents, so to speak, are a different kind of investor.
Yes.
Extremely wealthy people who want to hold on to the money that they have. They're probably more risk averse than many others, wouldn't you say?
Well, I'm in Silicon Valley, so I get a lot of I get a lot of very aggressive clients as well, Scott. And we tend to like stocks more than bonds just because if you have enough money, you can ride through these kind of market cycles, right? You don't necessarily need to de-risk or get scared when things go awry. And I think the question really is, is there risk to these companies in our core portfolio? If I look at the Mag 7, for example, these stocks are trading at multiples that are finally starting to get interesting.
Yeah, that's what Stephanie was saying. I mean, they've really compressed.
They've really compressed
across the board.
And I don't think companies like, Meta or Google are really at great risk because oil prices are higher. I think they're going to work through this quite well.
Is that the game changer in any way in this whole thing, Lori, is that you have had multiple compression in stocks that some had suggested had gotten a little too rich and were spending too much money, and now they have found themselves into an attractiveness that they maybe haven't had for a minute.
I think that's true for the U.S. broadly, and this AI tech part of the market is sort of the beneficiary of that. And so if I go back and look last fall, the market cap weighted S&P 500 PE, just a bottom-up calculation, was at 28 times. And if we look at where it is as of last Thursday, it was down around 21 times. And we saw some of the big mega cap, growthy names. I can't say names on TV, but we saw some of those.
Everybody knows which ones you're talking about.
But we saw those, just dramatically derate. And at the same time, what happened was that European valuations moved up. Canadian valuations, the most expensive on my global developed markets framework right now, Australia moved up. And so if we actually measured this the Tuesday after the Iran strikes occurred, if you looked at the U.S. versus non-U.S. on a relative PE, we were way below the 5-year average. And we had actually washed out the premium on a 20-year basis. So we're hearing, both bottom up and top down, there's some resiliency in the U.S., obviously risk in pockets, but better off than Europe or Asia. But the valuation door was also opened for both those tech names and the U.S. broadly to benefit from that outperformance and resiliency.
Does the door opening, especially, Stephanie, for those tech names just invite people to walk through it again on the other side of this?
I think a lot of this depends on the duration of this conflict, of course, and now...
Let's take it at face value. Let's just assume, let's just say it lasts another 2 to 3 weeks. What the president's going to tell the nation tonight. We're going to see whether that plays out to be the case, but nonetheless, if I told you that's going to be the case, and you believe that, how does that factor into how you'd answer the question?
I think the fundamentals are still quite resilient. I mean, we're in the sweet spot right now, where so long as this conflict does not persist for many additional months, we have a handle on some of these supply constraints that could really pose an issue for these AI companies. It's after those few months that things get thornier, because right now, I mean, you have economies like Korea and Taiwan facing the greatest pinch when it comes to prices because of this energy shock. But who depends on Korea and Taiwan for all of these all-important inputs around chips, right? U.S. companies do. And those prices would likely be passed along to those U.S. tech companies. The good news is we're putting a lower probability on that happening this week than we were last week, and that's helping, I think, with some of this momentum.
Is the broadening trade the thing that's most at risk? Is that the thing that's changed the most within the market? Because if I'm worried now about a potential growth scare from elevated energy prices, how am I going to feel confident enough to go out onto the cyclical curve, ones that are more susceptible to a slowing economy?
I think that's right. If you looked at small caps going into February 27th, small caps are up over 6%. I mean, they're barely up on the year.
Yeah,
They've
but the fact that you can even say that they're still green for the year
is
a stunning statement in many respects in that of itself.
Yep.
The fact that the Russell's green.
And green today. But I think there's a little bit more risk. I think investors are going to tend to hunker down, go a little bit higher quality. So I think those Mag 7 names still do very well in an economy like this. People want something they can get their hands on and know. And again, if you think about what's been moving the markets over the last couple of years, you take South Korea, Taiwan, to Stephanie's point. I mean, DRAM contracts this month, quarter over quarter, were up 90 to 95%. We still have massive demand. And you look at companies supplying memory, for example, they're sold out for the next 2 years. There's still a lot of appetite for what can happen with this AI trade, and that is very positive for semiconductors, positive for the Mag 7. I think we still see stabilization towards those larger
And I don't
names.
think you want to talk about individual names, but so I'll do it. But we can look at a chart, for example, of Micron, which I know you're referring to. So you're suggesting that pullback and ones like it were overdone?
I think it's overdone. I mean, again, not referring to any specific names.
Sure, that's why I did.
There's some
that's why I'm here.
Some great memory names coming out of South Korea as well. And yes, I think that they just got hammered and unreasonably so.
How about the broadening trade, Laura? Is it now in some serious question? And is that yet another reason why I want to look at those types of stocks, the Mag 7, other semis, and gosh, maybe even software, which has been beaten up so hard?
Yeah, I mean, look, I do think that this has reminded me a little bit of the rebound out of tariffs last year. And if you looked last year, we had this broadening trade to start the year. We had the whole tariff issue, and then we had the summer of the AI names, right? And then we got another broadening trade towards the end of the year. And we actually have gone and looked, sort of at the earnings growth dynamics very, very closely. And we said at the beginning of the year, we said we're going to lean into the broadening trade for now. But if the rest of the market cannot display superiority on various earnings metrics, it's not going to last, and it's going to be a tug of war. And guess what? We're right back to a place where the rate of upward revisions is strongest for the top 10 market cap names and barely in positive territory for the rest of the market. If you look at bottom-up consensus numbers for 26 and 27, they're 4 to 6 points ahead in that Mag 7 trade versus the rest of the market. And we've actually seen 27 numbers improve a bit in addition to 26. So that Mag 7 trade, that AI trade, is hanging on to its earnings dominance, and people want to rotate so bad, but AI is just not letting it.
Believability and durability, right? The two words that I think of maybe more than any others when it comes to exactly what Lori was saying about those names. If you have believability that they're going to continue to deliver their earnings growth, which is better than everything else, and they're durable more so than these others, and they can withstand some geopolitical events, they're looked at as times as safety plays, that feels like it leads people back.
Yeah, I mean, these tech companies are less sensitive to things like higher energy prices and even a tightening in credit conditions because of how much of this capex is cash financed. And beyond that, as long as you can hold on to the belief that we are still in such early innings of this AI adoption boom, that is bullish for many of these companies that have already seen cloud service revenue grow 37% year over year.
You guys worried at all about the backup in rates that we've had? Because it felt like a good headwind, Laura, for the market itself. Now, obviously, they started to come down, but they're back up as we have this conversation now.
I think it matters tremendously. And we saw back in 2023, there was a 10% drawdown in the S&P, and the only thing I could figure out at the time was that 10-year Treasury yields were moving up. And I know I've been running stress tests like everybody else for the last month, and my first higher oil price scenario, I put in 4.5% on the 10-year yield for my PE multiple assumption. It's a long story, I won't get into it, but it's one of the feeders into it. And, within a week of having that out, I had to revise it and put in 5% because we were already getting close to that 4.5%. So, and we have just seen historically, for whatever reason, when you even start talking about 5% 10-year Treasury yields, it adds some angst to the market.
Well, you could see it. Like when we started to approach, 5, we get like 450-ish. Now we're at 432. It's a different story. People started to feel a little uneasy about that.
Yes, and they should. There's been so much discussion about rates moving down this year. And again, I just don't see, we'll see when the jobs numbers come out and more to tell there. But I think the pressure is going to be on a little bit more of an inflationary, for the short-term time frame, which is not great for stocks.
Well, last point, Steph. Same
No,
thing.
I think I absolutely echo that. I think we're going to see rates probably set a little higher for longer. But look, it's for good reasons, right? We don't see the rug coming out underneath the labor market because corporate America is doing quite well. And for all of the doom and gloom around AI boosting layoffs, we actually don't really see evidence of that in the hard data. But where we do see evidence of as AI boosting corporate efficiency, boosting corporate productivity. And we think ultimately that's going to be bullish for the labor market.
All right, great having you all here. Ladies, thanks so much. We'll talk to all of you soon. Boy, Nike got to be one of the stocks of the day today. Gabrielle Fonrouge is following that on what is dragging this stock down by so much, Gabby.
Yeah, so shares of Nike are on pace for a new 52-week low today after the retailer issued weak guidance and warned its turnaround is taking longer than expected. Now, last night, investors were looking for a show-me story, but all they learned was there's still more pain ahead. Sales are going to be down for the rest of the year, and its cleanup in China could persist through fiscal 2027, which hasn't even begun yet. Nike does expect gross margin to begin to expand at the end of the year, but that could also be at risk given the war in the Middle East and potentially higher input costs. The lagging turnaround and the persistent bad news is leading Wall Street to lose patience with CEO Elliott Hill's turnaround plan. This morning, Bank of America, Goldman Sachs, and JP Morgan all downgraded the stock. Scott.
All right, Gabby, thank you, Gabrielle.
Thank you.
We're just getting started here. Coming up next, countdown to an IPO. SpaceX reportedly filing confidentially to go public. We do have new reporting today as well on the race to go public between Anthropic and OpenAI. We'll ask top VC Lo Tony for his thoughts next.
the tower. Every core computers now have primary control of critical vehicle functions.
SpaceX reportedly filing confidentially for its coming IPO. Mackenzie Sigalis has more details for us today. Hi, Mac.
Hey, Scott. So this confidential filing sets up what could be the biggest public market debut in history. SpaceX reportedly looking to raise $75 billion at a valuation north of $1.75 trillion. Now, this lets SpaceX work through SEC review in private before opening its books to investors, though it would still need to make that filing public at least 15 days before the roadshow. Bloomberg says the company is currently preparing for investor briefings this month to justify that valuation. The pitch is that SpaceX isn't just a rocket company anymore. It now includes Starlink, X, and XAI, while also running a massive government business that's brought in more than $24 billion. If the deal happens, it would be historic on every front. More than 20 banks reportedly on the underwriting syndicate, retail investors potentially getting as much as 30% of the offering, not to mention the fact that it would make Musk the first person ever to lead $2 trillion public companies. Scott?
All right. Mac, thank you. Mackenzie Sigalis. For more on what to expect from that offering and the other major ones that are looming large, we are joined now by the venture capitalist Lo Tony of Plexo Capital. Welcome back. It's good to see you.
Thanks for having me.
What are your expectations for SpaceX?
Well, it's a potentially $25-30 billion IPO, but with a very small float. So I would say it's not so much about liquidity as it is to potentially have better price discovery. And to put that in context, this deal could rival an entire year of IPO issuances. And if it prices at the high end, then we're talking about one of the largest IPOs ever. But I think we're focusing solely on the IPO as a bellwether for other IPOs, such as Anthropic, where we are an investor, or OpenAI. That misses a larger point. This is the first company coming to market that's really trying to control the full cost curve of AI infrastructure. And that's not just compute, but where compute lives. And we've been focused so much on GPUs, data centers, and power constraints, but there's another constraint emerging, which is the location and energy availability. Communities have been pushing back about power usage in their areas. Policymakers are talking about making the data centers identify their own power. And so maybe the question starts to become, what if constraint isn't just chips and power, but where compute lives? And I think that's what also makes SpaceX very unique, being able to control launch, global data transport through Starlink, and now AI through XAI. And so a logical extension is moving compute off Earth. So I think investors are really underwriting two timelines at once. Near term, Starlink growth, launch economics, but long term, it could be a bet on a completely new model for AI infrastructure.
Is that a good or a bad thing?
Well, I think for an investor, that is a bet that could make a massive payoff if it happens. I mean, there's a lot that would need to be in place. So this isn't something that could happen near term, but we have heard Elon talk a lot about this. We know Elon is a fan of vertical integration. We've seen that executed very successfully at Tesla, and we see him going deeper with SpaceX. And he's talked about the ability to be able to take advantage of 24-hour solar power, the ability to have a different method of cooling, kind of figuring out how to deal with vacuums, but space is cold, so that works, and to not have to deal with any of the, terrestrial regulatory issues about going into communities. So I think, that's kind of the larger bet. So we have a few threads happening with this IPO.
That's interesting. And the idea, too, that retail is potentially going to get a much larger chunk of this right out of the gate than would traditionally be seen. What do you make of that?
Well, there's a couple of things. I go back to the small amount of float and price discovery, coupled with the fact that we know that Elon has a massive following of fans who are clamoring to get their hands onto this opportunity. SpaceX historically has been one of the most popular names within the secondary market. So I think this is a little bit strategic as well. And again, with that small float, there's a natural constraint on supply. So again, this is going to allow for a nice discovery of what the price really is that investors will bear, especially those retail investors as well.
Since you mentioned the secondary market, there was a story that moved earlier today that I thought was quite interesting, and I wanted to ask you about. I'm gonna ask you to try and take your Anthropic investor hat and put it to the side and just try and judge this best you can based on the story that OpenAI and the shares have fallen out of favor, according to this report, on the secondary market, as there seems to be just a tremendous amount of building buzz for Anthropic. What should we make of that?
What I think we should make is what we looked at when we go back all the way to 2023 in the fall, when we first started looking at Anthropic. What we liked the most was the fact that the company was very focused on the enterprise market. And that was reflected not only in their approach to building out the infrastructure, where Anthropic, instead of like OpenAI, Anthropic doesn't do video, right? So it's a much more efficient use of their compute. But then also the way that there were guardrails instrumented around the Anthropic platform as well. We suspected that was going to be much more attractive to the higher margin enterprise customers. And again, focusing on those enterprise customers and their needs, so therefore not need to do things like video, would allow for a quicker recovery to cash flow break even. And so we're now seeing that play out in a few different ways. We're seeing OpenAI shift more towards enterprise, and we're seeing OpenAI begin to constrain some of their efforts around where their areas of focus are going to be, most notably and recently with the discontinuation of Sora, which was a massive cost to them in terms of the compute. So I think the secondary market right now is reflecting somewhat of a repricing of risk reward for AI, not solely focused on just the growth dynamics themselves. Both companies are growing really well, but I suspect that that is a signal that secondary investors are telling us they feel a little bit more comfortable with the risk reward of Anthropic and where Anthropic is on the valuation curve.
I almost feel like you're suggesting that what felt at the beginning like, such a transformational tool for consumers who looked at what OpenAI had done with ChatGPT and said, I've never seen anything like this before, could end up being more monetizable, if you will, at a higher rate with Anthropic and the enterprise applications that they have. Is that something that we need to focus on a little bit more? Is that what's at play here in some degree as well?
Absolutely. I mean, that really summarizes it quite well, which is why you have your job. So when I think about where we're heading with the labs, with the OpenAIs, the Anthropics of the world, if we look at their product line, a lot of people focus on the chat experience of OpenAI. It's almost like a Kleenex of sorts. When people think on the consumer side of AI, they often think of ChatGPT. That's one area. And I think ultimately my thesis is that the intelligence as a product will converge as we get closer to AGI. And so then whether an enterprise chooses to use OpenAI or Anthropic, it'll be somewhat fungible in terms of general intelligence. Where Anthropic has shown great prowess is in being able to customize around specific verticals. We've all heard what's happened with Anthropic and their Claude Code, right? And so that is a signal that they have been able to kind of take their general intelligence product, customize it for code, and come out with a very compelling application. And I've always talked about for the past 2 years, when we move up the stack, that's where we're going to see the most value is in these applications. The more that Anthropic begins to build out for other areas, finance, some of the work they're doing to power the buyouts of the private equity firms, consulting. That's where I think things get very interesting, is being able to make these customized solutions as applications to sit on top of the intelligence, where I think the intelligence will be able to converge, and we won't have these conversations around who's at the top of the leaderboard for intelligence. It'll be about who's monetizing that intelligence with applications that have good margins.
It's going to be fun to watch. Great insight, as always. Lo, thanks so much. That's Lo Tony of Plexo. Still ahead,
Thank you.
Apple marking that major milestone today. Star analyst Dan Ives has a new note on what he expects that stock to do. We'll discuss when we come back. 50 years ago today, a company called Apple Computer was founded in California. It's since grown into one of the most important and successful consumer product businesses ever. The stock up 259,000% since the IPO back in 1980. And as you know, reigned for years as the most valuable company in the world. It recently ceded that crown. For more, we're joined by Wedbush analyst Dan Ives. He's with me here at Post 9. It's good to see you.
Great to be here.
It's been a remarkable run, and we'll talk about what's next. But what is the fact that the stock feels like it's a little more resilient than some of the others. It hasn't come as far off its 52-week high as some of the others. And the smartphone business, its core business, feels like it's pretty good.
Yeah, I think to some extent it's been a surprise upgrade cycle in terms of iPhone 17. And then you look at the services business, that's held up, Rock of Gibraltar-like in terms of what we've seen from the growth. Looking in from AI, and obviously the disappointment in the last few years, but ironically, almost by accident. It's like they went the wrong way, but somehow they got there first. In terms of not spending on CapEx on AI and almost waiting to some of that was self-inflicted, they now find themselves in a situation with 2.5 billion iOS devices to ultimately monetize the AI revolution from a consumer perspective. And I think that's why it's been a safety blanket in a very nervous environment.
It really is interesting. What was perceived to be a tremendous liability now in hindsight feels like it was a good decision to be more asset light than some of these other companies that are just tripping over one another to spend the tens of billions of dollars that they think is required.
I'd say, look, 80% of that was I think, by accident.
Yeah, of course.
I mean self-inflicted.
Sometimes the best things happen by accident.
Yeah, exactly. And I think, but Cook definitely recognized, especially over the last year, that like they needed to change the DNA from an AI perspective. They brought in from the outside in terms of some of the Microsoft and others. And I think in terms of, when you think about Gemini and Google, that's another one, like almost by accident, because by the DOJ, by that suit, by Google winning, that now opened up the opportunity to really double down as a partner with Gemini, which is really going to be their core engine when it comes to AI. But with that said, a golden 50 years. But now it comes down to Cook's legacy will be defined by the AI chapter.
What do you think his best accomplishment has been in his tenure in this run?
I think, first off, supply chain logistics. I mean, Apple, I think some will say, and they'll say, okay, they've lost their innovation. I actually think Cook has innovated massive in terms of the last, call it the last 5-7 years, but it's really the logistics, the supply chain. What they've built out is really unrivaled in terms of around the world, and obviously a lot of that in China. And then you look, 10% politician, 90% CEO. I think his ability to navigate regards to the administration has been really one of his key parts of the success.
He's got to get AI right? It's too early to declare victory. Would you say?
And that's why WWDC will be extremely important in June, and they need to make sure that the consumer AI revolution comes through Cupertino.
All right, I know we'll see you out there. We look forward to that. Dan Ives, thank you, as always. All right, coming up next, we're tracking the biggest movers as we head into this close today. Christina Partsinevelos is standing by with that. Hi there.
Hi, Scott. A major chipmaker buying back a multi-billion-dollar stake in one of its own factories. We'll have that and obviously much more when we come back after this short break.
We're just about 10 from the closing bell. Let's get back to Christina Partsenevelos for a look at the stocks that she's watching. What's on your list?
I want to start with Intel shares because they're jumping, down from earlier highs, but still up almost 9% after announcing it's buying back Apollo Global's 49% equity interest in its chip facility in Ireland for roughly $14.2 billion. Apollo spent $11 billion just a few years ago because Intel sold that stake in 2024 and says this move right now reflects stronger business momentum and could help their credit profile. That's why shares are up. RH shares, though, are going the opposite direction, tumbling about 20% after posting earnings and full-year revenue guidance that did miss Wall Street expectations. The home furnishings company said it was hit by tariffs and bad weather, and they expect revenue to continue to decline in Q1. And then shares of Hasbro, they're falling right now, roughly about almost 5% after confirming a cybersecurity hack. And the company says it may take several weeks before the incident is actually resolved. The Peppa Pig and Dungeons & Dragons toy maker has taken certain systems offline and is conducting an investigation to figure out the scale of this breach. Scott?
All right, Christina, thank you. Christina Partsenevelos coming up next. The big weight loss win that is sending Eli Lilly shares higher today. Look at that stock, better than 4%. Details in the zone next. We're now in the closing bell market zone. Mike Santoli and 314's Warren Pies are here to break down these crucial moments of the trading day. Plus, Tanaya McKeel is watching CoinShares' public debut, and Angelica Peebles is tracking that action we showed you in Lilly a little bit earlier. Michael, feels like we sprinted and now we're just a little bit tired. We need a drink, we need to catch our breath and see what's what.
Yeah, to a degree, Scott. Certainly at the highs today. We spent like 2 hours with the S&P 500 just hanging around 6,600. I feel like a lot of times you have one of the prospects for this tactical lows, a strong rally day, and then it's about the market almost reacting to its own reactions to these different levels. That's where we are right now. I'd point out it's also a very top-heavy performance day in terms of what's driving this follow-through to the upside, which is modest at this point. So, there's tests along the way. I think you have to be open-minded to the possibility that at the recent lows, Friday and Monday, the market did price in maybe a more prolonged and more complicated conflict with more oil disruptions. But you need confirmation, I think, incrementally here from oil and everything else to have this be more than a bounce.
I mean, what does the shortened week do for how you think this is going to wrap up, right? We're going to get a jobs report, I think, still on Friday, even though stock market's not open. So do we tomorrow just wait and see what happens between that and then over the weekend with the war?
Obviously, that's a good possibility. The pattern in recent weeks has been weakness in the 2 days before a weekend, or the day before a weekend especially. I really think it depends on whether the market feels it's getting any sort of clarity tonight from the president and from Iran, by extension. So if it feels as if, we're on some kind of a glide path to something that seems like a reliable de-escalation, maybe we won't have a flare-up of nerves ahead of the weekend. But obviously, the possibilities of a weekend that's 50% longer than normal without trading could in theory, cause some hesitation.
What do you and Mel got coming up in a few minutes?
Well, we have Bob Diamond, former Barclays CEO. He's just in the Middle East. He's going to give us his take on the economy there, what the markets are contending with, as well as Chris Ferrone with some timely charts on individual names as well as the index.
Oh, good stuff. Look forward to that. We'll see you in a little bit. That's Mike Santoli. Tanaya, tell me more. CoinShares making their debut at the NASDAQ.
Yeah, Scott, a rough picture for the crypto asset manager CoinShares, now down 25% today. This was a SPAC merger valuing the business at $1.2 billion. The timing here is so interesting, Scott, because crypto's been in this bear market where prices are suppressed, but institutions' appetite for crypto is definitely growing. There are clear signals of that. I wonder how much SPAC mechanics and the overall drag on the sector today are weighing on the price. CoinShares has a steady revenue model, profitability, longevity in the market. This is a European company, about 12 years old now, that definitely, are not trumping the short-term selling today. But then again, the company also faces big competition from BlackRock and Fidelity, as well as specialty firms like Bitwise Asset Management. I spoke with J.M. Munietti, the CEO. He said the success point isn't today. It's 36 months down the road, 18 months down the road, and that their success is going to be measured at some point by their ability to grow in this market in the U.S. Asset managers, super fun in crypto right now, Scott. I'll keep an eye on it for you.
All right. Thanks so much, Tanaya. Angelica, tell us more about this move in Lilly.
Yeah, Scott. Well, today the FDA is approving Lilly's GLP-1 pill. Now that is called Foundayo. And the decision gives Lilly yet another way to compete directly with Novo, which introduced a pill version of Wegovy earlier this year. So this approval alone was one key for the stock. People weren't sure exactly when we'd get that approval. And now the attention turns to how well Lilly can sell Foundayo. So CEO Dave Ricks telling me that he's encouraged by the uptake so far from Novo's Wegovy pill. In just a few months since it launched, about 600,000 people have received prescriptions for that drug. And analysts I talked to say that they're going to be closely tracking prescriptions here, since that's a faster signal than waiting for quarterly earnings when you actually get those sales results. And they realize that this is a new brand, so prescriptions might not take off as quickly as we've seen with the Wegovy pill. And on the recent stock weakness, Ricks, the Lilly CEO, he says that people can write what they want or trade against Lilly, but that their job is just to deliver. And so now we will be looking to see if the company can indeed do that, Scott.
All right, Angelica, thank you. Angelica Peebles. All right, Warren, we still need to take the 200-day back, right, before we can feel better? I'm sure you're going to tell me that.
Yeah, I think that, look, this is like a headline-driven market, so it's hard to put a bunch of risk on or take risk off, as we've seen the last couple days with this face-ripping rally. But I think so you have to rely on technicals. So we broke out of this long-standing consolidation, and the good news is we've re-entered into that range, which is actually a pretty good sign when you break down that maybe the lows are behind us. That number is 65.38. The next thing we're looking at is the 200-day at 56.40. And then a 50% retracement of that correction, that almost 10% correction we have on the S&P 500, would take us to 6660. That would basically say, if you go back to history, look at 10% corrections, that by most cases that we're done, we've seen the lows. So those are the numbers we're going to be watching. Everything's going to come from what we hear from the president tonight, though.
Yeah, I mean, we think we know what we're going to hear. I'm not sure what difference that's necessarily going to make for the market. What do you make of the money that's come back into tech?
I think it shows you where the underlying strength is. If we remove the disruption from the war, like we've talked about, if you could get back to February 28th before all this started, what are the underlying trends in the market and the economy? I think that the secular trend that everyone wants to flock to is the AI story, and the meta group underneath that right now are the semis in the scramble for compute. And so everything we track says that is continuing to pace. And so I think everyone's wanting to get back into a normal cycle, but it's kind of impossible right now until we get a little more clarity.
Yeah, let's try and get some stability too with the big bank stocks, right? Which are better today, but you need to put a few things together there.
Yeah, absolutely. I mean, leadership's been a problem for this market all year. We've had energy and staples, which have been the strongest sectors. Financials and tech have been negative on the year, and they've been laggards. That's the reason we downgraded stocks back in February. It was like the canary in the coal mine.